All right, welcome back everybody to now the final weekend of the 2025 TraderLion Trading Conference. This has been fantastic so far and really looking forward to ending things out strongly. We've got a great lineup of presenters today as well as tomorrow. So looking forward to hearing all your guys' feedback on those. Let us know in the chat right now where you're tuning in from. Always cool to see who's the furthest away. So we'll have a friendly competition there. And then also let us know in the chat, what have been some of your biggest takeaways from the prior weekend's presentations, and also who have been your favorite presenters so far. Be curious to hear what you guys think. With that said, I just want to say again, we have such a fantastic lineup of presenters, from market wizards to top traders to top educators. Really an extreme wealth of knowledge that we're really lucky to have. So huge thank you to everybody who's presented, and looking forward to hearing the excellent presentations today as well. Speaking of which, here is the planned schedule for today. First up at 9:30, we've got Oliver Kell, U.S. investing champion and record holder, discussing building a swing trading system. This will be a fantastic discussion, diving deep into his process. And then at 11 a.m., we've got Roy and Wes Mattox discussing what they don't teach you in business school, which will be kind of a different perspective, but fantastic as well, discussing the most important concepts and also key lessons they've learned from their years of doing this. Then at 12:30, we've got Himanshu Sharma discussing how to identify multi-baggers, his process, both for the Indian markets, but also how we can extrapolate that to the U.S. markets. That should be fantastic as well. Then at 2 p.m., we've got Leif, Soreide, discussing lessons from trading off the recent bear market low, discussing a lot of his process of swing trading, and that will be excellent, going through many case studies. At 3:30 p.m., we've got Chris Flanders discussing progressive exposure in practice, and then to wrap things up at 5 p.m., we've got Brad Freeman discussing learning the story behind a stock, more of an investing perspective, but there'll be many lessons I'm sure that we can take away as position and even swing traders to help us understand and look for edges from a fundamental nature. So looking forward to all these presenters, and let us know in the chat who you are most looking forward to hearing from. All right. So again, a fantastic group of presenters today. Really looking forward to all of them. It's been a great conference so far. One ask that we do have from you guys, we work really hard to make this free. We put a lot of time and effort into it. Please help us spread this resource. If you've got any trader friends or just want to share it on Twitter or in a Discord you're in, please go and do that. You can share the link that's basically the URL of the stream right now, or you can scan this QR code and it will set up a tweet just like this that you can edit and then go ahead and post. Please go ahead and do that. Again, we work really hard to make this happen, and we'd appreciate you helping us reach as many traders as possible with this resource. With that said, I also want to give a huge thanks to Ninja Trader Live for helping make this conference possible, for sponsoring it. Ninja Trader, you can tune into them for daily futures trading, real-time market coverage, and actual strategies. This is the go-to place if you want to learn more about how to trade futures. They're live 6 days a week with top educators and traders. So you can visit the link that's in the description right now, and also scan the QR code to learn more. Again, definitely check them out if you're interested at all in trading futures. All right. I do want to mention all these sessions are recorded. I'm sure I'll get asked that a few times at least in the chat today. And if you see somebody ask it, just let them know kindly that yes, it's recorded. You can actually scroll back at any time on this live stream and rewatch any of the conference presentations, and you'll be able to access that in the future as well. But also, to get the most out of the event, what you really want to do is sign up for the free, 100% free VIP pass. You can use the QR code right here, or click the link in the description, as well as in the chat right now. And what this gives you, basically all the recordings of not just this year's, but past years as well, presentations all in one place, with the slides, with additional resources, notes that we create. So you don't want to miss this. Again, it's 100% free, so make sure you scan this or click the link in the description. Again, this gives you speaker notes, slide decks, all in one place, so you don't have to go searching for 2022 presentation, all that. Check this out and definitely make the most of it. And you'll also be basically free entry into many different giveaways of TraderLion Masterclasses and DFU. So again, don't want to miss this. And 100% free. So why not get the extra resources that we've created for you? All right. I also want to mention a book and resource that we're incredibly proud of that we just published a little over a month ago now. This is the Trader's Handbook. This is our debut full-length book. Basically, each chapter walks you step by step into in terms of building and refining a trading system. So if you're learning about setups, risk management, post analysis, all of that is covered in here. And we walk through step by step the higher order principles that I've learned from market wizards and all my interviews with them. And we've kind of synthesized all that work into this one book. So I highly recommend it. I'm very proud to say that we've got well over 400 reviews on Amazon, rated 4.9 stars. We've got over 13,000 readers already, received tremendous feedback. So definitely check it out if you haven't already. Here's a review from Mark Minervini, 2 times US investing champion. The Trader's Handbook is a comprehensive encyclopedia for investors interested in learning the ins and outs about technical analysis and stock trading in general. Packed with explanations, practical insights, and real-world examples. It also features a model book section showcasing historical stock market winners, highlighting their breakout points, key patterns, and notable price behavior. A great addition to any trader's library. So that's wonderful to hear from Mark. And go ahead and listen to Mark and pick up a copy if you haven't already. I believe it's actually 25% off right now. So you can go ahead and check out Amazon. And he mentioned the model book section. Basically, the very last chapter of the book is basically, over 200 annotated charts of big winners from the past 10 years. This includes Google. This includes a lot of the great winners from last year as well. Reddit, A-Lab, analyzing their trends, analyzing entry points, all of that. So that's an excellent addition to the book. And not only do you get the book when you go ahead and pick one up, but it is also basically your entry ticket to the free educational resource that comes with it, which includes 5 bonus model books, soon to be 6. I'm going to be doing one on IPOs and their amazing moves, inspired by CoreWeave and Circle recently, and that will be fantastic. But basically, in that educational resource, you get bonus webinars that go along with each chapter. You get additional bonus webinars on trading breakouts, pullbacks, and different setups, and a whole bunch of other educational articles and resources. So basically, if you pick up this book and send us your receipt, you'll get access to that whole suite of educational material, which can really help you improve your trading. So definitely pick this up if you haven't already. All right. I also want to mention that we have a ton of completely free TraderLion resources on our website. This goes from the Ultimate Trading Guide to free courses from Oliver Kell. We've got the TraderLion podcast archive there, educational articles, and much, much more. So to check this out, you want to visit TraderLion.com. And if you're ready to take a step deeper, we've got an amazing array of TraderLion masterclasses with top educators and traders. You can learn stage analysis from Stan Weinstein, swing trading from Oliver Kell, US investing champion. You'll hear from him in just a minute. Jared Tendler, teaching trading psychology. John Moik, guiding you through history and building the blueprint for trading success, and much, much more. So these are fantastic. We put our heart and soul into each one of these and make it a tremendous value for what you get. So highly recommend checking it out. And if you've taken any of our masterclasses, let us know in the chat right now which were your favorite and what did you think and what would you tell other traders about these resources. I also want to mention again, each year we do a great thing here and not only create this educational resource, but also help, raise money for a great cause, St. Jude Children's Research Hospital. We're a little over 50% of our goal. We want to blow that out today. So please go ahead. If you've enjoyed any of the presentations and found value in it, donate $1, donate $5, whatever you can, help us pay it forward. And if you found value in the conference, again, we keep this completely free, pay it forward and help us by donating to a great cause. We take no cut of the proceeds. YouTube takes no cuts of the proceeds. I think they actually pay the fees associated with it. So this is just a purely great thing. So if you've found value in the conference, make sure to donate at least $1, and that will do, great work towards meeting our goal and help a great cause as well. So again, even $1 is great. And the donation box should be just below the stream or to the right of it as well. And I think in the chat, you can also click the icon where it's like a heart. So that's the way that you donate. They make it pretty simple and easy. I also want to mention that in addition to the TraderLion conference each year, we also have the TraderLion podcast, webinars with market wizards, educational tutorials, the Trader's Handbook webinars going through each chapter. So we've got an amazing library of content and soon to be much, much more. So please go ahead, if you haven't already, to go subscribe to basically our channel. We put so much work into this channel to make it the best resource for traders out there. And we're shooting to reach 200,000 subscribers this year. So if you're not subscribed, again, it's 100% free. and it will basically let YouTube know you're interested in all the material that we have to offer and upcoming material that we have to offer. So definitely go ahead and subscribe if you haven't already, and stay tuned on the lookout for that. All right. And with that said, again, a huge welcome to everybody. Thank you so much for attending the 5th day of the TraderLion conference. This is going to be fantastic, starting with Oliver Kell. And I look forward to seeing you guys all there. And hopefully you guys have your notebooks ready, because I'm sure there's going to be a lot to jot down. So stay tuned, and we'll be right back with Oliver. Cheers. All right, welcome everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, Oliver Kell. He's the U.S. investing champion of 2020 and record holder. He's someone I've learned an immense amount of trading from, and really looking forward to today's presentation. We'll talk about kind of his overall system, going from the cycle of price action into executing a lot of his recent trades, using those as case studies. Oliver, thanks so much for joining us again, and looking forward to this. Thanks for having us.
Sure. Thanks, Richard. So this is basically, I'm just going to go over like the root of my strategy, kind of how I think about the market. And I think it can be like a baseline for anybody to learn to swing trade who, is more of a trend follower, moving average type trader, uh, to then, build other pieces around that fit their style. Um, so kind of the root of my, at least what I call it, is the cycle of price action. But it's just, an objective overlay to keep you on the correct side of the market. So basically I use the 10 and the 20 period moving average, and a green light environment for long trades is when you're above the moving averages, and a red light environment is when you're below the moving averages. You can short or just go to cash on that stock, and then you want to adjust your market exposure and aggressiveness just kind of based on where we are in the cycle, which I'll go more into that here. So basically, the red moving average for me is the 10 period exponential moving average. The blue is the 20 period exponential moving average. People use the simple period moving averages. From my perspective, it doesn't really matter much. I just, kind of randomly started using the EMA after using SMAs for a long time. And that's why I use it pretty much. But basically, the way things work for me is when a market bottoms out, not always, but typically there's some sort of capitulation of some sorts, where things really stretch down from the moving averages. I call that a reversal extension. And from the reversal extension, you get a snap back to the moving averages. Often you kind of pull back again. It might look like a bear flag that you might think is going to break again. But really, it's just this entire period here is a period of high volatility. And then right in this zone, after you touch the moving average, pull back, you're tightening up and you're decreasing volatility. And this is generally for me where you kind of get that, pivot to then get long the market or get long a stock. And essentially it's building a higher low here. So you're seeing a snapback off capitulation, a decline in volatility, tightening of the price structure, and then, building a higher low. And then when you push through that zone, I call that the wedge pop. Typically you are moving through the moving averages, but technically that's not like the buy area, which I think a lot of people misinterpret. It's breaking through the price structure that is
The swing high.
Yes, you want a tight area. You want, what I call a mini base, and that's really the key. Then from there, the first pullback into the moving averages, or really the next higher low, is what I call the EMA crossback. Essentially, you've crossed the EMAs and you're checking back into them, and that's another nice low risk area to get long the market or pick up a stock that's hopefully near the beginning of its move. These are my favorite areas to get involved in the market: the wedge pop and then the crossback. Then from there, if you move higher, you'll get what I call a basin break. It's just like a consolidation. It's nothing more than that. It's a consolidation back into the moving averages, usually in the range of maybe like 1 to 3 weeks. So this isn't like a full new base or anything like that. And then if you move up and in a really strong market, you might get like 2 basin breaks. Sometimes you only get 1. Sometimes in a really, really strong market, you get 3. And then from there, you typically get some sort of acceleration, euphoria, and you get what I call an exhaustion extension, which is essentially the opposite of a reversal extension. The reversal extension is created by fear. The exhaustion extension is created by greed and euphoria. People chasing the market, things are ripping, they want to be involved. And really, you bottom out when there's no one left to sell, and you top out when there's no one left to buy. So typically you'll get a hard flush back down into the moving averages. If you have a true exhaustion extension, and I'll go over here, you'll come back to the moving average. It'll kind of typically find some support. Some people will think it's just another, check back to the moving average, and it'll start to turn back up. But then you typically get a lower high, and you flush the moving averages and have more of what I call a wedge drop. So it can set, kind of like a base structure, like on the wedge pop, but sometimes it's a little shorter and then just kind of drops. I would recommend going back through, hundreds of charts and just see if you can see this for yourself. And then you get the cross back, the basin break, and you do it all over again. So the key is, in my opinion, is to marry up the weekly with the daily. So this is fractal. It'll work on the weekly, the daily, the 65-minute or the hourly, whatever time frame you want to trade. Naturally, lower time frames are going to have more whipsaws and false moves, higher time frames less so. For my strategy, we want to try to be involved in situations where the weekly is in an uptrend. So let's say right here you get a weekly wedge pop, this right here will be a daily upcycle. And then this might be, a daily correction, but it's all within a weekly upcycle. And then another daily upcycle and another daily upcycle. So this all here would be taking place inside of this move on the weekly. And then let's say you lose the daily moving averages right here. It's typically just like a check back into the 10 or 20 week, and then it resets again. So I kind of trade the daily time frame inside of the weekly cycle. And if you can pair both of those up, that's going to be your best chance for success, just because you've got time frame alignment. Does that make sense, Richard?
Yeah, I think that's really well explained. And I know extensions on the weekly, especially when they marry up with extensions on the daily, that's when you get more cautious and are watching for those wedge drops and potentially end of the trade, end of that upcycle.
Yeah, exactly. So like the further you get into the weekly trend, like if you're getting up here on the weekly and you're really extended from the 10 week, and then you also get extended from the 10 day on the daily time frame, you really want to maybe be ready to take profits.
Yeah.
Uh, yeah. Okay. So implementing the strategy, and I kind of just said this, but the higher time frame is the weekly or the monthly chart. So I do look at both. The weekly is definitely the one I more regularly use, but I check in on the monthly. Um, and it's what I try to ask myself when I'm looking at the weekly. How extended is my stock? Are we breaking out of a large multi-month base? That's obviously the best scenario. The old saying, the bigger in base, the higher in space. So we want to try to find stocks that are not extended on the weekly. Something that I started using more regularly is actually the 5 week moving average is pretty much the 20-day exponential moving average. And it's best if you can get long as close as possible to that. When you're playing that daily upcycle. Um, and then a 5 to 8 week pullback or consolidation into the 10 or 20 week EMA. These are the best scenarios. Obviously you can have, 1 to 2 weeks of chop within a daily upcycle, but typically once that daily breaks and you're coming back into the weekly moving averages, you're going to want a little bit more of a basing pattern just so the market can kind of reset, chop some people up, build a new foundation, and then it'll have a chance to follow through. And then for me, I typically do not trade stocks below the 20 week EMA. Um, you know, there's some exceptions, but I would say not many. If there are some exceptions, it's rare. So if something's living consistently below the 20 week EMA, there's just better stocks to trade. There's stronger stocks out there, and there's just really no reason to pay attention to things below the 20 week, in my opinion. Um, all right, then the trade management time frame. For me, that's the daily combined with the 65-minute chart. So I analyze and manage each trade around the daily bars and the moving averages. Like when I'm scanning at night, I'm mostly looking at the weekly and the daily. Um, and I'm looking to buy strength back through the daily 10-20 EMA. So kind of that wedge pop scenario. If I can find a mini base and buy back through those moving averages. And then I watch the price structure of higher highs and higher lows on the 65-minute time frame. So sometimes if I miss a perfect breakout, I can let it kind of pull back and look for that next higher low on the 65-minute time frame and get on board the trade. And then it just kind of helps me the more I've been doing it, emotionally understanding like, hey, this may look like a big pullback, but it's really just coming back into a higher low. And I think if you can frame the mindset that, markets typically don't top until they have a lower high and they don't bottom until they have a higher low, it can kind of help you ride the trend more easily. Obviously, there's exceptions to that. There's things like news, or if a market just gets totally extended, the bottom kind of fall out of it. But typically, that's a good rule to have to kind of allow you to stick with your names. And then you've got the execution kind of risk management time frame. You know, I say the 30-minute or the 10 or 15 minute um, is what I do is I take the daily moving averages for the 5, 10, and 20 EMA, so that the daily time period, and I will put it on a lower time frame chart. The reason I like to use the actual daily moving averages, even though I'm looking at the shorter time frame, is because like I'm a swing trader, right? So I am actually, managing my trade on the daily. So therefore I don't want to be buying based off, the, 30-minute, 10 period moving average, because it might work for that day, but then it has a natural pullback. and I get taken out of it because I was buying too extended from a daily moving average. So I try to do everything I'm doing based on the actual daily moving averages. Um, and so typically I will set alerts right around the daily 10 or 20 period exponential moving average. I'll try to buy pullbacks to those moving averages, in scenarios like the EMA crossback, or after a few weeks of basing. I might get started in a base and break off the moving averages and then add on follow through. Um, I will put alerts at the previous day's week's highs and lows, to look for something I call a break and recapture, where maybe it takes out that previous day, week's high or low, and it also lines up with the daily 10 or 20 period moving average, and then it can retake that. I think the key though is to not create any trades on the lower time frame. So if you sit and look at the 10 or 15, even 30-minute time period, you'll find trades during the day, and maybe they work that day, but if they're not really backed by a weekly or daily time frame, they're not really meant to be held overnight. Because you just don't want to look for trades on the lower time frames. You want to let the weekly and daily kind of drive what you're doing. So those are really the three time frames. And for me, more and more, I'm trying to get away from like the 10-minute, like I used to look at the 5-minute. I don't look at it at all anymore. And, I think one of the big misconceptions is you take less risk on the 5-minute, which like technically you do. But if you get stopped out like 5 times because your stop's too tight, like maybe you're better off just like trading on the 65-minute and letting it play out. But, to each their own. I think the key is, the weekly, the daily, and then whatever time frame you're comfortable with, to execute on. Okay, so the advantages is, it's reasonably objective. Like obviously there's some, with more experience, you see different things in charts via volume, things like that. But overall, you're either above or below the moving averages. It's that simple. And like I said, it's fractal. So, you can go look at the monthly, the weekly, the daily, the 65-minute, whatever time frame you're comfortable trading on, and you can implement this strategy. So, for example, let's say you're a little more shorter term. Maybe you like to use the daily, the 65-minute, and like the 10-minute, and you're not looking to hold back to the daily moving average. You're looking to use like the hourly moving averages or something like that. You can fit this kind of multi time frame price cycle approach to whatever time frame you're comfortable trading with. And then price is the number one indicator. So the cycle provides a framework to analyze price essentially. And then you're always buying strength. You're just adjusting your time frame to get there. So for example, if you have a pullback on the weekly, right? Things are correcting, multi-week pullback on the weekly. You're then looking to buy strength on the daily, once the daily time frame starts to bottom out. Or let's say you're looking to buy an EMA crossback and, on the daily time frame, something's pulling back to the moving averages. You're then going down and you're looking at your 65-minute and you're looking to buy strength on the 65-minute. So even when I'm buying a pullback, I'm looking to buy strength. I'm not just looking to like step in and get run over if it doesn't hold where I think it's going to hold. And then I think this is kind of an advantage. Some people think the 10 and the 20 period moving average are quote unquote faster moving averages, and therefore, they can't keep you in a big winner. So my personality is like, I'm not going to hold back to the 50 period moving average. I'm going to hold and then probably sell right into the 50, based on previous experiences. So I find that the best stocks typically hold the 10 or the 20 period moving average. And if a stock can't hold that moving average, I could probably find something better, that's going to move a little bit faster. I typically want to trade, not typically, I want to trade high beta stocks that move quickly. And if something is the type of name that, doesn't consistently hold the 10 or 20 period moving average, maybe it's just not the best type of stock for me to trade, and that's fine. And then you want to try to spot relative strength by buying stocks that are ahead of the indexes in the cycle. So not always, but for example, let's say the indexes have a reversal extension on the lows, and you can find stocks that are already above their moving averages and the volatility is already contracted and they're kind of ready to go. They'll probably move out in that time period where the indexes are between the reversal extension and the wedge pop. So the indexes could be real choppy and volatile there, which can make it a little bit tough. But those best names will often push out in that time period, or around the time period of the index wedge pop. So if you can find stocks that are already set up, haven't pulled back and corrected as much as the market during the correction, they're already making higher lows as the index is kind of capitulating out. Those are the types of names that you want to be involved in, because they should outperform once the market turns. And then this is a key thing that I think as you get more experience trading, you develop more patience. But because the cycle gives you multiple opportunities to get long stocks, there's no excuse to ever chase. If you miss the wedge pop, you can wait for the cross back. There's just so many opportunities out there. And I think the more you kind of embrace that, the better off you're going to be. Because the key is, to get involved at a good price, so that when you get stopped out, you're stopped out because you're wrong. It's not just some random, 5-minute chart that looked good one afternoon. So disadvantages, there's whipsaw potential in that we're using faster moving averages. I personally like to trade stocks that are going to hold the 10 or 20 period moving average. And if they're not, I would rather find a different stock. So sure, there is whipsaw potential, but I just think that the best stocks are high beta stocks that typically hold the 10, 20 period moving average for my strategy. And trend following in nature. So in a range bound market, you've got potential for false signals, or you might have a bunch of small winners or situations where you get up, 5, 6, 7%, and then you end up, taking a scratch trade or like a 1 or 2% winner. And maybe you just don't make too much progress. But that's just kind of the part of the process until you get that next major trend. And then discretionary execution. So this can be viewed as a major advantage. I think kind of once you put in the work, it does certainly leave the door open for emotional mistakes, or obviously if you have incorrect analysis. Kind of the way that I kind of think about it is, my system creates, a 90% mechanical overlay, to my discretionary input. So, I'm picking the stocks I'm trading. I am, assessing the areas to get in and out, etc. But a lot of the time, kind of once my trade is on, the system is in ways kind of managing it. And more, the longer I've run the system, I just don't really get that emotional with it anymore. Just because I've gone through the best winners bar by bar, and I've kind of seen they'll ride these moving averages during their runs. And I just kind of embrace that, and it allows me to kind of stay with stocks. I would say for me, sometimes I'll sell an extension that maybe isn't an extension, but usually I'm good enough where it might pull back for a day or two, and I realize my mistake, and I can just get back on board. But yeah, I guess discretionary execution could be viewed as a disadvantage. Okay, so trend price structure. So like in the past, I think people have been so focused on the moving averages when it comes to my strategy. They think a stock just like crosses the moving average, it's a buy or whatnot. But it's what gets overlooked is the price structure, which is actually what's important. So if you look at this kind of model, so let's just say over here on the left, the bottom left, we had a reversal extension. We had a sell off, and we came back up, and we built a higher low, and then we contracted. Right? There's no moving averages here or anything. It's just like volatility contraction, and then we take out this pivot, and we have an up move. So we have an expansion higher. An expansion higher meaning we really make a statement move up, right? And then we pull back or we contract, meaning that the pullback is smaller than the expansion, right? That's basically, in my eyes, what trend is it's expansion followed by tight trade and contraction, and you trend up, and then at some point you expand a little too far. And that doesn't mean the market's going to sell off, but it means, okay, rather than just a pullback, we may need a little bit more of a consolidation, maybe a multi-week consolidation. That is essentially like your basin break. It's like, hey, we've had a good move. We're still strong. We still want to go higher, but, we need a timeout. We need a water break, right? And then once we kind of, refuel, then we're gonna start the expansion phase again and get going. And that's basically what price structure is. So like here would be like your wedge pop. This would be your cross back, and you're moving. Then you tighten up. You need a little more chop. This is your basin break. And then at some point you go up and you pull back. And at this point it just looks like the rest of this. But then you make a lower high. And maybe this so far is just a pullback to a moving average. But at some point you start to really break trend, right? And so to me, that would be right here. And then you kind of tighten and you really confirm and follow through down. And so basically we've had higher highs and higher lows. Now we have lower highs. It's kind of like, oh, maybe I want to be aware in case something happens. Oh, maybe it puts a higher low in here and goes higher, no problem. But in this case, it goes lower. And now the trends move back lower, and that's fine. You just need to assess that. Here's probably your wedge pop, blah, 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 lower highs, lower lows. And then at some point, we get that higher low again. We start to contract. And then when we kind of get through here, it's like, here's the wedge pop again, the cross back, and the cycle plays out again. So it's really important to pay attention to the actual trend, higher highs and higher lows. But the real key is, the tightness. You want to find those mini bases, those tight areas. One, because like everybody says, that's how you manage risk, and it is. But it's also to get a real expansion in a stock, it's typically going to come out of a contraction. Even if you're just talking a 65-minute chart where it's like a huge morning expansion, and then it consolidates in the afternoon, consolidates the next day for like a day and a half, and then maybe it's ready to move again. You'll see that same thing on all time frames. So you want to find tight areas. Like that's really the key in my eyes. Any questions on that?
No, I think that was really clear. I just really like what you said earlier when you were talking about this is stocks don't really bottom until there's a higher low, and they don't really top until there's a lower high. I think that's a really simple way to put it. But I think this is a really good diagram to explain it, explain the cycle, and you'll be able to study this if you go back and study bases. I think NVIDIA is really good at studying the cycle, Tesla as well, and just the cues recently. You can study this recent correction, see the reversal extension down,
Yep.
the higher low that forms, all of that. It happens in all markets and all time frames. It's going to be a little bit different and rhyme a little bit different each time, but it's a great framework to interpret and know when you want to get involved in a trend and be in the right general area on that first wedge pop or the first EMA crossback.
So some basic notes, like trade the strongest stocks in the in-play themes. Like if you're trading weak stocks, you're going to have a harder time than if you're trading the leading names, the strongest stocks that are liquid. Like I like liquid stocks. I think they hold their structure better. And then the in-play themes. So like right now, I think crypto is like a pretty in-play theme. Like if you're trading crypto, you're probably going to have a little bit more luck or, success than if you're trading, oil stocks that have been like pretty choppy and a little bit out of favor. Um, so relative strength and the proper groups will make it all easier. And then embrace that concept of expansion and contraction. If something really expands, like it's gonna have to chop around a little to refuel for the next move. So if you want to be a swing trader, at least on my time frame, you do have to be willing to kind of let stocks rest. Stocks go up and they rest, and then they go up again, and then sometimes they get too overheated, and that might be the end of the move. But you got to embrace that expansion and contraction concept. And then sometimes it takes a few times to get a trade right. I'll show you near the end here one of my biggest trades ever. I think I got, stopped out for, I think like 2 scratches twice before I was able to get it right. And then this is a basic system to wrap your own tips and tricks around. So I learned a lot from a lot of different people, and, I took what worked for me. I trialed and errored with a bunch of different things, and I kept what worked for me and I got rid of what didn't. And I would suggest that you do the same, and then fit this strategy to your personality. So I know people who kind of have adopted this approach to the market, and maybe they like to just take their profits and kind of reset rather than hold through the pullbacks, and that's totally fine. Maybe you hold for the entire trend. This kind of same system can be implemented in many different ways, because it's basically just a root trading system, that many people have used for a long time. So make it your own. Okay, so here's a couple trades. I'm actually still in this. So this was a situation where we had a wedge pop over here on the left, and then it kind of chopped around into the crossback. It had earnings, and then I had actually been long it on this wedge pop, and I actually I want to say this was the earnings day, and I actually sold it, which proved to be a mistake. But then I got back long it in here and in here and in here and here. I bought it like 4 straight days in a row. And I've just been, riding this stock this whole way. So, got long in here and it's just moved up. In hindsight, I wish I had added more in here. I didn't. And then I actually, right in here, I made the mistake. I thought this was an extension, and I sold into it. And then, the next day I wasn't working and it went up. And when I was doing my work, I was like, oh, I really blew this trade, because this was my favorite position. And then they didn't get in the S&P 500 and it pulled back, and I was able to pick it back up, literally lower. It bailed me out of my mistake. And I've just been holding this whole time. I thought in this zone we may be potentially putting in an extension. We had all this volume, but it was able to just kind of consolidate and continue to trend higher. So at this point, because this trend started in late April, so this trend has been going on for, about 2.5, 3 months. And you can see how we've consistently held the 10-period moving average this whole time. The book, Trade Like an O'Neill Disciple, he's got a rule where, once it holds the 10-day for like 8 weeks, that becomes the moving average you're going to use to sell. So I don't adopt their rule entirely. Typically, when a moving average holds 3 or 4 times, so you can see 1, 2, and then kind of right here is 3, then I'll say, okay, which moving average should it set up into, the 10-day or the 20-day? And I'll use that. So I've been using the 20 days default the majority of this run, and only recently am I switching to the 10-day. And that's how I'm going to manage my exit on this. Either an obvious kind of blow off, or if it breaks the 10-day. So this is just like a closer look at the entry. So I was already long. I got out like literally like right here on earnings. Not the best. And then I started getting back long. I started getting back long on this break and recapture. I added a little. You can see this little spot here. I added. And so this just gives you a sense of like this base that's built here on the 65-minute time frame. These are all my daily moving averages. So this red is the 10-day, this is the 20-day, and it's allowing me to kind of set my position into the moving averages. And you could say like, oh, why'd you sell on the earnings day? It was above the 10-day. And I mean, you would be right. It's because I made a mistake. But overall, I'm looking to build positions in bases like this into these moving averages. And the nice thing about a situation like this is I was able to get long some here, then it had this flag, so I got long some more here and then more there. If I can buy 3 or 4 times in the base, it allows me to get a bigger position, where if I'm buying here and then here, I'm raising my stop to here. If I'm adding here, I'm probably raising my stop to up here. And then this is probably just to kind of top it off. I'm probably raising my stop up to like here. That's how I'm able to get a bigger position. So I actually prefer when stocks they make progress, but they take kind of 2 or 3 days to get going, which is also why I prefer to get started in by the moving average versus just buy this breakout up here, because that allows me to, build a bigger position, which is important for me. And then this just shows the 65-minute for the whole trend. So, you can kind of see that base there. And so talking about expansion, expansion, tight contraction, right? And even though this is a gap up, this is expansion, tight contraction, expansion. Okay, it needs to pull back a little. And the way that I don't worry about these types of moves is I view the 10 and the 20 period moving average as kind of my filters for my higher highs and higher lows. So incorrectly would be to say like, hey, it went up and it based. This is the higher low. Went up and it based. This is the higher low. This is the higher low. Oh, I get stopped out. For me, it's like, this is all just an up move, and we haven't even determined the higher low because, we're too far from the 10-day. Even this here is debatable to be a higher low. Now up here, when you kind of build this more of a shelf, you come back into the 10-day, this could be an area to get long, right? And we break out of this little descending channel on the 10-day. Now to me, this is like a new higher low, right? And so this is your contraction, you expand again, and then, you contract again, and you expand, tight trade, expand, and then we need to kind of reset again. So that's just the concept of expansion and contraction. It's really just trend, and you want to trade in the directions of the expansions. Once you start to see the down moves bigger than the up moves, it's probably a sign that the trend is starting to change. Okay. So another name that I am currently long, I got long Uber. Uber's a name that I have been long and not made any money in. Coin. So I can't remember this news. I tried getting long this in here and it just never really got going. But then right here, it kind of made a statement. At the time, this is more volume. If you look at how light the volume had been, and I initially put a little on into this back test of the 20 EMA, just very small, and then I can't remember why this thing ripped, but it did, and I was ready for it through. I think it was through 260, and loaded up on it, and we just had this massive expansion. And I really liked the quarterly, or still do, on this thing. So I was just, it got really, really extended. And I'd done this in coin a couple times the last year and a half, where I was just committed to holding it back to the moving averages. On this day, I actually thought I made a mistake. I was like, oh, crap. But, I stuck with it. And I almost feel like I got lucky here. It just kind of came back. And, it's just kind of riding the 10-day moving average up. And, we'll see how far it goes. But that's the trade, right? So you've got this huge volume, these bull snorts that kind of alert it to you, then it consolidates down into the 20-day. it sets up this pivot here. And when it goes, you get long and you ride the moving averages. And, that's all I'm doing right now. And so you can kind of see on the 65-minute here. This might have been an area you tried and it just kind of didn't work, or, you might have stayed with it because it didn't really lose that support area. But for me, kind of when it's just lollygagging around in here, I might get out and just reset on something, if I took it here, just because. But then here it had, wedge pop back through the moving average. It came down and set on the 20-day here. And then this is a pretty clear base that was built through all this consolidation, and this, 260, 261-ish area was the buy area. And then, you see the huge up move, then you see the tightening, huge up move, and then it kind of needs to pull back more. But our filters, our 10-day, just kind of keeps you going, and we'll see when it ends. I don't know, but that's just like an example of how I use the daily and in the 65. I'm pretty much mostly looking at those two time frames during the day. This is another trade I'm currently in right now. This is SMR, so I did really, really well in SMR and Oklo on the previous push up. And so I got long a little SMR in here that I got stopped out of. And then I started paying attention to it more. I was watching this 3750 level here, and kind of when it reversed, I got out of it because I wasn't sure if it was going to keep going lower. But it undercut here. It made a higher low here, and I started watching it again. And I got long here and here, and I also got long Oklo. And then I added a little more, or actually a good amount more, through this high when it followed through. And then today it got a little extended. So I think this is an area you could have taken some off. I actually just stuck with mine, but I'm expecting it to kind of chop around, maybe even wash out a little, who knows. But you can see this contraction in the volatility here, and it's coming down in the 20-day. It's real wide and loose, and then it really, really tightens up here. And I don't know why I have all these arrows here, I'm sorry, but it basically moved up here, pulled back, and then did what I call reconfirmed, and then it followed through again. And the way I kind of think about this here is it's pretty extended, clearly, and I mean this is to me a short-term exhaustion, but I view it as having consolidated that pretty well. So my mindset is like, hey, if this just keeps going, if this just keeps going higher tomorrow, great. But I would be going into tomorrow expecting it to maybe pull back, consolidate, because we're so far from the 10-day or the 20-day. So I'm willing to just kind of let it chop around. I have no expectation here. Whereas what I was saying, someone else with more of a lower time frame, not a lower time frame, just their strategy might be to sell those extensions. They might have checked out of this thing into this rip, and they'll be just the way that I'm willing to just kind of hold, let them move it out. They might just be waiting to get back on board it, like over here, and that's fine too. And then lastly, I wanted to show without any moving average. This is a trade I took in coin. I want to say maybe the end of 2024 or beginning of, maybe it was the end of 2023, actually, beginning of 2024. You can just see. So this is coin. This orange moving average is just like the 200-day for this time frame. It's irrelevant. So don't pay attention to it. But essentially, we have a structural break right here, right? We come up and we hold again. And then what do? We move higher. and we build another little base here, and we break out of it, and we contract, and we move up. And like I have these higher lows drawn all here, but it's basically, we move up, here's the higher low. We move up again, here's another higher low, new basing pattern. We expand, contract again. And then essentially, once we break this pattern of higher lows, if you could see the daily here, this was getting pretty extended from the 10-day. So I had already like taken a little bit off. And then I obviously gave back some off the top here for sure. But then was stopped out. And then what do we see? It came up and it rejected it here. And what happened? Here's a big expansion down, contraction, expansion down, contraction, expansion down. So the stock changed a little bit. And I can't remember what happened here after this, but I don't know if it went back up or not. I think it consolidated for a while. But it just goes to show you don't necessarily need the moving averages as long as you understand like basing, tight areas and, can properly assess the higher lows. I like the 10 or the 20-day because it's a reference guide. Kind of how I called it that filter. It's like if something's pretty far from the 10-day, like I'm not going to count that high or low because I'm very likely to just get shaken out of it on like a natural consolidation back into the 10-day, right? And so that I just wanted to show that. So, focus on the price structure. Like I feel like from previous talks, everybody's so focused on the moving averages when you don't have tight trade. You just don't have much. Um, and then this was an example. This was one of my biggest trades ever. But really, it was a lot of kind of just my example where here, I'll just go through this. So we had a higher low here. So this green line's the 50-day. Here's my 10, 20-day. And we were kind of tightening this base. I got long in here. It went up, it contracted, it kind of back tested this breakout. I added a little more and it went up. And then I got stopped out in this zone. And I basically like didn't really make any money, maybe made a little. And then I was ready to get going again. I probably would have bought through here and it kind of washed out the next day. And so this was definitely what I was ready for and it just didn't happen. So, do you kind of like leave the stock? No, like, you kind of always pay attention to your best names. Your Nvidias, your Teslas, lately your Palantir, your Hood, etc. You just kind of always keep them on your radar because then what ended up happening is this thing tightened up again and I was able to get long on this break back through here. I was able to add in here and then I was able to like load the boat on this move, add. And like this thing ended up doubling in like 2 or 3 months or something. But oftentimes, that's how kind of trading is for me is I get going, I'm pumped. Like when it's Nvidia, I'm like, okay, this thing's about to hold here and just like keep trending higher. And then you get stopped out. And then you're like, all right, man, that sucked. Like I'm back to square one again. Here we go. And then you find your next spot and you just kind of like never know when the trade's going to work. You never know how well it's going to work. You just try to put yourself in position to, be successful. And that's really it. Like I think it's important people realize like most of your trades are going to be losers, probably like 60 to 70% of them. But you just got to, keep trying to find good spots where your risk is tight, where maybe you have a small winner, like this first one, small winner, I kind of consider it a scratch. Some of them are going to be losers, obviously, for sure, where so hopefully not too big, but it's going to happen. And then you get the trade that kind of pays for all the scratches, all the frustration, gets taken care of in one trade. So that's pretty much it. Richard, I don't know if you have any questions.
Yeah.
Yeah, first of all, thank you so much for running through all that. It's worth pointing out as well, this is the textbook NVIDIA base that everybody should go and study. And also, before the latest entry in your trades, Oliver, it was also showing RS to the market, right? It was forming higher lows as the market was forming lower lows, I believe, during that
Yeah,
period,
I believe. And also like the key with this was the same as that hood trade. I was able to buy this like one, two,
multiple times. Yeah.
three times. And then on this day, this was also a breakout of a huge weekly base. And
Yep.
the volume, like literally the first 5 minutes, it was on. And you kind of just have to know when to go for it in those situations. But so yeah, it's just another example. Like I like to buy, down in these areas because then maybe I get two or three chances to get more size on where I can raise my stop. Um, that's like a key for me personally.
Yeah. And I know NVIDIA is super liquid. You like to go a little bit bigger in those ones. How much are you kind of putting on of your account or of the final position that you want at each of those spots when they develop as it approaches, the weekly pivot that kind of signals natural breakout?
Sure. So like typically, so like I kind of position size what I call, like my top names that are like very liquid and typically like the biggest I will go is like 30 to 35%. And then kind of like my, liquid core, but it's just not like a top two or three name for me is like a 15 to 20%. And then if I'm trading stuff that's like a little more volatile, something like that SMR, for example, that I showed earlier, typically those like if it's a cheaper stock, the max I'll usually go is like 7%. And then if it's kind of like a volatile name that is more high priced, I might go like 12%. Um, but I put a lot of my money in my top two or three ideas. Like I like trading stuff like Nvidia, Palantir, Hood, that is like really, really liquid. I find it holds its price structure better, but that is also, high beta. So like for example, when I first started trading, traded a lot of Apple, Baidu, Amazon, they were the high flyers and now I rarely trade them at all. And eventually, Nvidia, it's already getting like that. Eventually, Nvidia will be a boring stock. Like it just will. It's like just kind of how it goes, and there will be other stuff to trade. Um, yeah.
Yeah. And then could you go back to the hood one from the very beginning, that chart here? Because I think it'd be good to point out for people maybe, what you classify as the EMA cross bag versus the base and break on that daily chart. It was one of the first ones that you showed. Sorry to make
Yeah.
you go all the way back
No, no
there.
worries.
Yeah.
See.
So yeah, this
Okay.
one. Yeah.
So I wish I had the whole chart on here, but I think technically like in here was the wedge pop, this kind of gap up here. Um, and then this was setting into the moving averages here. So this little mini base was technically a crossback. This was also affected in that, maybe this would have gone here, but then it had earnings. So it's kind of waiting for earnings, in my opinion. And then kind of once it had that out of the way, it did what I think it would have just done right here if it didn't have earnings.
And so point out the base and breaks maybe for folks as well. Yeah.
Yeah, okay. So this is the crossback. Then we go up and this is like a basin break or I would consider it a basin break because it's a little over a week. But this is more of a kind of true basin break. Uh, but really they're the same thing. Basin break is just like a 1 to 3 week kind of consolidation back into the moving averages, and we move up and then we chop again and we
Expand
move up
higher.
and
Yeah.
here's another one. So like from my perspective on Hood, this has happened essentially. We've had one, two, three. We've had like four little mini bases, which is a lot. I would love it, like absolutely love it, if this thing accelerated here, because I think I would have a lot of confidence selling into that if it happened. And I'm going to do better if I can sell into a blow off than if I get stopped out losing a moving average. I sort of thought that was happening here, and I think if it had gone another day or two, I would have sold into it, but then it kind of just chopped around. So that's another thing. Like you don't want the market or the stock to get like too far ahead of itself, right? It's good when stocks consolidate. Um, and like it can be tough to hold through these consolidations, but like another name, like fortunately Hood has doubled, right? But another name that I was in for most of this run that I got stopped out of like a week ago was Crowd, and I was in it this whole time, and it had like these consolidations, and I sat through it all, and in the end, it only really moved like 20 to 25%, which is, I mean, solid gain, but, I'd rather be in like the hood, right? So sometimes it can stink to sit in these consolidations because you never know, like, oh, is this gonna be the end, or okay, no, we just got another, big expansion where we moved another 25% in like 5 days. Um, so yeah, I don't know what I was saying there really, but
No, that's exactly what I was looking for. And then stock selection obviously is critical, especially with the themes. And like you said recently, the one that's really caught fire has been the crypto. There was kind of a period where it was kind of pausing, and then with coin and IBIT and Bitcoin itself pushing
yeah.
recently, that's been ignited. What do you do to stay on top of what themes are working, and know when to focus on a theme? What signs you're looking for that money's flowing in as stuff is setting up so you're ready to execute when that theme really takes fire?
Sure. So, I mean, one is like the charts in some ways are going to lead you to the themes. What has nice bases. And then I do, maybe use a little bit of what I consider to be common sense. So really is what part of the reason I was so into Hood actually wasn't crypto at all. I know of an older gentleman who I haven't talked to him in a long time, but I consider him to be one of the better traders I've ever known. He does a lot of archaic stuff with options, spreads, all types of stuff. And my buddy told me that this guy was moving a bunch of his money to Hood, and I said, oh, like some of it is more like long term stuff, DCA, because I've actually never used Hood. And he was like, no, he loves trading options on there. And so in my head, I was like, oh, I thought this was like a straight up retail app, like my brothers are on it and stuff. And then, I hear this guy who is very sophisticated, really loves it. And it was kind of like, whoa. And then all this crypto stuff started happening where they added all the crypto money or whatever they're doing at Hood. Um, but for me, really, like by the time all that started happening, kind of the trend was underway, and I was just kind of managing my trade, and it was just like a positive for me. But like, crypto's been a pretty clear theme in that just like the Bitcoin, the base that it's had has been a clean, nice base. It kind of moved up and then it built like a nice handle, and obviously it's pushed out of it. So I feel like that's kind of an obvious one. Um, Obviously like the main driving theme of the whole market really is AI. I mean, there's themes within themes with AI. Um, and at the beginning of it, I think Nvidia is kind of the infrastructure piece to AI, and then you have you know essentially the computers are Amazon, Google, Oracle, like they've got the huge data centers and stuff. Those are essentially huge computers that they're plugging the Nvidia infrastructure into. So it was like Nvidia to me was like a no brainer. And then kind of step two to me of the AI play was like the applicators, like who's going to take this data and scrub it, which for me was a no brainer, like Palantir. And then like I kind of thought there was potential for Snow to do well, like Snow Databricks. But Snow to me is just such a crappy stock that I never really like. I haven't traded it this whole run, and I guess it's done well, but it obviously hasn't done as well as Palantir. Um, but so now, like kind of what's the next step? And I was actually talking to this guy today, who lives in Silicon Valley, and I think like, cost compression, people spend so much money scrubbing their data with things like Snowflake and Databricks, how can they cut down that cost? And I think that's maybe an area to look at. And I had not thought about that until I talked to him today. But cybersecurity, like to me, has been a multi-year theme. Like everything's moving online and you got to protect your stuff. Um, Robots and things like that are obviously a theme, and I sort of think there's like to me at least, and keep in mind, I haven't made that any money in these stocks personally I'm not fully into them, but like something like quantum to me, I'm not so sure that it's a real thing based on my reading, but it's been an in-theme play that has paid fat huge for people. And basically, if you just paid attention to that group, saw when those bases set up, that theme was then in play. It's like probably in play again right now. And it's been driven kind of by the charts. Um, but, so it's basically for me, like the core themes are AI. Okay, what's within AI? Like I kind of just went through, like you got your infrastructure, you got your data, and then
Energy too. Yeah, with
energy,
Gav. Yeah.
the power play for sure. And then for me, even within power, you had like your big traditional power, the kegs, the VSTs, and whatever. And then to me, the little more bit of a specky, but something that I really believe in is these small modular reactors. I think that's like the major growth play, which is why I've been paying attention to Oklo and SMR. Um, and then you've got crypto. And then you've got like your sector themes. Like I think like if you look tonight, maybe we're seeing a little bit of money rotating to retail and stuff like that. Um, to me, you want to try to find like that game changing company in retail or the game changing company like in medical devices versus like the whole theme. There's usually like a company with a killer product that, there's a reason why that one does so much better than the other ones. Um, so it's kind of like theme, and then you want to focus on the specific company. Um,
Yeah. And then I know big moves on big volume that will
yeah,
catch your eye, and that helps point to what the themes are working and where the money's going.
yeah. I mean, like huge volume is going to tell you where the money's going, and if you see enormous volume in a lot of stocks that are kind of playing in the same space, that should kind of
Big clue.
pay attention to that, I guess.
Yeah.
And then major themes, they typically they last more than like 2 to 3 months. Obviously, sometimes these institutions take 6 to 12 months to buy their positions, and they're looking to hold them for 5 to 10 years. So typically, if you can find the core themes, you can ride them over and over until they're played out. Um, so, you don't really have to reinvent the wheel like every 2 or 3 months.
Yeah, perfect. Oliver, this has been fantastic. I think this is a great overview of your process and a great starting point for people to build their own foundations. Any last words of advice for traders starting out, or advice, specifically about, incorporating your cycle into a system, or how you trade personally?
um, I would just say, yeah, you have to like take, you could take this system and adjust it. Maybe you like to hold stuff for like 5 or 6 days. Like, great, buy it at 48 and sell it at 60, and then buy it again at 65 and sell it at 80 or whatever. So, do what works best for you from a time frame perspective. And then I just think, it takes time to like catch a real trend. So it's like, you kind of have to be patient. One, on your entries for the right spots, and then two, to let the trades play out. You're never really going to have a big winner if you can't be patient.
Yeah, I think that's a good golden nugget to end it with. So Oliver, thanks again for your time. To everyone watching, hope you guys enjoyed as well. Leave a like down below if you did. And Oliver, where would you point people to if they want to learn more about your process or you know how you like to trade?
Let's see. I think I have it here. So kelltrading.com, I have like a book that it basically just outlines what I went over. And then we have a newsletter at theswingreport.com. And then we have the Swing Trading Masterclass. Richard, you would know that website better than I
Yeah. TraderLion.com/university. You can find it. And that's so in depth. So I learned so much going through that. So perfect. I think we'll leave it there. Again, thank you so much, Oliver, for all the thoughts and all that. To everybody watching, again, hopefully you enjoyed, and we'll be right back with the next presenter. Stay tuned. All right, welcome back, everybody. It's my pleasure to introduce the next two speakers of the TraderLion Conference. We have Roy and Wes Mattox. They're both market strategists, and Wes is the chief technical strategist over at IFS Invest. And today they'll be discussing a really great presentation that I think approaches things from a different perspective, what they don't teach you in business school. So first of all, Roy, thank you so much for being here. Wes as well. And I also wanted to mention that you guys were top performers in the U.S. Investing Championship, the Money Manager division a few years ago. So it's great to have your perspectives here at the conference. So welcome and thanks for your time.
Richard, it's a pleasure to join you this afternoon. And we think, again, this is the fifth time that we're presenting in the conference, and we're delighted to be included in that. It's such a great assembly of participants. We listened to all the speakers, and during all years, and we think it's really the best educational experience that you can find on the web. So thank you for providing that for the hordes of people that follow you online, Richard. So again, thank you. And we thought that we would take a little different approach. Many times in the past, we've talked about the technical aspects of getting in the weeds, and talking about chart patterns, and talking about breakouts, and talking about screening stops and things like that. We're just going to provide some common sense information we think that your viewers will enjoy. So with that, let me turn it over to Wes, and then I'll take you up after Wes finishes his presentation. Let me tell you that Wes provides an interesting perspective because he does have a CFA. He did spend 7 years on Wall Street. He's also got his CMT license as well. So he's very well suited and equipped to address this very subject. So with that, I'll turn it over to Wes.
All right, great. Thank you. And yeah, I'll go move forward through this. And just a quick disclaimer, of course, we're not giving financial advice. You guys should consult a financial advisor if you'd like specific advice. The good news is, we're not going over a whole lot of specific charts and stock recommendations. So it's not going to happen here. But again, it's just for informational purposes, and we hope you can learn something from this. But a brief, I guess, background on us in case you guys aren't familiar with us at all. We're partners and portfolio managers at Integrated Financial Strategies, like Richard mentioned. Roy, he's been doing this for many decades, and has been a trader for since 1987, I believe. I joined Roy, my father, at Integrated Financial Strategies in 2022 after spending maybe 7 or so years on Wall Street as an equity research analyst. So I had some exposure to a lot of different sectors there. And I know it's something that a lot of people talk about in passing is the equity research, the analysts and the buy ratings and the price targets and things like that. But hopefully I can give you some insight, into what that looks like, and maybe confirm some things that are people already suspect with anecdotal experience, but also maybe you guys can learn a little bit about what to take of value and what to just be aware of, I guess, from that analyst perspective. And just briefly, I'll talk about, I'll plug our little meetup. We host a meetup the second Tuesday of every month. It's open to anyone. It's a few hours, and we talk a lot about the market and conditions in general, and we'll go through individual stocks. We'll talk about what we own currently, what's on our buy list, and just how we're thinking about things. We find a lot of people get some value out of that. So we're happy just to share, once a month, just our thoughts with the public. So yeah, I wanted to go through it. It's maybe 10 slides or so with some kind of high level takeaways, and I'll share some experience that I have, because that's so far that's been the majority of my career, was as an equity analyst in New York City. There's a lot of, I think, valuable information that you can get from these equity research reports, and it's important to understand the structure of the industry, I think, and the incentives at work to always take opinions with a grain of salt and always be critical of what you're reading. And whenever I tell people from a high level, I know a lot of people here are at least familiar with this, but I always tell them, the guys on TV that have a price target on Apple, that's the industry I was in, and I was working on creating those price targets and all those earnings estimates for people. So I'm going to go through a few things that I learned over the course of 7 years, and what I can use to, that I think I use to apply in my decision making as a trader today. So one of the first things I'll emphasize is you don't have the resources that these big funds do. The research firms, there's tons of them, right? There's maybe 100 research firms, and there's maybe 20 good ones. People like Wolf Research, where I was, Evercore ISI, JP Morgan, Morgan Stanley, Goldman Sachs, Bank of America. All of these have these research departments where they have experts and lead analysts in specialized sectors. So you have maybe 5 guys that are all working in one sector nonstop all day, every day, thinking about 10 stocks. They live, breathe, and sleep 10 stocks, right? And so that's just the point is, that's what you're up against. You're up against these research firms, but also, you're up against the hedge funds who have their own analysts in-house as well. So the hedge fund analysts have their own, research they're doing, and they also have these 10 other top research funds that they can get, different reports and different estimates and different opinions from. So, it's at that rate, it's 50 people that are all, live, breathing, sleeping the same 10 stocks. And, that's just the idea of the intensity of what's going on behind the scenes for those, portfolio managers that are maybe running billions of dollars at hedge funds. And just to give you, I guess, a sense of the scale, from my experience, I was in transportation as an equity research analyst. I was really one of these trucking analysts. So I had like 8 stocks that I had to know inside and out. And we had these 4 lower level analysts who all feed information up to the lead analyst. And that lead analyst I worked for, he had to know all 30 stocks that we maybe covered. And he's been doing that for 20 years. And he's only been focused on 30 stocks for 20 years. So, you think about the value there, that's the value proposition is somebody that, has fostered relationships for, with CEOs for many years and seen many cycles, up and down cycles, in this cyclical sector. And so with that, we've got very, very extensive models that are hundreds of lines long and 25 years of history. And we're doing all these different things. We're updating models at least every 12 weeks, maybe every 6. We're having calls with the CEOs and CFOs. Every quarter when we have those earnings releases, we're updating those estimates within hours. We're talking to the CEO and CFO after the earnings call that we listen to, and trying to get the best estimates we possibly can. There's tons of weekly data that we're all feeding together to create these supply and demand models for the entire industry. We've got weekly channel checks. So we're talking to people that work at Target, Home Depot, Walmart, whatever it might be, the biggest shippers in the world that are moving goods around. We're scheduling calls with them every week. And we're having this this interesting network effect too, where we can survey all these buy side clients and get the real buy side expectations, which I think is, valuable things. But I guess the point is, this is the kind of the organization of what happens with every team. And the fact is we don't have that, most of us here, right? A lot of the TraderLion population is retail. But anyways, even though we don't have these, I do want to say, I'll get to this later, the point being where, there's obviously plenty of opportunities, and we'll talk about where retail is really, is beginning to shine. They often do shine in a lot of these, in some of these stocks that end up being true market leaders. But here's just kind of that overview. Again, what you're up against in that, and this is, it's a behemoth, industry. There's a lot of people that are all trying to figure out, get an edge in the market. Something I learned, and maybe this is a bit provocative, but I wanted to, point out CEOs do lie. Even if maybe they can code it in a way that's not a full-on lie, they often just the point is they say what they have to say. I'll tell you, when I was, I think, 23 years old, I remember this point really early on where we got off the phone call, me and the lead analyst. We were talking to a company CEO, and the analyst, after that call, he comes on the line, he calls me back and says, "Man, that guy was full of it." And I remember as a 23-year-old thinking, that never crossed my mind, right? I guess I was still naive at that point in time. Just to obviously take anything that anyone said at face value. But then when I thought about it and realized it, that it was an eye-opening moment that, that CEOs have to basically, they're constantly just pitching their companies is what they do. So, that was a very interesting experience, and I guess changed my naive, and I became a bit more cynical that day. A few more instances where I saw this happen. Norfolk Southern was another instance in the railroad companies where there was a derailment and there was a lot of concern about the fallout of everything, and they're just trying to, I guess, manage expectations and downplay the overall impact of this big derailment and this chemical spill and everything. Where I'm seeing that same thing. And Carnival Cruise was another company we covered back several years ago too, and a couple of different cruise ship fiascos occurred there. And I just remember hearing the CEO and at that point kind of getting used to it and understanding, they're saying what they have to say. Of course demand's going to bounce back. Of course they don't expect any long-term damage to cruise demand, but the fact is that everyone in the market is trying to figure out how severe it is in reality. So I
think I just watched that Netflix documentary, actually.
Sorry, what was that, Richard?
Sorry, I just want to jump. I think I just watched that Netflix documentary about the one of the CCL disasters that happened. Yeah. You just got to spin it the right way.
Yes, the poop cruise, of course, that comes to mind, right? That's right. And then I will tell you one other instance that comes to mind too. It was my first week actually with a new sector. I'd started in this sector where it was like cruise lines, it was gaming companies and lodging. And I remember we were putting out this earnings report really quick because that's one of the things that we wanted to do, we wanted to be first always with our, take on earnings. And I think it was the Wynn Resort CEO or whoever was saying that they were unlucky, right, in this particular quarter, which is a normal phrase that these gaming companies use. They can be unlucky because the dice happen to actually fall, out of their favor a little bit more than what would be normal. And I remember the analyst said they titled that earnings note something Wynn Resorts, claims unlucky. We beg to differ, which I really thought was a very respectable and confrontational title, which is a bit risky too from that from an analyst perspective to do that. But just there have been a few of those that really stood out to me where you just have to look through, and you can kind of just trust the numbers mostly, but I don't know. Keep it in mind as you read the reports and everything sounds rosy, record demand for things or whatever it might be, and the stock could be topping despite the CEO trying to push that. Next I'll go over and say politics matter. Something that I saw from the inside, is the need to maintain these company relationships, and that's as important as it ever has been. If not, it's probably the most important it's ever been to have those company relationships. The guys, the portfolio managers at these big funds, they were more and more selective with what they were willing to even pay us for. And so one of the things that they were doing is that they would pay us for what they call corporate access. They can get models and they can get estimates from 20 guys easily, right? It's not a hard thing to do, but you can't always set up meetings with the CEO or CFO of a company. So we were seeing how important that was. And so, it continues to be risky to have a sell rating on a stock. I'm sure a lot of people here realize that, right? Everyone has probably seen those numbers where it's like 90% of stocks are rated to buy, right? And then like 10% are rated to hold. And maybe 1% are rated to sell. That's still a very important thing. If you're cut off from corporate access, you're risking just an important part of your job and an important part of your compensation ultimately. So, these equity analysts have to be gingerly with the way they communicate things a lot of times. I'll just throw out that one company too. Heartland Express was a trucking company. I remember we had a sell rating on for 2 years probably, and that was one of the guys I was always trying to talk to. I'd email them twice a quarter at least. Try to get in touch and talk, and most of the time there was no response. So that doesn't help anybody. We can't really get, if we have questions like, why are your gains on the sales of your truck so high? Like what happened there? We didn't get any insight into that. And, ultimately it's just harder for us to get the models right because we may not know a couple of little details that matter. That Wynn Resorts note comes to mind too. I think we had a sell rating on that stock there too. And, the same type of thing happened where you got a sell rating on these things and these companies, and then 6 months down the line you upgrade them to at least a market perform or a hold, and all of a sudden everyone's reachable at the company and they're at least willing to talk. So that's something to keep in mind. The politics of this are still a big issue. And one more thought on this idea about the politics of covering these industries. Analysts always have to keep their sector investable. If you're an analyst, like I think my transportation analyst made this point at one point. The biggest companies in the sector were all railroads. That's where all the big institutions were interested because they're $100 billion companies. If you start telling people like, hey, you're wasting your time. Railroads, they're done growing, their margins have peaked. Maybe maybe an analyst like is a solar analyst, right? And you see what they've done. You say, look, come back in 3 years when we've got a new president. That's obviously that's not feasible, right? That you're hurting your livelihood that way too. So, the fact is you always have to sort of pitch something interesting going on in the industry as an analyst. I saw that firsthand too. At one of these points when oil was having a really severe price decline, and it was low for an extended period of time, there just wasn't interest in in oil companies, right? It was probably during the Biden years or maybe Obama years or whatever it was, where it wasn't a priority, right, to grow production and things like that. And I saw people get let go in the energy sector because there just was no real interest in that sector. So again, politics in this industry, they still matter. Let's see. There are good and bad analysts. I certainly saw that too at the different companies I worked at. Being considered a good analyst is very, very important. And it's, if you're not familiar, it's measured through this annual report from a publication that's called the Institutional Investor. And so it's just like any profession. There are good and bad people at this. And the buy side really respects only a certain number of opinions. So, there are some questionable boutique investment firms that maybe you guys have had run-ins with short reports. Some of those are not very good. But if you're good and you're well respected, an analyst actually can maintain. They're more likely to maintain that relationship with a C-suite. The C-suite at a company despite downgrades that just are part of your career over time. They know that it's best not to cut off communication from top-rated analysts despite the downgrade. And a lot of times the way that analysts can get around this is they blame it on valuation, right? It's not the company, it's not the execution. Maybe it's just the cycle that they can't help, or it's again just valuation. But it's always good to sift through the good and the bad. If you're following a company closely and you're digging into the fundamentals, it's really good to understand like who are the top two guys that people listen to on that name, because a lot of times the downgrade's not going to matter at all. You'll see that, or Loop Capital is an interesting company that sometimes makes headlines, and I don't know if they're always the ones that are moving stocks, right? But you get the Bank of America analyst who maybe is well respected. You can count on that to move something a little bit more. So keep that in mind. Make sure you know the good and the bad in sectors that you're looking at. Okay, and estimates are always behind this. It's just the nature of things, right? You might get new data every day, right? And it just doesn't make sense to publish a new model every single day if there's just new data coming in. Mostly we got weekly data. Analysts are sometimes busy. It doesn't make sense to publish all the time with just little things. Sometimes if you've got 5 stocks in a sector and this data came out, but you're waiting on one other company to report their update, then you might just wait 3 more days till the 6th company comes out with their information, just so you don't double your workload, things like that. But so consensus numbers are often stale. The other thing to mention here with the estimates being behind, companies, and I certainly saw this where I would have these calls prior to the quarter, right? Like before the blackout period, several weeks before the quarter, where you just kind of poke and prod and try to figure out what you might have missed this year or this quarter. Why am I higher on pricing than maybe the CEO thinks makes sense for the model or something like that. But you're always getting the companies to steer you in a direction so that consensus is lower, right? They do want to beat the estimates. It's not satisfying for them to watch their stock go up 10% ahead of the number and then just meet expectations and fall 10%. They're part of their job, and the investor relations team over there is to manage expectations, and they do seem to manage it in a way so that they can beat their expectations and look good I guess, on the on the Wall Street reports. And so here's something good that I'll talk about. Right. So here's the silver lining of all this. There's a lot to learn from this and profit off of. The sell side is still obsessed with valuation. Every single reporter, every single publication, anything you put out has to ultimately have a valuation section, because the whole point of this is what's the price target. That's what everything comes down to. And there are certain times when it matters, absolutely. But then there are certain times when the buy side is smart enough to know when to ignore valuation. Roy's going to go into some of this more too, with what he's learned a lot of. But over the years, we've seen that valuation is not, the cheap stocks aren't the market leaders, right? So keep that in mind too. The sell side is kind of stuck in this way with valuation, but that's we don't find that we make a lot of money when valuation makes sense. So something specific to the cyclical transportation stocks is it was very, there were lots of ups and downs, right? So everyone in this industry was obsessed with calling the peak or calling the bottom. It wasn't really a big secular growth story, right? It's, how much can freight really grow? How much can goods, shipments really grow? Well, it can only grow sustainably at the pace of population growth, really, right? So there's not a big growth story there. A lot of momentum traders that are, going to be attending this conference, they look at stocks breaking out to new highs and consider that a buy signal. But I think, the context of a breakout is extremely important. Buying the breakout in a cyclical stock is going to have a much higher likelihood of failure. I've seen that many times I just remember a few of these trucking stocks that, over and over just broke out to new highs and were sold immediately into on a good earnings report, because, really the smart money is trying to call the peak. I remember that too, that the analyst I worked for, I think it was the interview I had with him. And he said that his job is to identify inflection points. And, that's just much different than a lot of what we're looking for. It's not worth the squeeze for most of us anyways, either, to try to short a stock for a 10% move or call the bottom for a 5% move. And these cyclical stocks, we're looking for breakouts that are going to continue. And it's just not common in transportation, oil and gas, housing, financials, whatever it might be. Whatever's highly cyclical, it's just not as common. So, we do avoid a lot of these stocks for that reason, because, these things tend to revert to the mean more so than some of these newer growth stocks. And so, additionally, you can still find inefficiently priced stocks. Equity research has not saturated every single corner of the market. Apple, Google, Microsoft, the Mag 7, they have a ton of eyeballs. They've got, 50 analysts that all cover it. So you're not likely to find, big inefficiencies in these stocks, since they're they're the most watched stocks in the world. And so, you can only achieve alpha in these stocks really from timing the market. I mean, maybe occasionally you could have an opinion that's right. Nvidia was a great call in 2024, that beat the markets substantially. But, Roy and I find that, we can time the market with some of these beta stocks, or we can find inefficiently priced stocks that have extremely high growth, maybe have limited analyst coverage at the time, have a lot of a wide dispersion of earnings estimates, where you just can't be even close to honing in on earnings. You get to something that's as mature as like a Visa or a MasterCard, right, which are just these real big whales of companies that are just have a formula down to grow earnings. There's not going to be a lot of up and down. They're going to miss or beat by a couple of pennies. But a lot of what we're looking for is, ideally going to beat by a lot more than that. Just one example, I'll just say that comes to mind, and just because it was one of my favorites last year and still kind of is that Palantir. It was inefficiently priced, I think, for a long time. One of those things where, the sell side got it wrong over and over again, right? I think there were probably 7 out of 10 analysts that had a sell rating on it. No one could wrap their head around the valuation, but, for whatever reason, it continued to have that valuation premium. And that's because the buy side understood it, a lot better. It didn't have to fall into that perfect, valuation formula where, it's cheap on a price to earnings basis and things like that. So just, one example where, man, they were on the wrong side of it for an entire year, where I've never seen a more hated stock, maybe other than Tesla in 17 or something. Okay, and just a couple more things. Analyst coverage, I think it's a good thing. I think it adds legitimacy to a company, for one. Good analysts can spot a dud, so they don't bother covering these companies if they think it's going to zero. A couple stocks come to mind too in my experience. If you remember in 2021 maybe, or 2020, just 2020, there were some self-driving trucking companies, and so of course we had to, figure out if they were the real deal. And there were a few: Embark, Too Simple, and Aurora. And in those frothy years of COVID, I visited one of these companies in San Francisco, and met with the people running the company, and it was a bunch of kids in their 20s, trying to solve this huge problem that is just, it continues to be a very difficult problem of autonomous driving. I visited these guys. I talked to the VC guys who were backing the company. I rode in the truck for, a 30-minute lap around the city, and my lead analyst comes back and he says, "This one's a zero, right?" That was, I hated to admit it, but he was probably right. And, I felt that human aspect, man, I wish it wasn't, for the sake of all these guys that are trying so hard to do it. But, he really was indeed right on that company that fizzled out to almost nothing. And so, ultimately the point is, we never bothered putting in the work to really try to cover this company in great detail, because, we didn't see a future for it. So, if you see something like, okay, Circle, right, as an example, or CoreWeave, those companies that are, hot IPOs, they obviously get analyst coverage from the people that were on the IPO deal, but they're going to get more and more of that. And, that just does add legitimacy, because, the equity community, the detailed institutional guys are doing the work, and they think it's worth their time. It shows real faith that the business is going to at least exist and probably continue growing for the next 5 or 10 years. So, for that reason, analyst coverage, it's a good thing to have. And when you can see it, a company go from having 5 analysts to 10, that's also a good thing. That just adds further interest, further liquidity, further eyeballs on a name, for a stock that might not be as well covered right now. And okay, the last thing I'll go over is more about fundamentals. Okay, what I'm calling the holy grail of fundamentals. It's scalable businesses, accelerating revenue, expanding margins, recurring revenue, and pricing power. If you can get that, it's not common, certainly not common. But that's where you'd probably be best served spending your time looking for companies like that. That's what we're looking for as growth businesses. I just remember the problem. It was so hard for me to wrap my head around these trucking companies. and in my experience, you would think they could just keep scaling and scaling, right? You could buy 10 trucks this year, buy 20 trucks next year, 30 trucks the next year. Well, the problem is all these drivers just quit. So they'd quit, or they'd take their truck, they'd buy a truck, and they'd go work for a broker because they can get a little bit better money for the broker because the environment was so good. So it was so hard for me to understand who is even trying to waste their time trying to make 5% here and there on these trucking companies that just can't seem to actually grow. So I was just looking at that over in our models over the last 10 years, how you can't grow the business if you can't grow the number of trucks. And it's so clearly not a great business model, or just it's a hard business to be in. Not something that we would want to have a part in as traders, mostly because it doesn't follow anything on that formula most of the time. It's so clear these software companies with the network effects, they're so important, and thank God they just are free cash flow cows. Between Meta, Microsoft, Apple, Google, all those things. They're such better businesses the way the way they've scaled. It's unbelievable. I say I like to see things that have uncertain and incalculable upside. We don't want to sit here and talk and debate if McDonald's is going to show pricing up 3% or 4%, or if Walmart's same store sales are going to be up 1% or 2%. That's not the stuff we're looking for. The traders at this conference should concentrate on things that can be unbelievably big opportunities. One thing I try to look at too is a company that you can buy and not really care about the quarter. If you don't have to really care about the quarter, and the story so well, and the secular tailwinds are so large, why do you really care about the quarter? Why do you care if there's a 10% move following the quarter? And you can, certain people can work that way and make a really good return on some investments. Something like Robinhood comes to mind, for instance, right? The secular tailwinds are so clear. Do you care if they sell off 10% in a quarter when you think it's a 10x from there or whatever over 5 years? Not necessarily. So I find those are really good opportunities. And I'll say to add on, retail investors I think are continually getting improved resources. There are a lot of communities that sprout up through caves of Reddit and YouTube with people that are actually doing good and valuable work, digging into the fundamentals, and retail investors are showing a lot of success at spotting interesting opportunities well before institutional investors. So yes, you're up against behemoths, as I mentioned, a lot of resources, but many in the old school analyst community still lack the imagination. They're too hesitant because of valuation, and they don't have the risk appetite to take chances with companies that are in their early stages but could ultimately become the next true market leaders. So with that, go ahead.
Sorry.
I was going to pass it on to Roy, who will go over some insights about his last 4 decades, but Richard, if you got a question, I'm happy to take it.
Yeah, just want to jump in here because I think it's timely. You mentioned a few times the models that you guys would build and all of that. What would be the key factors that would be the inputs to those models? And I'm certain that it changes based on the industry and the company itself, but what would be kind of the key ones, and what would kind of you guys be looking for in terms of an earnings report or a big announcement that might really impact one of those factors?
Yeah. Well, to give you, I guess, an idea of what we look for. I mean, in transportation, there was price per mile basically, and utilization, and those are the real things that flow in and signal demand. As we're looking for inflection points, Well, for one, okay, if price per mile, that's really the most important thing, right? If price per mile is improving, generally you're going to have expanding margins, and these margins for trucking companies can go from like 15% operating margins to 2% operating margins, depending on how good of a demand environment that is. So, price per mile was so important, and one of I'd say two things that we looked for to give us a sense of if price per mile was improving in between earnings reports. We got weekly trucking data, which had a price per mile that's like a national index. So we were getting that every single Monday morning, and sending that out to everyone so they would know, if we're seeing year over year pricing increase or accelerate or decelerate. And then we actually found that a lot of times our primary resources were such a differentiator to give us that turning point first, like very, very early on. We might talk to the guy at Home Depot, and he might say, man, I think we're gonna have a really good bid season. I think a lot of our trucking prices are gonna come down a lot. Like I think we're gonna be down 10% in prices. And so we hear that first before, we saw it even in the data, and before we, saw it or heard it anything from the trucking company. So that was, a unique thing. And gosh, what else would come to mind there? I mean, a lot of times everyone was just obsessed with peak too. Like if you were to say, man, it can't get any better than this, or if Knight Swift happened to report an 18% margin, that's the debate. That's what would always make it so hard to say, keep buying the stock. That's about as good as it gets. So, in those particular sectors, I'd say that, I don't know, that's what we look for.
Yeah, no, that's helpful. And
Yeah.
just kind of to generalize that, things that would really impact signs of demand are kind of the key factors to look at. And you could apply that to different industries and all that, software. I think daily access, daily active users is a big one because that's a sign of demand that they
Yeah.
can pitch to advertisers, all that. So,
Right.
I guess, do you kind of just think about for each stock that you're focused on, what would be the key metrics that analysts would be looking at? Do you kind of make that calculation?
Yeah. Well, for like what we're looking at, um, certainly on a high level, it's about revenue acceleration. I really like to see revenue acceleration because that's when you get to that question of how much can it accelerate, and I like that idea, right? It helps to have that at your back when you're trading a stock. I think, you see a stock go from whatever 30% to 35 to 40%. Everyone's sitting there questioning how much better can this get? And I'll go for Palantir and Hood, for example, which are two of my favorite that I've looked at. There's customer count, of course. I remember Palantir customer count being up 100+% and thinking, wow, holy cow, that's a huge customer count increase. I understand revenue was only like 15% at the time, but customer count's up 100%. Surely that revenue is going to follow, things like that. And, Robinhood comes to mind. I mean, you look at just deposits because that's ultimately the driver of Robinhood. How much more money can they raise, or who's coming over there? Who's depositing more, and that just comes with more product offerings too for them. So those are two. You really do want to boil it down. I forget who it was. I think I talked to one of my mentors, John Roque. He was back at Wolf Research. He was a technical analyst entirely, but he basically he talked to, I forget who it was who he worked. He worked for Soros at some point, but it might have been him or someone else. But he was like, what two things matter for a stock? So you can generally boil it down to almost two things that matter for a stock in any case. That really moves it, right? A lot of other stuff can happen, sure. Like, you can shut down this arm of the business, that, whatever. Like, you might lay off 5% of your workforce. Well, who really cares? Does that really affect the thesis at all? It really can be simplified, I think, quite a bit if if you generally know the company, well enough. All right, and with that, I'm gonna hand it over to Roy to give you some of his key lessons over nearly 4 decades of trading experience.
Thank you, Wes. Great job. And Richard, we certainly hope that this provides the viewership a great perspective in terms of where analysts get their information, how do they utilize that information, how do they formulate their buy and sell decisions, and again, how do you attract the most money in in individual securities. That's the most important lesson that we want to learn here. So with that, let's continue. Okay. What I wanted to do is come up with really basically some practical advice in terms of just the basic things that I've learned over the decades to stay in the game. What they don't teach you in Wall Street today is trend following, and trend following is the foundation of success for what Wes and I do. We're interested in capturing 80% of the move of a stock from the beginning to the end. You miss the first by missing the first 10% and exiting after the last 10% and just get that 80% meat of the move. And if you can do that, believe me, you can compound your results significantly. And those compounded results lead to really superior performance over time. So trend following is really the foundation of doing this. I really learned this from Michael Koval's book on trend following. I think that's really the premier book that's been written on trend following, but I think it's very, very useful and insightful. I found over the years that the stock market is not random. You can beat the stock market. There was a book that was very, very popular, I think in the 70s or the 80s, talking about the random walk of Wall Street. And in that book, the author postured his belief that you can't beat the market, and that's certainly not that's not an accurate statement. You can certainly beat the market by using tools that you have at your disposal, tools that we didn't have really have at our disposal, 30 years ago, and they're all around you and very ubiquitous today. We think it's really important just to trade the dominant market theme. Now, you can be what's known as a top-down investor or bottoms-up investor, and we have found that when you can identify what the major theme in the market is and find the leading stocks in that dominant market theme, that's going to lead to the stocks that really significantly outperform the market. And that's really where you get alpha from. You get alpha from the companies that as Wesley mentioned, that have accelerating revenues, accelerating earnings, strong margins, high returns on equity, and they're dominant in the business that they are involved in. There is always a bull market somewhere, and that's important to keep in mind because I guess in 2023, after the bear market, 2023, we had about a 20% year. Wes and I did for our clients in 2023 after the bear market, the first year after the bear market. But the Mag 7 stocks were the rage, and all the money in the buying was concentrated in the Mag 7. While we're trying to pick up pennies, all the dollars were right there in the dominant 7. And Apple, Google, Netflix, Priceline, Tesla, etc. And so you have to know where the bull market is. You don't want to be locked out by not participating because you might have a determined view or a bias against the view, and that's not very useful or successful over time. It's important to know the market trend, and again, the trend in the stock, or the stocks that you're involved in and interested in, are they above all their moving averages? Or is the 10-day above the 21-day? Is the 21-day above the 50? Is the 50 above the 150? Is the 50 above the 200, and so forth? You must know if the market is in an uptrend, a downtrend, or under pressure. There are certainly times also to know and to learn well, when to panic and when do you go to cash? And many times that occurs during, like, say, a black swan event, for example, when 9/11 occurred. That was a time when 9/11 occurred, when the markets were shut down for a week, and when they opened right back up, there was tremendous selling, and that selling wasn't going to be over in a single day. And so even with the market opening down, limit down after 9/11, the time to sell was when the market opened. So that was a time to actually panic. You were rewarded by, quote, panicking and protecting your nest egg and going to cash. You have to know what's happening in the background. We recently had sort of a 9/11 event earlier this year when we had the deep seek news that came out, and we were loaded up in the data center companies because they had all these tremendous tremendous growth prospects where there was huge capital X expenditures by all the Mag 7 and the hyperscalers. And there was the DeepSeek announcement came out, and that was a better mousetrap that China presumably was being able to produce AI models very much cheaper than the NVIDIA model. And that was the time right there where we had to go to cash because we didn't know the downside. We didn't know if that was transitory or if that was something that was going to be more long lasting. And when you don't know something, when you don't know, when there's uncertainty, it's most of the time it's best to sell first and ask questions later. So that was a time to also when presumably you would have thought that, man, I'm panicking by going to cash, but there are certain times when it's necessary for you to do that. And if you made that call correctly and know how to do that on a timely basis, that can significantly impact your performance on a positive basis. Okay, the market leaders, they can run longer and higher than everyone expects. As Wesley said, the analysts are typically way behind the earnings estimates, and that's just the way the process works. So all the companies are coming out and guiding the analysts a certain level of earnings that they expect to hit, and they also want to lowball you. So it's important to know that. And as long as the stock is continuing its growth spurt, and in terms of growing organically, the numbers can stack on top of each other and can lead to really systematic long-term performance numbers that are very, very strong. And that leads the stock prices to follow. Price action determines your equity curve. So the only thing that matters is price. So when you narrow it down to, buying a stock after doing all the work, the only thing that really matters is, did you make a timely purchase, and are you immediately right or are you immediately wrong? That's important to know. And lastly on this slide, never give up. A lot of people have found that this is a terrific career. This is something that they want to do long term, but believe me, there's so much mental fortitude that's required, and most people, 9 out of 10 people, can't do it. But if you truly love what you're doing and you really enjoy this, there's nothing better in terms of a career choice, or there's nothing better to compound your money than with the low entries to barrier that you have by investing in the stock market. Next. Okay, risk management and capital preservation. This has been, of course, the most important concept for me to practice over the last 38 years. You got to keep losses small to survive, and we limit our losses to a maximum of 1% of our equity on an individual position. So we never want to take more than 1% of our equity drawdown on an individual stock. So that's, that's very, very important. Also, the position size is very important. And you have to do the math so that you can participate in the maximum amount of size with the keeping that 1% as a uh, uh, the maximum drawdown that you're going to occur on a position, the maximum loss that you want to occur in a position. You want to always avoid excessive risk and leverage. It's easy to get to think that the market will continue to run the way that it's been running on an exponential basis, and many times that's just not the case. And you have to be very, very careful and use leverage judiciously. Uh, Many times people become addicted to excessive risk and excessive speculation, and that only leads to eventually drawdowns and breaking rules and reducing your equity curve. So just keep that in mind. Um, we don't we don't like to press our positions unless we've got a 10% cushion, like in our entire portfolio or in individual stocks as well. So this has really been a quite interesting environment because we were up 6% in January for the year, but gave 5% back in one single day, and that was the deep seat day. But that's how we were position size. Just a couple of days ago, we had the second worst day uh, in our in our fund, where we were down 3.4%. And occasionally you'll get those. So we've had 2 days, two bad negative days this year, but we are still up mid to low uh, digits in the market despite those two things of happening. If you can avoid those deep seat experiences like that, you're going to stay in the game. So because that's what you're designed to do, you're designed to stay in the game and compound your results. Daily returns in day trading, it's just not practical. I've never seen anyone consistently make money in the market every single day. The gains that you have in the market, they typically happen in periods, and those periods might last 3 or 4 months, and you might have 2 or 3 periods in the entire year where the environment is clearly bullish, and that's where you achieve most of your results. And so don't think that you're going to have a 2 to 3 year bull market and you'll without ever having drawdowns. That's just not realistic. I had a buddy of mine that used to tell me right when I began in the business, and he told me it's okay to be wrong, but it's not okay to be broke. So you can't you can't dig your heels in when you have a loss. You got to be those are the times that you have to really, really consider whether or not you want to hold the position or not. And it's by far the more concentrated positions that you have, it's much more important to to not take any very, very large losses. You can't just set it and forget it. Set it and forget it, or a buy and hold strategy. That's the quickest way of generating underperformance and also going to the poorhouse. Just ask those people that stayed in from 2000 to 2003, and it took them to 2013 to get even. And also those investors who unfortunately stayed in from 2007 to 2009 and they never got out. You can't just set it and forget it. You can never take your eyes off the ball. It's hard enough when you have the great periods of time where you can outperform to have the downturns that systematically occur that you have to manage for. So it's really important. What we're saying is the focus on the downside is much more important, or it's as important as managing your money and compounding your money on the upside. Wes. Okay, just a little bit about executing and trade management. Press your winners, sell your losers. Don't double up your losing positions. That's obviously that makes a lot of sense, but many investors unfortunately double down on their losing positions when you should be selling. There's an old adage in our business: the first loss is normally your best loss. So you press the winners, sell the losers. You also should be buying incrementally until you have a cushion built up, say in your overall account. Um, Over concentration it's really an enemy. It's really not your best friend until you have enough profits built up that you can trade off of. So it's in our view, it's inappropriate to start off with 10 or 15, 20% positions right off the bat without having any significant profits built up. We think it's very important to have profits built up that you can trade against. Okay, don't wait for perfect conditions. There'll never be clarity, true clarity, until the coast is clear. And when the coast is clear, the majority of the money has already been made. So don't be late to the party. But you have to have, you've got to have some seasoning. You have to have some tools to know when do you get in the market, when do you press your positions incrementally, and when do you get out. That's important to know. You have to have a strategy and a trading methodology to help you navigate around that. That's important. The technicals provide the timing. Wes talked about the fundamentals. The fundamentals are, of course, very important. The fundamentals drive the earnings momentum and drive the earnings acceleration in the company, but the technicals provide the timing, both in and out. So you must master the technical side of the business, and that's technical analysis. You must become very adept at reading charts and understanding supply and demand and how those relationships work. That's a situation that takes many years to master. That just doesn't happen, from reading a book or being in the market a couple of years. That takes years of experience to master. But when you do master that lessens the drop in your equity curve, and it also provides you with the ability to have sustainable performance over time. Technical focus and market signals. Okay, the greatest, and this is really going back to O'Neill, the greatest stock market winners, the companies such as, Google and Netflix and Booking and Apple and Tesla and on and on and on, and Amazon, they never had cheap PEs. They're never cheap. And many times the high PEs, that's telling you something right there. Many times we're attracted to stocks that have the highest PE in the market, or they don't have a PE because they're growing their revenues and not their earnings, because they're putting all their investment capital and their earnings into growing the business. And that's something that's changed over the last 20 years. O'Neill would never buy a stock that didn't have any earnings. And remember, CAN SLIM to CA, in SLIM, the earnings estimates, O'Neill was always looking for a 20 to 25% revenue growth and earnings growth as well over the past 5 years. But in the companies that I mentioned to you before, Google and Amazon, they never had 5-year numbers that were profitable 25% until they were very, very seasoned, till they had a dozen years, in the business. So if you're waiting for the PEs to come down, when the PEs come down, the stocks are going to be out of favor, and that's really not when you're going to want to buy these strong momentum stocks. Volume is very, very important. So we watch the volume, particularly on individual companies, and the volume clues allow you to determine and understand that that this is institutional activity that's taking place. And the number one rule to follow is follow the institutions. When you don't have $1 million research arm to provide you with all the research that, say, a Fidelity has or a Putnam has. You can find that information strictly or right from Market Surge, because you can see all the institutions that have positions in the company, that are building the position in the company. That alone tells you that the institutions are in there buying. And we utilize that concept in every stock that we're interested in buying. Momentum and price, that's the secret, and that's the magic elixir. You want to find stocks that are making new highs in price. You want to find stocks that are making all-time highs in price, and you want to see those stocks that have an explosive catalyst that can be witnessed from observing their volume clues. That's where you can find them. Those stocks that have no overhead, those are the ones that can provide you with the explosive potential. The greatest stock market winners also have tremendous liquidity. Remember, the institutions can only buy stocks that trade, hundreds of millions of dollars a day, and those are the ones that typically have the greatest activity. I remember a market pundit once told me that, if you can't trade the very best merchandise, the merchandise that Wall Street is paying the most for, that has the most volume, you certainly won't be successful trading a stock that's barely trading, that has very, very little volume. So you want to be in the most liquid names. The most liquid names are typically are the best quality merchandise. So liquidity drives the best moves. Again, technical analysis, this is extremely important. That's what Wes and I do the best. We identify these true market leaders that we ascribe to by finding and utilizing sources that we depend on. TraderLion, for example, provides Richard writes a trading blog every day, and I'm sure in the blog that he'll put out tonight, he'll be talking about probably Palantir and Robinhood and Circle and CoreWeave. And so it's important to find people that can provide you with information that have the same mindset as you. And, that makes, that's a silent partner. So when you do that, and you can do that from Twitter, or you can also have accountability professionals and friends that trade as well, that you can bounce ideas off of. We think that's essential in terms of maintaining your growth, but still being objective. But let me caution you that you must ascribe to the people that have the same mentality as you do. You certainly don't want to ask a value investor what he thinks about a momentum stock. That would not be a good fit. We have multiple screens that we actually run to find the leading stocks in the marketplace. And as everyone knows, relative strength for us and many other momentum investors, that's the magic elixir as well. You can't hide from the stocks that are outperforming all other stocks in the marketplace, and that's certainly what we're looking for too. We're looking at those stocks that have relative strength of, in the high 90s, 97, 98, and 99, we found that those lead to the most explosive moves on the upside. And finally, expand your setup toolbox. There are many different tactics that you can utilize in terms of knowing when to buy and when to sell a stock, and it's important to grow that toolbox so that you have various setups that historically are very, very successful, and the odds are that they'll work. It's important that you have a number of those in your toolbox so that you're not just trading one different setup and one different idea. Mindset, psychology, and discipline. We don't really talk a lot about mindset, but mental focus is extremely important. And being able to take a licking and keep on ticking is essential in this business. This business will wear you out with the losses that you have to take in order to finally capture the truly successful stocks that you typically purchase, and that you have big winning returns from. Many times you've got to go through 4 or 5 stocks to find the 2 or 3, or 10 stocks to find the 2 or 3 that are going to truly work. So it's important to weed your garden, get rid of those that aren't going to work, or that aren't working, and stick with the stocks that are working. Day trading, if you're trying to make money every day, you're going to get frustrated. You're not going to be equipped to have the energy and be at the top of your game when the easy money environment is upon you. Position trading, for us, finding those winning stocks and feeding those winning stocks, and that's our formula for success. It's important to continue to learn. I've been doing this almost 4 decades, and I never not learn something, on a daily or weekly basis. I learn something every day, every week, every month, even after doing this, for going on 4 decades. You got to be positive, grateful. You got to be helpful to others. I think that's an important mindset. It should not be all about you. It's all about, you want everyone to win, and we all want to win together. Conventional wisdom is often wrong, but never in doubt. So, conventional wisdom, it's many times that's not going to be a winning formula, but it seems like, those that conventional wisdom is never in doubt, and the never in doubt that's not going to really make you money. Media wants to sell fear. It's important to understand and know when to fade them. You can see what's going on in the tariff situation from the beginning, and since Liberation Day in April, that's being pretty much discounted now. But the media is still coming out with all the tariff news, panicking, and it's being discounted in the market. You've got to understand that that's how the news outlets work. That's how news works. That's how fear works. Don't let fear interfere with your investment process. And accountability partners, as I mentioned before, it helps you to stay sharp. I think Dale Carnegie, or one of the motivational stalwarts in the past. I think had something like a mastermind group. That could have been Napoleon Hill as well by Think and Grow Rich. And a mastermind group is essential in terms of you staying on top of your game and being able to bounce ideas off of. We think that's very, very important as well. Resources, you got to have a trading plan. You got to have a methodology. What's great is this is really the best book that I've read, like in the last 5 years, the Trading Handbook. It's a great, great text because it covers all those things in terms of how do you build a trading plan, how do you have a process, and it's laid out for you right there with many, many different examples. It's really the most essential book that I've read in the market, and I myself, can go to it after 38 years and pick up, additional ideas. It's fantastic, and we recommend, everyone that listens in to, go out and buy that book. It's essential to have that one book in your library. Wesley mentioned about YouTube and the internet. Just about everything that you can find now is on the internet, and you really have many, many creative, smart people on Twitter, on X, that provide great insight and provide great research as well. And this is something that provides the individual investor a tremendous advantage, because the institutions aren't wired that way. When you work for someone like Merrill Lynch or Goldman Sachs or Wells Fargo or somewhere like that, UBS, they have a buy list, and that buy list covers a stock or two in every different industry. They will not allow their financial advisors to buy anything that's not on their buy list. That's a huge disadvantage to the retail investor. You want to be able to buy anything and everything that sets up and that fits your criteria. And by having that provides you with a great, great advantage. And I think that's one of the reasons that most retail investors or individual investors can outperform the S&P, and you can outperform all these institutional investors as well. I have probably maybe 100 books in my trading library, but you really only need just a few books. Like the Trader's Handbook, Mark Minervini's books, How to Make Money in Stocks, Jesse Livermore, Nicholas Darvas, Gerald Loeb. Those are some of the best books that are in the market. And I have found that it's best to take 5 books and read them 10 times than read, 100 or 200 books one time. Just read those books over and over and over again. TraderLion, by the way, they have each year they put out a publication. It's called the Model Book Winners, and I find that very, very useful to go back and constantly and consistently study what these stocks looked like each year. And that's really one of the most valuable resources I have found on the planet, by observing and taking a look at what they looked like and what the pattern recognition process looked like. And many times we've been in and identified many of those stocks and have been in those stocks, but that's a great learning experience as well. Bear Bryant had a great quote, and he was quoted as saying, Bum Phillips that said about Bear Bryant. He once said, he can take using and beat his'n, and he can take his'n and beat using. So, that's the difference between the great and the superior traders out there. You can be looking at the exact same stocks, but your returns can be they can be there could be a wide bell curve because just the talent is different, because people are more experienced and they've seen it more, and they're a little bit better equipped to, in terms of executing their strategy. So talent is very, very important when you're looking at all the same stocks. So, lastly, on this page, I wanted to point out 90% of fund managers underperform the S&P 500. So why not just have your money in the S&P 500? That's what most people should do. However, the great traders out there, and our results reflected as well. The very, very best traders on the planet can systematically sustain in a sustainable fashion outperform the S&P 500. And for us, we're trying to beat the S&P 500 by 2 times, by doubling what the S&P 500 is by 2 times over the course of a full market cycle, of a full trading cycle. And that, if you're able to do that, those compounded results are life-changing. And that's why we're doing this, because we want life-changing results and life-changing money. You're not going to get it in the S&P 500, particularly when if the S&P 500 goes through a bear market. And I just want to encourage you to buy individual stocks, manage them well, identify the leaders, and compound your results. In closing, stay disciplined, stay focused, stay humble. If you get full of yourself after having, a great run, and that could be a period of 3 months or even 3 years. If you let your guard down, you're about to be penalized. So you got to be very, very careful, because believe me, I've seen this after, almost 4 decades, that as soon as you let your guard down, as soon as you think that you've got it figured out, you're about to have a come to Jesus talk with yourself, and it's not going to be one that you're going to like. So, if you have your discipline in place, if you have a, a mitigation strategy that's that works, that will keep you out of danger, that will keep you in the game, and that's what we're talking about today: is how do you stay in the game year after year, decade after decade, because that's what we're trying to do. And by following these basic principles and precepts, I guarantee you that your results will improve if you haven't utilized all these techniques that we've talked about today.
Excellent. Well, Roy, Wes, it's great to hear your perspectives. Both Wes, your approach with the background information about what's going on behind the scene with the analysts, and then Roy, of course, sharing the key lessons and principles that have allowed you to have great success over the years. So thank you so much, both for being here. And hopefully everybody watching, you enjoyed that immensely. Highly recommend checking out their Charlotte meetup. Really great information, emphasizing key principles, and then providing what they're actually doing behind the scenes. So Roy, Wes, any other closing words before we get going? Or I think that's it from my side. But let me know if there's anything else you want to add, Wes.
I have nothing to add. Thanks for
No
having
problem.
us.
Yeah, of course. Our pleasure. And thanks all for watching again. And we'll be right back. Cheers. All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, Himanshu Sharma. He is a full-time trader, investor, and educator. He is the founder of Chartadude, and today we'll be presenting on his process for finding high-potential stocks, how to find multi-baggers. So, Himanshu, thank you so much for taking the time, and great to have you back.
Yeah, thanks for the opportunity. It's, I think, second time we are meeting now, and this is related to more for stock screening and entry part. So if we have the opportunity again, I'll try to cover the exit part as well.
Yeah, perfect. Well, let's go ahead and dive right in. I think this is such a crucial part of trading, focusing, in the right universe and being able to spot the names that have the potential to go on fantastic trends.
Okay, so basically this is the agenda for today. I'll be giving brief intro of mine, and I'll be defining what do I mean by the multi-baggers. So I will then dwell a bit into understanding the past winners as well. What footprints do they have in common? So here I would like to say that the book Monster Stocks by John Boyk and your TraderLion Handbook also helped me a lot, because unless we study the past winners, we are not able to spot what template do the recent winners have. And then I'll take you to the scanning process of mine, and I particularly go through EPS scan, RS scan, and IPO scan. And that's a very common question, that how to spot the strong industry groups. That's what I learned from Dan Zanger. And then we have entry, setup, and trade execution, and then finally I'll conclude. So this is the overall agenda of today's presentation. So in a way, as I told about, this is about me. I am founder of Chartitude. I did my CMT level 3 from MTA, and I got that certification from IFTA. I did MSTA from STA UK, so I'm a member of CMT Association, MST, IFTA, and ATA. And I think you are aware about me because last year also we met. So I was working with Government of India here. I resigned and I went to Jakarta to learn about trading over there. So I had my mentors over there. They taught me everything about trading from A to Z. So these are some common questions that I receive. It's like how to narrow down to probably less than 30 names from thousands of listed stocks. And secondly, the question is that what is the optimal number of scans? So do you run relative strength scan? Do you run 1 month gainers, 3 month gainers, high volume spikes, EPS, IPO, near highs, liquidity scans? So when a beginner comes to the market, he is bombarded with approximately like 10, 12 scans here and there. So when I interact with them, they come to me and they say, can you just tell me 2 or 3 scans maximum that I can run, because I'm a working professional, I can't go through almost around 10 to 12 scans. And then what are the optimal parameters? So I read a book, The Value and Momentum Trader by Grant Hamming, and he was discussing about what are the optimal number of parameters to be used so that your stock selection is not too less and it's not too high so as to bombard you with a lot of headache. Or that scan gave you almost around 600 names, and then now you're back to square one. And then the common question even I had in my earlier years were like how to increase my probability of winning. And the answer I got by reading all the newsletters by Sir Dan Zanger when he wrote all these newsletters since 1998. So he was constantly focused on stronger themes and stronger industry groups. And in almost like every month in his newsletter, he mentioned that, okay, this is the industry group that is very strong, so we are playing here. So I think that increases your probability of winning. So what do I call as a rapid multi-bagger is that the stock that doubles in a year. So it's like you have a market cycle, like you have in USA, you have Hood and you have Rocket Lab. So you have so many stocks going on more than 100% in a very short span of time. And these are generally monster stocks. They usually run for 3x, 4x, 5x kind of move in their bull phase. And I have observed that their bull phase usually lasts for 8 to 10 quarters. So it's very important that when you run your scan, for example, there is a beginner who just sees this presentation, goes back and starts running the scan. He will be getting around 100 names, 80 names. He has to make sure, he has to ensure that you are in early phase of that bull run for a particular stock. Because if you are buying it after it has already shown 8 to 9 quarters of earnings acceleration, then chances are highly likely that you are buying it near the top. So we have a few exceptions here and there. And so when I studied the past winners, I mean, I always say like your book, like TraderLion Handbook or Monster Stocks by John Boyk or Mark Minervini's Trades or Trades by Dan Zanger. When you read all of them, they have some common templates. They have some technical templates and they have some fundamental templates, so that if I know those past winner templates, I can apply the same and increase my probability of winning. So these are some technical templates that I found in most of the past winners. You can say like almost around more than 90% of them were in an uptrend when they went on to become multi-baggers. So you can say that if they are not IPO stocks, they were in number one case, they were coming off when the market was in a phase of a bear market or a crash or a correction. Like during the COVID fall, you will see that all these stocks have corrected deeply, and then they were starting off their uptrend. Earnings were already on the table, but because of the external market pressure, they corrected a lot. So they were above their 200 days moving average, and I have observed that most of them were at least 50% above from their lows. So it's like I don't want to buy them near the lows, because I think that I am an individual investor. I don't have resources to hire a research team or an analyst who will be doing research on these value stocks hovering near the 52-week lows. So I think that I am paying a premium to 3 or 4 employees by buying it little bit expensive, and they are giving me extra bit of confirmation that smart hands are active here. So I want to align my buying with them, as Richard Dimmelwickoff mentioned multiple times in his newsletter. These all were close to their highs. So a lot of times people think that high means that we are buying it at the third or the fourth or the fifth base. I'm not talking about that. I'm talking about that supposedly a stock was in a downtrend. It was in stage 4. Then it went to just sideways consolidation. And when it is turning around up, it will be close to their highs. So it can be 6-month high, it can be 52-week high. I have observed that minimum 6-month base is crucial to absorb that overhead supply. So they are just starting off after a downtrend or a sideways trend, and they all had volume spikes. So these were the technical footprint that I'll be using to prepare my scanning criteria later on. So if I go to the fundamental footprints, now that's very important. What happens is that most of the time, these stocks have earnings surprise of more than 25% in the recent quarter. So what happens that I'll give you multiple examples where the stocks are just sleeping in terms of profitability. They are reporting almost around the same part quarter after quarter, but suddenly in one quarter, all of a sudden, like they report a PAT jump of 25-30% or more. Then you get a fair bit of idea, okay, there is something going on in this business. And then you go back and then you analyze the recent presentations by the business, you read the con calls, you visit the website, you get to know the catalyst, you get to know the trigger, that N of can slim. It may be a new product or a new service or a new management. And how do these multi-baggers pop up? That's what Darvas also mentioned in his book, How I Made $2 Million, is that there can be 100 reasons behind a stock movement, but I am only interested in one, that is earnings scan. So I'm looking for earnings movement. So I prepare this list. I always look for 25% jump in profitability in, for example, this is June quarter, so I will be comparing it with the previous March quarter. I'll be looking for 25% jump. I'll prepare the list and I'll be looking for these stocks to accelerate in the next quarter. So the ones that show me surprise, first of all, I'll tell you how to reduce the number of names, and then I'll go for earnings acceleration. I will spot their accelerations. If they accelerate, first of all, between this quarter and this quarter, I have 90 days of time to read these names. So they will be like around 40-50 names. I can easily spot the catalyst. I can read what the management is saying, and I can analyze that they are from the infant industry. So when Darvas is trading Thiokol Chemicals, they are into rocket fuels. When he's trading a stock called as for the filter cigarettes, then he's trading National Semiconductors in his third book. You can still make it in the market. National Semiconductor, again from an infant industry. And the fourth point is that the PE ratio less than 30. Now here I agree with the fundamental view. Now a lot of traders, I have heard that PE ratio doesn't matter, but I mean, I agree to that point. PE ratio doesn't matter, because if the PE ratio is too high, then your stock has to report higher earnings growth to actually justify that valuation. So if PE ratio is like 100, 150, I will be very cautious, because then I have to look for the earnings growth as well. So if the earnings growth slows down, then the stock will be beaten down badly. And luckily we have circuit limit in India. In USA there is no circuit limit, so it can just fall off the cliff as well. So here I agree, what happens during the bear market or crash or correction, the starting PE value comes like very lower. It comes below 30. I have observed in most of the multi-baggers. So that is why bear markets or crash or correction is the best time to spot them. So these are some model templates for which I'll be using my scans. So I run basically 3 scans. I run EPS rating scan, I run RS rating scan, I run a scan for IPO stocks. Now this is my bread and butter scan, as I mentioned, that EPS rating. The stocks with high EPS rating of 80 plus with other liquidity filters like you may have some price more than maybe $1, $5. You can have some rupee transaction value or dollar value to be higher than some limit in order to pop up or screen for the liquid stocks. So EPS rating 80 plus means your stock is in top 20% of the strongest earning stocks. That's the parameter used by IBD and Market Surge and Market Smith. So EPS rating, they basically take into account the recent 2 quarters, and they take into account the past 5 years of earnings. They give more weightage to the recent 2 quarters. So that's how they calculate the EPS rating. Now that's my bread and butter scan. I'll explain to you in a bit. And RS rating, that's relative strength. Enough has been written on it, discussed on it, and IPO stock. So I'll explain that one by one. So EPS rating scan is my bread and butter scan. And when I run this scan, I make sure that I segregate this scan in 3 lists. So one list is that I have a small size EPS names where the market capitalization is from $100 million to $1.2 billion. In Indian market, we usually say that 1,000 crore to almost 10,000 crores. Mid-size bucket is where these companies are a bit mature, $1.2 billion to $2 billion. Here in India, we say like 10,000 to 20,000 crores. And the large size EPS, these are the companies in India, because we have the largest company also like 15 lakh crores. So it's more like $2 billion plus companies is in the large cap. So what I have observed in the past winners is that these are usually the small size names. So I'm interested more on the smaller side. So I'm interested more on the small caps and the mid caps, but not on the large caps. So if you give me 10 names, I will give more preference to the smaller size name, because I think that it can move faster. The business is young. It's from an infant industry. It has more headroom to grow, and the total addressable market size is also very huge. So now this was one common question that we receive, is that too many variables or too less of them, what do you do? So any scan, if you use both TA and FA together, that will weed out a lot of names. So basically you're adding too much criteria to filter down the stock. So instead of 5, you're using 15 criteria, you will be getting like very less names. You will miss out on a lot of names. So using TA, if you use just TA alone, you will be getting a lot of names like 200, 300 from your relative strength screens, and then you have to manually check them for EPS. If you run like FA alone, you can miss out the names that are moving up on story or anticipated earnings, because the earnings right now is not on the table, but it may come later. So what I found is that running that EPS scan first is more optimal in my case, because as I mentioned before, that more than 80% of the past multi-baggers had earnings on the table. So here I agree with Nicholas Darvas, William O'Neill, Mark Minervini, everyone, that earnings is very important in the long run. Price is the slave of earnings. So if I run my EPS scan first, overlapping in both the scans, because automatically the higher earnings attract institutional capital, and they are very high in relative strength as well. So you can go to the history of any stock market and you will see that in the longer run, high EPS scan names also have that high RS as well. So what I do is that I run these scans in this order. So what happens is that now you have a pain point like, okay, I ran that EPS scan of EPS rating more than 80. I have roughly around 200 names. If I run this scan today, I will be having 180 to 200 names. Now what do I do is that exact process that I follow is that step number 1 is that I focus on smaller size names first. So that gives me like less than 150 names. Now manually I have 90 days to check for their earnings on the table or not. So what in the second step, what will I do is that I will look for earnings surprise. As I mentioned that PAT jump of 25% plus in recent quarter. If I apply this filter, I will be having less than 50 names left. And you will say that why less than 50 out of 150? It's because some of the stocks usually here are cyclical, are shallow cyclical. So they are like fertilizer related names. They are more into agriculture space. They make money. They are dependent on monsoon. And there are some companies here in India, infrastructure related companies, they get orders from the government during the last quarter of the financial year because government also has to show the expenditure. So that's not really a surprise. A surprise is something that your profitability was flat and all of a sudden that you got a jump in profitability. If you scan for that, if I do that, I will have, as of now, I have 42 names in my watch list. So from 150 to 42. And then I'll look for starting valuation because I don't want to pay extra. If I am paying extra, if the PE ratio is very high, then I will look for PEG ratio here as well. That has been discussed by Peter Lynch in his book One Up on Wall Street. What is PEG ratio? It is like if you are paying PE ratio of 100 and the stock is showing earnings growth of also 100%, then the PEG ratio is 1. So PEG ratio less than 1 means that the PE ratio that you are paying is less than the earnings growth. So basically the stock is growing faster than what you are paying for it. So if the starting valuation, the PE ratio is very high, I will be looking for profitability growth, the earnings growth, the PEG ratio. And as I mentioned to you that it should be from an infant industry like artificial intelligence, data centers, semiconductors, renewables, or here and there eVTOL is now gaining ground. It's like vertical takeoff and landing, and you are hearing about drones in modern warfare. So these are all infant industries. So if I apply this exact process, that's what I do. I am left with some 20 to 25 names and I'll flag them off. Once I flag them off, I will be checking for their earnings acceleration in the subsequent quarters because this is the first quarter I am catching them. Now a lot of people ask me a very common question that suppose this is the June quarter and you are comparing the earning with the past quarter of March. Why are you not taking it year on year? So my reply is like that. There is a speeding car on an expressway, you install a camera. If it just crosses 80 miles per hour, you want to catch the driver for the offense. So what happens is that the sleeping profitability, you want to catch it in the first quarter itself. You want to get that flare in the first quarter itself. So that's where I am active. I'm looking for that 25% jump in the recent quarter. And from 150 names, I'll look for surprise. I'll give you multiple examples and then I'll look for starting valuation and infant industry. That's what I do this scan all about. And I am left with, to be very honest, like I'm left with around 20 to 30 names and from thousands of listed stocks in Indian market as well. If you send me to any other country, I'll run the same scan. So other leftover names are still there in my list. That's why I said I have just flagged these names. But the other names, I can just trade them based on the chart patterns. That's what Dan Zanger said, that price, volume and earnings makes up for the winner. So they are not discarded from my watch list. Maybe they can show up their acceleration. Maybe they are not dependent this time on some weather or some cyclicality. So I'm not discarding them, but I'm just flagging them the listed stocks, the filtered stocks. So now here, that's what I mean by earnings surprise. Now that's a company called as Precision Wire here in Indian market. Now if you look at the profitability, it's like 18, 22, 20. It was hovering around 20. And all of a sudden we have a earnings surprise and we have a profitability of 30 CR. So that's where on the first step itself, I want to catch it. Now here, that will be filtered out in my watch list and I'll be looking for the acceleration. Now, if you look at the company has reported the highest sales, they have reported increase in their margins as well. So if these three things accelerate together, then you know that Mark Minervini also mentioned about code 33 in his book, that all three, sales, margin and profitability, all three are accelerating together. So that's what I want to see. Now that's what I really call as earnings surprise. That's what I'm looking for. Now this company HPL Electric, when I spotted the earnings, now you look at the earning here, net profit, it was hovering around 14, 18 number. All of a sudden it directly jumped up to 2x. So what happened to the chart? I can show you the chart. The chart also spiked up almost around 40-50% from the earning day. And you look at the margin, it's the highest ever margin. You look at the sales, it's at the highest ever sales in the quarterly sales. All three have accelerated. And when you read about the business, they are into smart meters. So in India, we still have that old smart meters. Now the government is replacing those old smart meters or old meters with the smart meters, where any person don't need to come to your house. He can take the reading sitting in his office. So that just reduces the pilferage of electricity. So in fund industry, accelerating earnings, earning surprise, margin accelerating, sales accelerating, and that's what gives you some bit of hint that it can be a potential multi-bagger. If you look at this wealth management name here, if you look at the earning, the same phenomenon, that's what I call as earning surprise. The jump to 94, the jump in the margin and jump in the sales. They are into wealth management business. We are a growing market here, emerging economy. So a lot of people are giving their money to these wealth managers and they are making money. So a lot of people say in India that it's a decadal theme now. So if you look at this company, that's an auto ancillary. So we have a reputed four-wheeler automobile name in India and they are the suppliers to it. So if you look at the earnings, again, same concept, the surprise and the surprise in the margins and the highest ever sales, and the stock has also blasted up. So if I can show you like the chart also of this business, if you look at this stock, so if you look at the chart, there was a earnings gap which you call as episodic pivot, and the stock also moved almost 50% from the earnings day. And now I'll be looking for the earnings acceleration as well. So you can trade a lot of EPs the similar way in India as well. So here, now you may feel like now that's a surprise maybe. Now this company, if you will see that it's a pesticide, they make pesticides and they are heavily dependent on the monsoon. So we have monsoon during this phase in India, June, September quarter. So if you look at, they report 2 quarters of positive earnings and acceleration, and then 2 quarters it's dead. So again, that same story of June and September quarter, and again June and September quarter. So the next time the earnings comes in June quarter, I am sure that the earnings will be fantastic. It will be good because it's monsoon dependent. We have above normal monsoon here. But that's not really what it makes for a multi-bagger. It can probably move like 50-60%. If you look at the chart of insecticides India, you will get a chart like hovering up and down for 2 quarters each. So that's not really the surprise what I'm looking for. I'm looking for surprise and acceleration, but that's why I'm saying that in the next quarter, in the current quarter, the June quarter, this stock will also filter from your list, filter your scan. You will also get this name. But I will not consider it looking at the past historical profitability, because I want that sustainability in earnings. I want a catalyst. I want that infant industry group, not dependent on weather, not dependent on government orders and all. Now here, that's what I learned from Dan Zanger. That's the basic crux of what I do. Price, volume and earnings make for the winning stock. So I don't want to bang my head outside of this earnings scan here. Now, what do I do is that now if you come to me, you'll say to me now, this is the stock that doesn't have earnings on the table right now, but it is moving up. How do I spot that? For example, my mentor said me that you have to scan for the Korean stocks. So when I went to the Korea, the Kospi index gave almost around 12% return in those 3 months. So I was looking for relative strength as a scan to basically, apply a shortcut. Now, it's a very, very strict scan because you are compromising on the EPS. So you don't have earnings on the table. So I don't want some bit of negative surprise here. That's why I'm looking for RS rating to be more than 80. That means the stock is in the top 20% of the universe. That means that it is performing better than 80% of the stocks. And it should be within 20% of the 52-week highs, because I don't want that overhead supply now, because the stock may not have any earnings. Now it should be as usual above 50% from the 52-week lows. It should be above 200 days MA and price should be more than $5 or whatever you can use here. In Indian market, we usually have that to be around like 50 rupees, 40 rupees. It's usually fair enough. So if you apply these 5 scans, you will get around almost 220 names in India. Like I ran this scan yesterday, I was having 236 names. Now, if you want to increase your probability of winning, you can again go back to smaller size stocks and you can look for the potential multi-baggers over there. So this is a bit strict scan. and as I mentioned that what is so common between RS and EPS is that 80% of the names will overlap. Because I have observed that the stock that has high EPS also has that high RS as well. Because this stock actually attracts that institutional capital. So any stock with strong EPS, they attract a lot of institutions, mutual funds, prop desk. So you'll see that the price will behave strongly and it will be near the highs and will exhibit high RS. So you have to understand that you have to pick the names that have just started their surprise. So it's not like that you are buying them when they have reported earnings acceleration for 6 or 7 quarters. In that case, you are actually very, very late. So if you are picking stocks from high RS with EPS acceleration of already 6 to 7 quarters, as I mentioned, that you are very, very late. So other not overlapping names, there will be 18% of the names that will be overlapping. So you can use an Excel sheet and you can find those unique names that are not there in both the list, and you'll find that some 10-20% of the names are having high RS but they are not having that high EPS. So you can have to manually scan for what the management is saying, what the business is doing, and if there is any catalyst. Basically, if you just give me one scan, I'll use that EPS scan. I won't use that RS scan. But if you want, like, I don't want to miss any name, then I think what I learned from Grant's book, The Value and Momentum Trader, is that running both the scans will be highly useful. You won't miss a name here. So now that's a very common question, that how do you spot the strongest industry group? So when I was reading all the newsletters of Dan Zanger, so I came across that he was mentioning every time about earnings. So whenever he traded a stock, he was saying that the quarterly part is up this much percent, the annual part is up this much percent. And then I connected the dots and I was checking like how is he good at spotting the industry groups. So in India we have multiple platforms. So when you run this RS scan, you can just copy all the stocks in industry wise. So if you do that industry wise, you will see that this is my RS scan that I have just run yesterday. So you'll find that a lot of names are from the specialty chemicals. And then we have auto ancillaries, as I just showed you one more name showing that earnings surprise. And we have power stocks doing well here because we are more thermally coal dependent nation and we are moving towards renewable energy. We are moving towards battery energy storage systems. So these power stocks are doing good. And some agrochemicals, as I mentioned to you, that we are monsoon dependent economy, the agri economy, and these 2 quarters will be heavily monsoon dependent. So these agrochemicals, so it is like a bottoms up approach, not a top down approach. Because if you generally look for a top down approach, like what I used to do in the beginning is that I'll be looking for all the indices and then I will be picking up the stocks. By the time indices are strong, I will see that all these strong stocks from the groups have already moved up 80%, 100%. So what I did was like 3 times or 4 times a week, I will run my relative strength scan. Even though the market is in a very bad shape, I will still run this scan. And I will pull up all the data industry wise and I look for which industry has the maximum stocks. And as you know, like we buy stocks as it comes off from the tight pivot, we'll be covering that entry part in a while. So pivot is an area where the risk is very less and reward is comparatively higher. So you get around 4:1, 5:1 or more risk to reward. So what happens is that it's like flipping a coin where the probability is in your favor now. It's a healthy market. So I want to ensure that I am flipping this coin in the strongest of the industry groups. So that's why I'm segregating the scan results into these industry groups, and I'm spotting the top 3 or 4 industries here. So if you look here now, this name I have recently traded, and this stock doesn't have earnings on the table, but it passes that high RS scan. So if you'll see that, you'll say that, okay, earnings is accelerating, I mean the losses are reducing. But if you see here, that's kind of a turnaround play as discussed by Minervini or Peter Lynch in their work. It's more like a turnaround play. The company is loss making and it's moving towards profit making here. So this stock has high RS, and if you look at the chart has also made a 100% move because the stock is moving in the anticipation of earnings. And this business is into vanillin. So recently USA has imposed anti-dumping duty on China. China was a major player of this chemical. So this Indian company has now its golden time running right now. And that's why you will see that the stock has also made, it's a quick doubler. Within like 1 or 2 months, it has just doubled up, and all because of anticipation of earnings. So that's the second scan that basically I run. Now, you'll say that, okay, some stocks will be recently listed, like they are listed within a year. So they don't have enough data. They won't be passing your earnings scan. They won't be passing your relative strength scan because some stocks are just listed within 2 months. So why within a year? Why not 2 years? Why not 3 years? Because after 1 year, these stocks will compete with other stocks on relative strength scan. That's why I am focusing on only those IPO stocks that are listed within 1 year. And they have market capitalization, whatever you want. In India, we use basically more than 500 to 1000 CR. 500 approx in Indian market, and price more than 50 INR. Those are all the liquidity filters that you can apply. When I run this scan, I can show you in my watch list. So again, I have that industry grouping here. I have some 85 names in the watch list. So recently you will see that these IPO stocks are doing good in Indian market. So we quickly get to know that the money is moving to these recently listed names. So these scans are really useful to spot that IPO names here. So if you look at here, this is a quality power, again a power and a transmission and distribution kind of proxy play here. As I mentioned to you that we are thermally dependent and we are moving towards these renewable energy grids and battery energy storage systems. So all these proxy names are doing good. So this is one scan that, so now this stock will not pass your relative strength scan because this has not been recently, it doesn't have enough history. This stock will also not pass your EPS scan because if you'll see here that it doesn't have 2, 3, 4 quarters of earnings history as well. So that's why we are running this IPO scan. Now that's another stock again from the same proxy play of power sector. I bought this here as it was coming off from this tight pivot and it was just hovering near the moving average. Whatever you call it like a moving average shakeout and a very tight pivot here. So I bought it as it came off this base and then a standard breakout buy here. And again IPO scan, and this had an earning gap as well, that unfilled gap, and I was looking for basically what you say like PED, post earning drift. So after the earnings it went up and then it went sideways, so gave that one least risk entry and went on with some 14% position size here. So if you look at the entry setup of mine, so if you have any doubt related to relative strength or IPO or EPS scan, because I feel like these are the 3 scans that gives me almost all the multi-baggers in advance.
No questions. Just I really like the tables that you showed because it's almost looking for like a range breakout, but in the fundamental numbers itself. Just like we're looking for a pivot breakout on the chart, you've got a range between 70 and 80, and then suddenly it reports 100. Right? That's exactly what we're looking for, both from a fundamental nature, and then it's very similar to the technical breakout.
Yeah, correct. True. So that's what I observed. Like when we have, I was looking like past winners, and I saw that okay, all of these have that price breakout. But what's causing that price breakout? So when I went back to the earnings, I saw that they had breakout in their earnings as well. So usually in most of the books that I read, they were like you have to wait for 2 quarters, you have to wait for 3 quarters. So earnings will already be on the table. But when I observed is that that's the first quarter surprise where you can track them, and the second quarter is basically that quarter where you get that 90 days of time to
Hmm.
prepare for it, to do your homeworks, because that's very important. When I learned technical analysis, we all were suggested one and the same thing, that okay, this stock has earnings now, you don't have to trade it because it will be very volatile, it will be very choppy. So what happened is that when I look for earning surprise, and then now I have 90 days to prepare. I know what the management is doing. Now the management says that we are announcing one capex that will be over in another 2 months. So now I'm sure that the earnings may be better. So the probability of the stock blasting off will be high, because there are some auto ancillary names here. They say that okay, the government is making mandatory to have air conditioners in trucks here also in India. So we are planning for it. We are getting first order. We are getting 2 orders. Now when I have read this bit of information and I have that earning surprise, now in the next quarter I can probably hold a 6-7% position size in that stock, because now the probability is in my favor that okay, this can be a positive acceleration because I have already read what the management is saying. So that fundamental shift in my mindset came like, instead of waiting for 2-3 quarters of earnings on the table, why not look for the surprise when the car just speeds up on the expressway and you want to catch it there itself when it crosses the threshold limit, instead of waiting for 3 quarters? So that's why I spotted like they all were breaking out in terms of profitability as well.
And one more question, if you don't mind. How often are you running and updating your EPS scan, the RF scan, and the IPO scan? Is this something you're doing and reviewing daily, or do you do it on a weekly basis? How often are you running those screens?
So that earnings scan I run once in 7 to 10 days, because the list doesn't get updated much. What gets updated is that I have some liquidity filters like the dollar volume in that scan. So if I run this scan after 10 days, what will happen? Let's say I have 150 names now. After 10 days, there may be 154, because maybe 4 stocks have got that liquidity criteria met. There were buyers coming in after the earnings, but hardly any change. So EPS scan, if you ask me, once in 10 days I run this scan, but every day I scroll through this list. So the fresh names are not coming into the list, but me checking this list. So just 2 days back, I was in Mumbai. I didn't have time to scan, so I just went through my earning list. It hardly takes 5 minutes, and I have the setups ready. I can trade with less headache. RS scan, if you ask me, I run that almost every day, because we have a platform here in India that takes almost around 5-6 minutes to track. Even deep view, if I use, I'll just get like all these high RS stocks and I'll get that in 5 minutes. So RS scan, if you ask me, the more number of times you run, the better it is, because you will be constantly aligned with the market. And IPO scan, as I mentioned before, these are just 80-85 names. You don't need to run this scan every day, because
Great,
every day there is no new listing. So
great.
EPS and IPO, you can be lenient enough, but for RS scan, I do this every day.
Yeah, great. Yeah, I think that's all the questions I had on the fundamentals.
Yeah, so once I run this scan, now the next part is very important, like how to enter them. So what am I basically looking for? I am not boarding a running train. So it's like when the stock is extended from the pivot or from the base, I'm not catching it, I'm not buying it. I generally wait for the earnings drift. So these are all my setups. So first of all, when I learned trading, initially I was fixated to just one setup. It was like whenever I spot a tight consolidation, I will buy. If I don't have that tight consolidation, I won't buy. So then I read more about Jill Morales. I read his all the books, In the Trading Cockpit with O'Neill Disciples, Short Selling with O'Neill Disciples, all the books, and all his newsletter, Dan Zanger's newsletters. and all these chart patterns by Sir William Giller, Richard Schebacker, Edwards and Maggie. Then I saw that, okay, there are some more areas where I can just play around. So I am preferring the long base. Long base coupled with tight consolidation, it's much better. So gap filling setup is what I'm looking for, where there is a downside gap in a stock. I'll show you multiple examples. And then the stock comes back up and fills that gap. Flags and peanuts, very common, high trade flags. I am looking for pullbacks from price support or key MA of 21 or 50 days, not 200 days. Because by the time the stock touches 200 days, I think it's already down 20-30% from the top. So I'm much more comfortable in buying the pullback only from 21 or 50 days. And then shakeout at 21 EMA or 50 EMA also you can add. Shakeout is basically when the price breaches that moving average and comes quickly back above it within just 2 to 3 days. So that's what shakeout, it was usually called as bear trap by Richard Schebacker in 1930s in his work. Then William Giller, he wrote a book, How Chart Patterns Help You in the Stock Market, in 1970s. There on page number 88, you will see a figure on the left hand side that depicting that shakeout. And then Jill Morales also called it as undercut and rally. So by whatever name you call it, the basic concept stays the same. The price breaks the moving average. Now in all these 5 setups, I'm looking for one criteria, that should be the tight consolidation. That should be there. So what happens is that you can say shakeout is more like it just went down below and then comes back quickly up. Here I can take an entry. But on all basically other parameters, other setups, I'm looking for the tight consolidation. So what happens here is that why tight consolidation? It should be first of all less than 8% deep. So why am I doing is that because if the stock comes above this consolidation, breaks above this consolidation, I can have a maximum stop of 8%. Usually my stops are in the range of 4%, 5% maximum. Rarely I go above 6. But I look for consolidation of less than 8%. The shorter the better on the right hand side. And base low I keep as my stop loss and I take 1% risk per trade. And I'll tell you why. Earlier what happens was that I was learning a lot about progressive exposure. So it was like you have to start with 0.25% risk and then 0.5% risk and then 1% risk. Personally, my problem was that initially when I take 1 or 2 or 3 positions to test the waters when the market is coming off from a correction, and by the time I go to 1% risk, the market is now very near to a pullback. So it has already ran up 15-18% most of the stocks and I am late in building my position. So I observed this flaw in my approach and then I decided that okay, I'll be taking 1% risk per trade, but how will I manage? How I will manage it, like the stop loss will be base low, the consolidation low. So let's say the stop loss is 5% deep, so I can build a 20% position size for 1% risk. Now what happens is that if the stock squats back below the line I have marked as the consolidation high, let's say the stock breaks out, so the range, the consolidation is from $95 to $100. The stock breaks above $100 and I'm buying it. I'm buying within 1 to 2% of the high of that range. So if 100 is the high, I'm buying it max by $102, not above it. So what happens is that once I buy and the stock falls back below 100 within the range, I trim half of my position. So even though I have taken 1% risk, I will still lose less than that. So in this way, I don't want to hold the stock fully when it is going down. I want to hold the stock fully when it is going up on a full position size. So what happens is that in this way, when it just drops, I have half the position. And the advantage in this method of mine is that your position size is heavy when it moves in your favor, but you are light on your position size when the stock is not in my favor. And I'm deeply influenced by Dan Zanger's quote that winning horses don't come back to the gates. So I have observed in lot of the past winners is that once they leave that consolidation area, they just never come back. They move for like 100-200% gains. The stocks that usually squat down, I have observed that they trouble you a lot after 20-25% of moves. So the strongest of the names are the ones that leave the consolidation zone and then they never return. I have observed in multiple examples that they have moved almost 200-300% after crossing the pivot. So for example, this was my big winner in almost last year. If you will see that this stock, once I traded, I tweeted around this level. So if you see here, once it left the consolidation, it never came back. It never troubled you. But what happens is that I have observed that when a stock breaks the consolidation high and comes back down, I don't want to keep it fully. I want to keep fully only those stocks that just never come back. There I resonate with what Sir Dan Zanger writes. So I enter these stocks like this. So I have some recent examples. Now that's not an hindsight bias. So this is like all recent charts till yesterday because I was not aware what will happen today. So now here, that's the breakout area that the stock moves up on very, very good earnings. It's a CDMO name. So here in India, we have contract development and manufacturing organizations. These are some pharma companies, agrochemicals, because world over the labor cost is very low in India. So all these companies from USA or Europe are coming to India for their manufacturing, low cost manufacturing. So that's what we call as like CDMO. So Jubilant Pharmova anyway has a radio pharmacy business in USA. So they have their highest revenue coming from US. So if you look at the chart, the stock broke out from that consolidation zone and then it had a squat. So what Mark Minervini calls that squat, what Richard Schebacker calls it as hard pullback. So in technical analysis in 1930s, we used to call it as hard pullback or throwback. Then Mark Minervini wrote his book, Trade Like a Stock Market Wizard. He called it as squat. And what happens is that recently there is a trend in Indian market from 21st June that a lot of stocks after the breakout are squatting back below and then they are giving you a reversal recovery. So I have marked the chart. So now what happens is that this stock passed my earnings scan. It is in an uptrend. Now right side consolidation I got. So this base is roughly 5.5% deep. So once it just crosses this line, which will be my alert, I can have a 20% position size. So I can have a 20% position size for 1% risk. So what happens here is that if the stock just blasts off in the air, I am having full position size. But if the stock after my buy, it moves up and then suddenly falls down back below the line, I am trimming half of my position. And I am keeping the other half stop loss at this base low. I will not remove that. I will not sell the stock before my stop loss is hit. And there is a reason, like a lot of people ask me that why don't you exit this stock? Now, if you read Darvas in detail, he mentioned that I decided to let my stop loss decide. So we are not experts. We are not that level of experts to identify market top precisely every time because we don't know how lower can it go. It can just end up its correction for a 4% fall or it can have a 40% fall. We are not aware of that. So that is why these stop losses act as a cushion and they are also my guide to tell me that the market is hitting a broader top. So that is why once I trim half of my position, this stop loss I will not remove. I will hold half of my position because these positions are not only for giving me the loss. I mean, that's not only for the loss. That also acts as a guide that if I am holding 6 stocks in my portfolio and all of a sudden someday 5 stocks hit my base low stop loss, I will be automatically out of the market without any question asked, and I'll not then come back again in the market without having some test buys of smaller position size. So now here, that is why I'm not trimming the rest half of my position. Now that's another example. That's a gold financer company. So basically you go to them, you keep your gold and then they'll give you loan. That's their business. So if you look at the tight pivot here on the right hand side, you look at the prior uptrend, You look at the right side consolidation. That's what I am waiting for. I'm not buying it here. I'm not chasing extended stocks because I have burnt a lot of my hands before by chasing extended stock. I buy them and then they sleep for very long, or either they pull back very deeply and my stop loss is hit. And also I can't build a bigger position size here. So I will wait for my setup always. And that's a 3.5% stop loss, which gives you a cushion of 25% position size for 1% risk. So if this stock breaks above this level, and now that's also the yesterday's chart, if it breaks above this level, I'm going in with a 25% position size, and as usual, if it drops back, I'm trimming half of my position, but when it is moving up, I have full size position with me. So that's Mangalore Chemical. This company has also been a phenomenal runner, and if you read a book by Jack Schwager, Market Wizards, you read that interview by David Ryan, he says that the stocks that have already doubled are likely to double again. So if you look at that Mangalore Chemical, they are into a fertilizer stock, so they are being merging with one company. So look at that tight pivot once again. So I trade lot of these tight setups here, and I learned this from Dan Zanger. So basically in my early years, I was looking for VCP. So I realized that not always you will get VCP on the chart. You will not always have that volatility contraction of first contraction, second contraction, and third contraction. You have to play around with chart patterns as well. So that's what I learned. So it's like a very, very tight consolidation on the right hand side, a 4.7% tight consolidation, and I can again go in with a 20% position size. So I'm really looking for that tight consolidation on the right hand side. So that's a cup and handle base in making, a very recent chart. The structure will be broken after this. Again a 5.5% risk here. Prior uptrend, if you look at this gap here, that's an earning related gap. This company is into, they make coffee basically. They supply to over 90 countries. So they supply even to Nestle. So they are white label manufacturer of coffee. The name is Continental Coffee Limited. So we have a very good coffee season going around, and there is high demand in India as well. So they are selling their own brand also. So if you look at the chart, we had an episodic pivot. Now if you want to just buy it here, you had one pivot here as well on the right after the earnings day. Now you look at what happened is that you don't have to chase the extended stocks. You have to wait for the setup. So once the setup is ready, now the setup is ready, and it offers me around 20% position size. So that's all mathematics here. If I flip this coin multiple times and I get 4:1 every time, I want to flip this over and over again. So if I am chasing here, I can't make a bigger position size here as well. So that is why I'm waiting for the setup, a 5.5% position size, again a long base, a cup and handle pattern in making. So if you look at Reddington, again a breakout. They are into iPhones, so they are making those iPhones here, some parts of iPhones. So that's why the company is going popular in India. As usual, I said like these Western countries are now going towards India, China and Vietnam for low cost manufacturing. So these names are doing good. And there is a trend in Indian market. After the breakout, you have a squat. So understand here, if you just buy here, you have a base low as stop loss. So it is not hit here yet. So if you choke off your trade unnecessarily, you will be regretting later, because some stocks they squat and then they recover faster. So what happened later, you say that, oh, I was holding this stock, I sold it out of panic. No reason for selling the stock. You may just at max trim half of it, but you see that we have a reversal recovery inside, 6.9% base, 14% position size, and by the time the market gains strength, my cash will be over in 5 to 6 positions. So at a time, I'm not holding more than 6 to 7 names. So the strongest ones are the ones where I'm entering a bit early. So that's again a longer base. Now that's one recently I traded this name. It's for like a 3.5% stop loss. I entered at 204, 230, 8.49 is where I pyramided up. And this is again a very bigger position size of 18%. So because it sharply moved up, so I was able to break my stop loss at break even. I'm manually observing the chart. So that's what I mentioned you. I'm also looking for a longer base here. So not always I'm looking for tight consolidation. Sometimes I will have a very, very long base. In the scenario where I have a long base, I can compromise with tight consolidation on the right hand side. In these scenarios, I am buying when the stock is crossing this line, and I am placing my stop loss some 3 to 4% below the line. So this is more like to do with the Sir Patrick Walker. I learned a lot from his trades as well. So it's like he says good above the line, bad below the line. So a very, very simple stuff, very less headache for me, nothing, no brain to apply, because not always you will have consolidation on the right hand side, but the stock has a very, very long base. Because earlier I have missed a lot of charts. So that's a company called as Force Motors. They make engine for BMW and Mercedes and Rolls Royce. So if you just look at the chart here, this was a very, very long base. But what happened was that I was so adamant on finding that right side tight consolidation that I missed this entirely. So what happened was that I had to take some late entry, and then I realized that I read all the trades of Dan Zanger. So I went through his tweets, his media section, there are thousands of trades, and I went through his almost around 70,000 pages of newsletter. They are in my shelf also. So I read all those newsletters and I saw that he's just drawing a line. In those high earning names, just draw the line and he's buying it. And he has not mentioned the stop loss, but I learned that, like from my experience, that if it falls back below the line, 3%, 4% below the line, I'm out of the trade. But at least I will not have regret, because these longer bases are very, very powerful bases. They just usually blast off. And as usual, if you look at this chart as well, right from the base, it has given like 500% move in just 140 days, less than a year. So I realized after missing this trade that time that not always I will get tight consolidation on the right hand side. Sometimes I will have a very, very long base. At that time, just buy above the high and place the stop loss 3 to 4% below the line. If it's gone, it's gone. At least I won't miss that. So now that's the next style of entry. That's what I take is a shakeout entry. I have taken that in multiple trades. So again, to make you recall, we are running that EPS scan. We have all these earning names in our watch list, and we are constantly checking these charts every day for 5-10 minutes. And then we are looking for entry points. So either we'll have a long base, either we'll have a tight consolidation. Not always you will get a VCP, not always you will get tight consolidation. Sometimes you will get these kind of shakeout entries. So shakeout entry is like the stock blasted off after the earnings, it formed a tight pivot. Let's say you miss this entry. Let's say you miss this gap entry. It just squatted back below. It had a very hard pullback. It broke that 21 EMA, that blue line. And suddenly on a very high volume, it quickly reclaimed that moving average. Now that's what we call as shakeout, moving average shakeout. That gives a very good entry point, but I'm not taking a full size position here. I am taking half position here. I'm not taking 1% risk. I'm taking 0.5% risk here by keeping my stop loss either at the shakeout candle low or some percent below it. So here I can get again a bigger position size merely for a 0.5% risk. The condition is that the volume should be a bit high, but if you wait for the volume, you will have to add a bit late. That's why I'm not adding my full position size here. I want to see the reaction of the stock. Now you'll see here that this is one style of another entry that I am taking in these winners in terms of earnings. Now you can also call it as a price shakeout. What Sir Richard Schewacker called it as, he called it as a bear trap in 1930s when he wrote a book, Technical Analysis of the Stock Market Profit. He wrote that book and he called it as bear trap. What does he mean by bear trap is that all these traders who shorted the stock here were trapped because it moved quickly back up. So that's why he called it as bear trap. Sir William Giller called it as shakeout on page number 88 in his book in 1970s. And Sir Jim Morales calls it that price undercut and rally. So if you go to his website, theowltrader.com, you will have a glossary of terms. There you will see that price undercut and rally. So you call it as a price shakeout or you call it as a 21 MA shakeout, whatever you call it, but that's the right entry point here in that stock. So here you will see that you don't have to be fixated with, or there is no inverted head and shoulder, there is no cup and handle, there is no double bottom, there is no chart pattern here, but there is some bit of another entry style here, and then you can pyramid it up at this standard breakout as well. So that's what I'm looking for. I'm holding this stock. I bought it here at the shakeout entry, and I'm waiting for the right hand side base formation. If it just gives me that standard breakout, I'm pyramiding the other half of my position here. So you have two advantages at the shakeout entry. The number one advantage is that even though the stock hits the resistance and had a hard pullback, you at least won't make a loss. And second advantage is that you don't have to wait for always that standard breakout. You can take some early entry at the shakeout as well. I hope this will help you to enter the stocks here. Now, there was a newsletter written in 2003 by Dan Zanger, and he shared one gap filling setup. And there was one gap filling setup in 2009 newsletter. He has shared the chart of research in motion. BlackBerry, if you remember, they had those phones. So in that chart, he shared one gap filling setup, and I refined it a bit further. I realized that he is just drawing one line here and he is buying. But I realized that I am not okay with it always, because sometimes what happens in Indian market, we have a lot of choppiness around because stocks are not so liquid as compared to USA. So what is a gap filling setup? So gap filling setup is that the stock gaps down on high volume, but it is still above that 200 days moving average. So you can say that it must be a very, very not so negative news. It takes support at 50 or 21 EMA. And then what am I waiting for is that gap filling. The stock has to attempt that gap filling once. It can do like 2 times, 3 times, it can make an attempt. But what do I look for is that consolidation on the right hand side here, because that's what absorbs that overhead supply here from the trapped buyers. So number one step in gap filling is that downward gap filling should be there. Number two, the stock should take pause at 50 MA or max to max 21 or 50, not more than that. Number three step is that it should make an attempt, and while making an attempt, it should consolidate on the right hand side. And then my buy trigger will be when this consolidation high is breached. This is the exact setup and the process of gap filling. And if you give me just one setup to trade, I will trade only gap filling, because they are very, very easy to spot. They are not too many also. So if I have gaps on the chart, it's very, very interesting when the stock comes back to fill the stock. Number one, downward. Number two, pause at 50. Number three, consolidation. And number four is the consolidation high should be breached. And I have observed that these downward gap filling setups gives you monstrous moves in a short possible period time. So here is one example. I traded this and I tweeted this as well. So here you will see that was a gap filling setup here, but this stock breached that 200 MA as well. This was an IPO stock. So I had to wait for a very long period of time for it to regain that strength and come back above that moving average. So number one step, downward side gap filling, and then once it breaches back up, so you look at that shakeout entry, it comes back up and then it forms a right hand side consolidation. That's what is very important for me. So if it just doesn't consolidate, your question may be, okay, if it just doesn't consolidate, I will wait for the consolidation here. I won't chase extended stocks, as I said that. So what will happen is that I waited for the consolidation. I entered here. That was my tweet. It will be on Twitter. So it's a downside gap filling setup. This company is into water management theme. At that time, it was a very, very hot theme. So these are the setups I use, like long base or pullback or shakeout or gap filling. So this is what I do. So just to give you a conclusion, I run 3 scans as I mentioned. EPS is my bread and butter scan. I make money from EPS scan. Most of my money I have made from EPS scan, because that's like a techno funda approach. If you miss out some name, if I miss out some name, I want to see, I'll run some RS scan as well, because there will be some stocks moving up on stories, and then I'll run IPO stocks because they will not filter down from these two. So I run all these 3 scans. It throws out some 200 names. I look for price, volume and infant industry in the smaller size market capitalization category. Less than 50 names are left. I prepare this list and I buy them on long base breakouts or flags or tight consolidation. And these are some alternative entry points. If I don't find long base breakouts or flags or tight consolidation, I'll look for some gaps on the chart. I'll look for pullbacks. I'll look for shakeouts. Now someone met me and they were asking like, how do you get conviction? So my answer was like, I don't have any conviction when I am trading because it's a game of probability. So it's like when you are buying a stock from a pivot, once you have entered, it's not under your control. A stock can do whatever it wants to do. It's for you to manage the risk. So your risk is 4 to 5%. A stock can make a move of 20%. So the ratio of winning is 4 is to 1. I mean, the reward to risk is 4 is to 1. Now, if I ask you, you toss a coin 3 times, how many times can you get head? You can still get head 3 out of 3 times. So you can't say that probability of getting a head is 100%. No, because you have tossed the coin for a very less number of times. If you do that more than 1,000 times, 2,000 times, your probability will come closer to 0.5. So if I am trading these tight consolidation where reward to risk is 4 is to 1, then there is no brain to be applied. I want to flip this coin multiple times, and in order to increase my probability, I run these scans, but make sure that you run this scan in hot industry groups or themes. So those top 3 industry groups, if you toss this coin, add those tight consolidation or pivot, 1 is to 4, 1 is to 4, 1 is to 4. I mean, even if I sell all my position for 4 is to 1 and I just continue to flip this coin till the market is healthy, I will make money and my equity curve will continue to inch higher. So that's the whole crux of the scanning process and the entry criteria. So if you have any question, you feel free to ask. If we meet again, I'll cover the exit part as well.
Yeah, this is excellent. I love how you entered it here. I have no conviction in any one trade, but that's why you manage risk and have your stop loss, let your stop loss decide, and just see how it plays out over a long series of trades. I think that's a great concluding point. I definitely have a few questions. First things first, so your universe list becomes about 50 names. What's your process for then, on any given day or any given week, narrowing down to the best potential setup? Is it then just the chart pattern, which ones are setting up tightest, have an inside day, upside reversal, it's right near the 21 EMA? What's your process for narrowing it down for 50 names to, 5 or even 2 or 3 to potentially buy on any given day?
So actually, I have this small list, medium and large list. I told you, right? These are the smaller names I give preference to. I will scroll through all the charts. So that's what I did. Like, okay, now I'll scroll and I'll look for my setup on these charts. So this one is a potential buy. This one, we were just discussing that we may have a reversal recovery. So today, yesterday I made the presentation, so I made sure that I put these charts here. So today we had that recovery above the pivot. So this would have been the potential buy. So if I still have cash left, I will give preference to these kind of names where I have the very, very tight consolidation on the right hand side. So KPI Green, it's a renewable energy stock, but it's bit late, so I will give it less priority. This is a large cap name. Again, I'll give it a very, very less priority. So far we have 2 names. Reddington we covered, so it is still viable. So tomorrow it will stay on the list. So I will be having roughly around, now that's a long base, I'm still hawking around. So you'll see here that I'm still hovering, I mean, potentially keeping this name for probably like another 6-7 days unless it breaks out. It's a very, very beautiful setup. So my process of filtering down is that I am looking for the right hand side chart development. I'm looking for a longer base or a tight consolidation and a smaller size stock. So I will be coming close to 5 or 6 names for the next day.
Excellent. No, that answers it well. Let's see. One thing I did want to ask you is, I I really love how you kept referencing the Dan Zanger newsletters, and having gone through that, I'm sure helped train your chart eye. Any advice for traders out there who want to do something similar, go through a lot of historical charts to build that blueprint, or go through a lot of historical newsletters from a trader like Dan Zanger to help learn how he interprets charts and all that? And any advice for people who want to do that exercise?
So the number one advice is that you need to visit his website. He gives you free 14 days trial period. So in that 14 days trial period, you can literally read a lot and lot of newsletters. And if you can't do that, you can go to his profile section. So you have to basically go not only through the Dan Zanger's profile, you have to go through those top traders' profiles. They share a lot of charts. So when I started learning, I literally went through almost every tweet of Mark Minervini, and I saw that whenever he's mentioning, I went long in this name. I am noting down the date of the tweet, and then I am downloading that chart and I am marking the entry myself on that particular chart. So some of the names were delisted. I mean, I didn't find their charts. So there is a website called barchart.com where you get those historical charts as well. So I went there, I downloaded the chart. This you have to do with Mark Minervini, Dan Zanger, Patrick Walker, TraderLion. So many free interviews available on YouTube channel of yours as well. Go through them. Prepare the chart database. Unless you prepare that database, you will not train your chart eye. Second step is that you have to read the past multi-baggers. So every year find the stocks that have doubled, read their charts, prepare that database as well. Second part. Third part is that you have to study your own trades. So maintain your trading journal, and supposedly, okay, today we are sitting in July. So I will be studying the trades of May. I will not be studying the trades of June. The June month trades I will be studying with a 1 month lag in August. Why? Because I don't want to be biased. If
Gives you a
I
step back.
start, yeah, so if I start analyzing the trades of past week, I will be biased. I will not have enough price data on the chart, and also I will not admit my mistake. So three things: go through the newsletters, go through the free tweets on Twitter, media section. YouTube is full of learning, your TraderLion channel. And second point is that past multi-baggers, and third point is your own trade. So you will have roughly around, in my opinion, you will have more than 5,000 charts with you. So if you just keep on repeating those charts, you will develop that chart eye.
Excellent. Yeah, 5,000 charts. That's a good place to start for sure. Himanshu, thank you so much for sharing your expertise. Was there any other key takeaways that you want people to have from today, or just in general advice for traders out there who are newer at this, or still struggling and looking to make some improvements in their
So if you are
process?
still struggling, then you have to read some basic books, one by Nicholas Darvas, then William O'Neill, Mark Minervini, Stan Weinstein, and the Market Wizard series by Jack Schwager, so that you prepare your basics. And as I mentioned, your YouTube channel. If you are a beginner, don't trade in leverage products. Don't trade like futures and options. Just stay in cash and try out with smaller capital account for initially at least 2 years. Don't leave your job for sure. Don't dream of becoming a full-time trader unless you see 2 to 3 market cycles, both sides, bull and bear. So this is all from my side. I think this will help everyone.
Yeah, perfect. Well, Himanshu, again, thank you so much for your time. I really enjoyed this. To everybody watching, thank Himanshu in the chat. Leave a like down below if you enjoyed. Subscribe to the channel if you're new. And we'll be right back with the next presenter. Stay tuned.
All right, welcome back, everyone, for the next presentation of the TraderLion Conference. It's my honor to introduce Leif Soreide. He is the U.S. Investing Champion of 2019, the founder of Champion Team Trading, and the host of the High Tide Flag Masterclass, his specialty. And today he's going to be discussing some excellent key concepts on thinking beyond the pattern and presenting some excellent case studies off the recent bear market low. Leif, thanks as always for being a part of this. I love learning price and volume action from you. I think you have a great way of explaining things. So looking forward to diving into today. Thanks for your time.
Yeah, thanks for having me. You know, I'm more than just a one-trick pony on the high tide flags, but we prefer those, right? That's the thing. But
yep.
This is
things that move.
Right. So this kind of has a think beyond the pattern is sort of what we try to do. You know, pattern buying alone. Sometimes the patterns, the ones that work they change, and you have to adjust a little bit. I think the real great thing about this presentation is we're going to talk about what was leading off the bear market lows, what that looked like, so you can spot it next time, right? Next time there's a bear market, and that's where you can make just, you know, huge amounts of money getting very loaded off near the lows. You're not going to exactly buy the low, of course, but that's really what I think is key. And we're going to talk about alternative entry methods, so a little tease of some high tide flags, maybe one. Just bought another one today, actually. You know, focusing on liquid stocks. You know, that's something we've sort of moved more into that over the years. We're not buying the thin stuff, and small caps haven't been performing very well anyway. So the more liquid leaders are more obvious, and that's where the money likes to run. And we're going to look at that. And we're talking about the quality of overhead supply and a high tide flag. A little update to your masterclass there. I think something from Oklo specifically, which I think is interesting. And then basic stop placement techniques and such. So, of course, I have to, you know, a little bit about me. If you don't know who I am, I won the U.S. Investing Championship as it came out of retirement after so many years in 2019. I won that contest, and I've been trading since 1996. Finally, it was maybe 2008, I was trading a 7-figure account and have made many millions since. I'm an entrepreneur, MBA in finance. This is like a dating profile. Except I've got the kids already, so sorry everybody. But my favorite pattern is the high tide flag, obviously. Trading influences, obviously William O'Neill. It's all sort of based around that, and everybody below there sort of, you know, puts the fine points on that. Mike Webster, David Ryan. You can watch them on IBD Live a lot. That's a lot of fun. Stan Weinstein, stage analysis, and Minervini with his early entries, and VCP, you know, tightening up of patterns and such as, and actually having a service, and I have a service also. So it's kind of inspiring to see these people actually kind of showcase it and compete in that way anyway, which is a lot of fun. So we do that too. So, so we want to define our stock universe. This is something I do very seriously. We keep the count. We're going to show that on a histogram of how many stocks are in trend. There's a chart on the left that everybody always has to trade, right? That everybody can't help themselves, even if it's out of trend. I don't know if you know what that is, Richard. I'll take a guess. Which one? Right. So that's Tesla. Everybody's always breaking the rules for Tesla, but I'd rather not break the rules. There are stocks that were trending from this bear market low. You see the S&P 500 above that on the chart. So I wouldn't trade that. I stick to I stick to my universe, and the number and the count actually matter. You know, the moving average is actually over each other. The 50 over the 150, or starting with the 200, and then the 150 over the 200, and then the 50 over the 150. That sort of sets your bases correctly, right? So you have the right sides and develop bases, and right sides that could be tightening up there. Without so much overhead supply, that kind of solves a lot of that problem. Like this chart has a lot of heavy overhead supply. And Tesla did sort of bounce from this slide here. This is from the past here, but it kind of chopped around the 200 while other stuff performed a lot better. So, and the reason, one thing I say is never be mad at yourself when you're trading, when you get something wrong. It's really only when you break your rules or do something foolish, like, you know, only this time or whatever. I'm just going to trade Tesla right here. I mean, I get why people do it, but I'm just very, very specific about it. It's got to be in our wheelhouse. And we do have some different rules for IPO bases, liquidity requirements and such. I try to trade 90 plus RS ratings for market surge. That's what I prefer. So And the count of how many stocks are entering or leaving your universe is kind of the key indicator that we came up with a couple years back, and we sort of plot that on a histogram against different indices, especially small caps. They tend to kind of mimic what kind of performance you could see trading randomly, right? But the more liquid ones have been working great, even though those were not. So this is Tesla, and it's sort of out of trend for me. Just this slide just shows that I always use a stop. So anything I say, if I'm interested in a stock and I bought it and it's down 10%, you can assume I'm already out for 5% higher. That's I always have a hard stop as soon as I buy something. And of course you can move your stop depending on your signal. Always work on your market signal. Something like this, like ASTS, this round trip I got out, got back in, and then once that breakout candle is there, you're adjusting to even, just sort of like I did before, for the most part, if you're pressing more risk and pushing your luck. And sometimes you'll have a whole sequence where everything just round trips, and that's part of the game. So alternative entries, you want to get a little bit creative. You want to look at pullbacks, earnings pivots is something we're going to talk about, post earnings pullbacks, and something we did with Rocket Lab recently. I don't have it on the slide deck, but that's a good one. Got to find what entry works best for you, obviously, and look at your stats and figure out, are pullback buys my thing? Are breakouts at new highs my thing? Sometimes 52-week high breakouts are too obvious. You want to put a little bit of you want to get ahead of that, because once you get to highs, you can bounce around your 5% stop. It could kind of easily lift it, especially in a choppy environment. So you got to have that situational awareness. And breakouts are sort of best when the market is forcing everything higher. The indices are really going there. So you want to get maybe as low as you can pullbacks and cheats and stuff like that. So cup and handle. One of the things I like to do is sort of fish a low in a handle. It's just basically a pullback buy once you get to the highs of the base. Imagining this cup, and this one here, Corsi, went to about 19 from there, but we're already even in way earlier. But you can fish that spot. It's just a overall example, and you can see how you can imagine this cup and then handle, and you want to get some kind of a tight area inside day and a turn from there using the daily highs is what we do. So high tight flag definition, this is in the Masterclass. I recommend that. It's a pretty fair price. I don't know what it is. It's not much, but check that out. We did that. I think we're going to do an hour, Richard, where we do like 6. So and we have people that wrote me and said, I think somebody watched it like 10 times. So it's kind of interesting. And hey, if that's what it takes, you got to burn it in the brain. Get all the examples. So when you do see it, and the environment has to be right. They're not always flying all over the place, but the number of them matters. And like we're starting to see several of these starting to work, whether it's Oklo or the small nukes or other names. So once again, they're all in the can. The can slim background is key, but for high tight flags, the N in can slim, and I think the N really in growth stocks is kind of key, just in general. So it's like a lot of comments from the Masterclass too, where it really helped my overall swing trading. Like if you can handle a high tight flag, you can probably handle a regular base. It's probably a lot easier actually, but your stats are probably going to be about the same, and I think the high tight flags go farther. So, and that's the class is here. This is just a screenshot of your website, I guess. So that looks, there's me right there. So check that out. High tight flag, the breakdown, you're looking for the flagpole. You don't want a lot of overhead supply in the flagpole. You don't want it back to recent highs necessarily, but sometimes on these ones that are just small nukes and stuff, the power comes and goes. Everybody's eliminated, so you can kind of discount some of that overhead supply there. So you want to use those tight areas and handles, and this went on for like a 10 bagger from this original buy here, but I'm probably getting in and out as it goes. And sometimes it is easier just to hold, and you got to decide what type of trader you are there. So you want to trade around that 100% rise. So we also have, we call rocket bases, right? So it did pull back more than 25%, but less than 50%. So that just might need more time. So it's just very strong base from that kind of a rise, there's something going on there. Just needs a little more time. So we look for like 6 to 10 weeks instead of 3 to 5. Then we have something called low tight flag for the special situations that are not quite the high tight flag, but look like it, but they're even tighter, hopefully like 15% or less in the flag. So sometimes they fail, but they're going to set up later. You want to be trading around these stocks that show all that power, and that's kind of what we do. And here's a scan. This is from Deep View, and you can use this for stockcharts.com and get that syntax. And we're going to get through this because the fun thing I'm going to do is show a bunch of trades off the bear low, and I just love talking over the charts more so than like presenting, right? So we can talk about that. So Axon, this is from the class actually. You see how far these high tight flags can go, and this one was a rare situation a long time ago where there's 3 in a row, and it's actually a pretty great stock recently too, Axon Taser. So this had the N factor, the new, so that's important there. And of course, more notes for high tight flags. You can pause this and take a look. Textbook setups. That's where you want to be. You want it to look good. You want inside days and such. Quality. You want to move up the quality. You probably want $10 plus. I start at 5 and up, but you want some liquid names. You don't want almost no volume. You get trapped in a stock, and you might have some breakout traders trying it, and then everybody just panics out and blows out. So you want some liquidity there, so you can see if you can get a look at it and take a manageable stop if you're wrong. So, of course, the group is important. Sometimes biotechs they can have news that cause these things too. So, and I've sort of moved away from biotechs over the years. There's just too many other stocks that aren't going to give you a heart attack when you're. And I never really got blown out in one, but we came close once or twice. Something last year was down like 30% in the pre-market and just snapped back to even. Just some crazy stuff. So we sort of moved on from a lot of those for the most part, unless they've got real earnings and all that. So, so when to buy a high tight flag? Obviously, you want tight action, average true range. We use that to see that declining. It's not always the case. The look is probably most important, but if you're scanning, you want to see some kind of tightening, and you can do that with regular bases too. You want to see the average true range tighten on the right side of every base, and you want to see that rising RS line right into the buy point, and layer all these things on. Diagonals, we put some emphasis on it if it's at a horizontal pivot, and these things kind of you got the confluence of different indicators that are going to improve your odds. That's something to then you want to target that stock basically, right? So the fun thing, we had Oklo, and this is I think it popped a little bit the next bar here, but just sold most of it into strength there. And the fun thing about this was we sort of discounted the previous overhead supply, just very deep base here, but we just looked at this as everybody that bought at 70 and held down to 20 is wasted, right? They're completely out of the trade, or they're going to hold forever. So I think that we tend to look back a year or two, but this special case where the theme got so hot, we found an inside day and just played it. So in a tough environment, you've got the Middle East conflict, and then we're buying Oklo in a high tight flag. So there's definitely a lot of power in the group there. So we're playing with that one, and shakeouts. We can do a lot of re-entries up to 3. If you don't get it right the first time or second time, I tend to back off. And this is what I've been doing with MSTR actually in the recent handle in June just was not really working out here. So we switched to IBIT, and that's a little bit better. So if it's not working out for you, there's maybe you won't be surprised when it tanks later. So and then you pause these slides and take a look at when to sell. First targets depending on the signal. If you're on a great signal where everything's working for you, you maybe want to take more than 2 risk multiples before you take anything. If you're in a total chop fest, you're probably taking something very quickly, like we did with Oklo. We took like a 20% scale and then moved the stop to even. It never hit it, and then we're selling when we get that 30% rip for the most part and keeping a trailer. So, and like I said, Celsius did about 900% from that example there, and we're not really looking so much at China names anymore, but the lower quality names tend to move in those interesting environments and they sort of all round trip. So you really need to sell those to the strength and kind of be smart about your risk management. So, all right, so earnings pivots here. This is something you want me to go over. It's a really interesting thing I think we not really discovered it, but you get a moment where you discover that earnings are creating the pattern a lot of the times. It's drifting into earnings and it's waiting for that confirmation. And then you get this tight area or pivot that people tend to try a day or two before. And I tend not to do that because you're sort of just gambling. Maybe you get up 3%. Maybe you just go take a stop right ahead of it. So I tend to wait for earnings and then trade it after that. In fact, KRMN, so this one went into earnings here and shook down and then went through the buy point. And we're a little more aggressive with the IPO basis. We have some different rules for that. So that was an add point, and it was very on theme. And this IPO looks like it's a successful IPO, so you want to try that. And we don't chase gaps on these more than 1% to 2%. Some people do those earnings gaps. I don't do that unless it's at the correct buy point. So you get out 1%, maybe I'll try that. So especially if it's a larger base. This IPO base is interesting because it's a little shorter. So great earnings at an ideal buy point, or at a great buy point, is ideal. So standard buy points are really best when the price drags into that. So that's what we've been working on there. And another example here, you'll take a look at KRMN. We have CPNG. This is one that I took here and just sold that into strength because it's this larger base I've been playing with. I tried it back in here and I think it was profitable. I had to get out. Got back in, sold it into strength, and retried the sort of the high handle turn there. But you get these larger bases, and you want to get the earnings pivots on the right side of the base. And the price, I think, sort of is waiting for confirmation that you're getting that beat and raise. That's what I typically want to hear. Great environments is kind of more of a binary move. You're sort of right away if it's pushing through the buy point or not, right? It's a lot can happen. It can fly all over the place, but for the most part, it's sort of binary. It's kind of 1 or 0, just straight out or straight down. So this one was interesting because it had this bigger weekly base, and you want to see that. So I'll try to target those earnings pivots with larger bases on the right side, and that one worked. And we're re-entered on this little mini handle turn there, and just kind of floating around for now. But it's a Druckenmiller name, and online retail is something we're interested in here. So,
and just to clarify for folks, the buy point for the earnings pivots is through a recent short-term resistance level, either through the prior day high, or here in this case there's a little range that forms there. Anything you want to add on that?
Well, it's just a little pivot. I mean, you're going back to this even 2407. You draw a line across that. Spot. So it's a little bit low in the base there over the 200s. Maybe not trending, but I think this thing was ready to jump out of the base finally. That's what I was betting on. So a little different rules. If you find any tight area, it's definitely over the 200-day moving average. So some of these this moving average down there it has to catch up with it now. But so we sold that and rebought it as just a regular swing trade after that. So. All right. So one of the things I always say is think beyond the pattern, and really. Pattern buying alone, I mean, I hate to say it, but it's just kind of like can lead to average performance. You just buy this pattern or that pattern, it's a tight area, and you're not putting a lot of thought into it, right? So you really can't kiss all the babies. I mean, today was a pretty good day overall, and there's too many stocks to trade, so we sort of had to focus on what we thought was, the best themes and groups and where the money was going, and just random pattern buying. Sometimes it can help diversify you different groups and such, but you sort of want to be concentrated in stuff that's working, and you got to know what's working. Bigger liquid leaders, is growth versus value working? Sometimes you got to get back into your leaders. I mean, I've been doing a lot more of that recently, sort of selling into strength and adding back, keeping the same stocks. And there's a lot of traders that I trade with that are going to be more long-term, and that's maybe more what they're looking for. They just want good entries or something like that, and they're going to hold for the long term using moving averages. But we're always checking for upgrades, like upgrade at a buy point, and it's something you've been looking at. And one of the things too is just if you haven't been looking at this stock that you're just about to buy, and you just look at it on the day and you want to buy it. Where was it 3 days ago, right? It's like, this is something you're not ready. You got to be doing your homework. Lone wolf trades are kind of lower odds typically. You got to match it to the group or the theme. Typically, right? Anything can happen. You know, that Tesla could go to the moon, like I showed in the first chart, but I won't be mad at myself for missing it because I don't trade that. And that's what I was saying about, don't have a lot of anger at yourself ever. Always talk positive about yourself, but stay in your lane, do what you do, and this is not a casino, right? So you got to run it like a business. So this is the fun histogram up to the bear market lows, and we track the IWM pretty closely. IWO is IWN plus IWM is IWO plus IWN is in Nancy. So the value and the growth component are both in this. IWM is the more liquid one, so we're sort of focused on that. And this had this perfect, I wouldn't say perfect, but pretty close to sort of like ABC move. We thought really everyone was overreacting to the Trump trade deals. If you look up what he did last time, is kind of very minimal overall tariffs and such. Versus this time, he put some very big numbers to it. 100% tariff on China, and then took it off, and we figured he would do it. So this didn't have much more legs to the downside, we thought. But you look down here, there's nothing to trade, so you don't have to do anything. There's no pressure when the stock's in trend, and it kind of fakes you out. You sort of take a signal change and roll back down. So your signal can be false too, right? When you start to get some stuff working and then sell out again, and start, you realize there's nothing to trade, and then that starts picking up, and that count starts picking up, and then you're buying the leaders as the signal changes and getting that right, and then going to green signal as quickly as you can once you realize that that's the bear market low. And I think April 7th was so.
Yeah, and for everybody, the histogram on the bottom is mapping the number of stocks that meet your particular trend filters. Right. So we're seeing basically breadth expand and confirm off the bottom low.
Yeah, this is TC2000, the special data package that you have your daily count of everything that meets all the stocks that are in trend, and the liquidity requirements, the $5 plus. And all that stuff, you can change it to match what you're looking for. Maybe you want $10 plus, and that's probably where I should be. But we've been consistent that it's $5 minimum, because maybe we'll try a $9 one that sets up absolutely perfect, right? So I want to have a little bit wider net, but that's what happened at the lows. There's nothing to trade. So once that starts building again, and shorts aren't working. I mean, I'm in here poking at some shorts. We're trying to get a feel for what's going on, and that's the way I do it. I'm a little more active, but the sizing, when things aren't working great, you're small, you're on red signal, there's not going to be a lot of damage. Okay, you're 25% or less invested for the most part, or maybe just cash. I mean, you realize we're sort of in a downtrend, going into a bear here. So, and there's a lot of lessons to learn from the recent bear. You see the chart there, what it looked like, kind of undercut all the way back to a year prior there. But there were several leaders that really never touched the 200-day moving average. And so there was really no need to catch that April 7th low and just index buy. I think we did better buying the leaders coming out of there, because leaders are going to lead, right? They're going to kind of outperform, and we want that outperformance. One of the things I would do, maybe, I have some different rules, and one of them is, in combination with other things, is the VIX hits 80, I'll market buy the index, basically. So, but we didn't get there, and there's no need to do that anyway. You'd probably rather have the stronger stocks coming out of it, but you got this great undercut. And what I think the best way to do is to learn how to trade from this is a walk through the trades we did in order off the lows. And it started with Spotify, and we were pretty accurate with what leaders we were buying. And you'll see the reasons yourself and understand how we came about these. It's not like we're reading Barron's or watching CNBC trying to figure out what leaders are. It's just how they were acting. And, some of them ended up being more sluggish than others, and that's going to be the difference in a contest winner versus a contest like decent place or just, beating the market. Managing these properly, you'll probably beat the market. But if you want to win a contest, you sort of need to be concentrated in just a handful, 3 to 4 stocks or something like that. But you know, I tend to, you only have to get rich once, so you know, it's better for me to spread it out a little bit and kind of get that same performance off the lows when you're getting, you know, 3 stocks very quickly that go up 30% versus one that maybe you take a stop on, right? And you take your whole account in that. So I'd rather spread out a little bit myself. Obviously not in the contest, and we have a lot of contest players, you know, on champion team, and somebody was up 100% the other month, and you know, we had Leif almost had the record last year. So it's fun to see what they're looking at and how far the leaders go and how good they, you know, are at finding the leaders. So, and that's really the key skill that I think everyone needs to identify, is finding the leader is really the most important thing. And we're going to go over that right here. We're going to talk about, I sort of did a talk with Arusha once, and I sort of came up with it on the fly. We called it careful concentration. And it was like, you know, how do you get 40% invested very quickly in something, right, without just buying one stock and putting a 40% size on? You sort of identify a group, maybe it's semis and they're all looking good, breaking out one after the other, and you go 10%, 4 times, now you got 40%. As you're moving up stops and taking profits or something like that. So that's sort of the way I run the service, is sort of champion team trading. A little more active, but very quickly kind of getting into a few. And obviously you got to do your own trading, and the contest traders are going to pick what they think are the leaders and stick with those with size. Obviously you got to use margin. If you want real outperformance, you have to get comfortable with that. But that's not for new traders. I'd say give it a couple years before you start messing with that. And like I said, I've been doing it since '96. I was very bad when I started, 1996. I was 16, and you know, blew out almost within a few weeks, and haven't blown out since. So that's good. You got to be careful with contest trading and margin, but you know, we tend to showcase those ideas. So yeah, one stock up 30% or a few up 30. It's a little bit more risk averse to go one after the other, maybe 1 or 2 in a day, and continuing up as you can see the market's holding to. You don't know the market's really going to hold either. So you want that confirmation as you're adding your risk, and moving up the stop kind of de-risks a lot of it. You know, obviously pending gap risk, anything can happen, of course, but just some thoughts there. So something interesting to think about. But so the technicals really gave the clues, you know, which stocks were leaders off the low. So if the bear is quick, you sort of look to the same leaders. Really very little change. You know, some tariff news, some inflation, kind of all the same story. So whatever stayed in trend, that's your leader, and they're probably going to snap back. So we looked at something like SE. So I traded that back in September for pretty good money. As it sort of touched the 200 and tightened up against the higher low in the market. You can see the S&P 500 on this market search chart behind it. We're trying to use that as like a little cheat there. And the patterns weren't exactly perfect, but off a bear market low, I just think that getting into the leaders is more important than patterns. So you want to use the sort of the spirit of a pivot or something. And I borrow that from Mike Webster. He always says spirit of something, and that sort of sticks with me, because we're getting a horizontal pivot. You know, you're coming off a bear market low, things are going to be volatile. So you're just trying to get exposure as things are turning up. And the market, if that snaps back, and it did, as it got that higher low, and we're starting to, you know, hit some of these stocks, there was a lot of runway in the market to push these up. So besides looking at the same leaders, you want to look for sort of like a lot of double bottom patterns we're going to show. Like I said, you're not going to get perfect pivots necessarily. If you're waiting for the perfect textbook thing off the bear low, you're going to be waiting till there's the next bear market probably. So that's not the way to do it, in my view. If you think you've identified it, and we're testing a few, we're not going all in. You get one right, then you try another one and say, okay, is this aggression worth it? Is it working? Otherwise, we're dialing it back. So it's not like we got some crystal ball and it's a call. We start buying, and then we get the confirmation, and that's telling us we're right. We don't know we're right until the stocks start going up. So that's a little look at SE there. So this is at the exact bear market low, April 7th, all these charts. You have Spotify in the top right, Netflix, Take-Two, and Palantir. And I remember reviewing these constantly and just thinking, I don't think we have too much more downside. It's just getting these kind of undercuts on that low day. And these didn't even touch the 200-day moving average. So it doesn't mean they're just going to bounce and for sure going to go up. But I'm thinking, I don't think we're going into depression. They didn't whack these. You're in your bear market measurements 20% plus off the highs in the indices. And they really couldn't take these down. So somebody was supporting them and was telling me that the power is probably going to come back at some point, and then you want to target these. So this is just a little review of, that's what it looked like at the bear low. These were my key stocks that I was looking at. And I was also messing with some shorts in there, and I wasn't getting any results, like I said. So it's like we're playing around with we're testing some long and short, but really the stocks and trend were disappearing. So the short side was the only side that really made sense. So you look at Palantir, sort of a key leader, almost looks like a big head and shoulders, but then undercut, and then it tightened up from there. And we'll show the buy we did there later. All right, so the first buy we did was Spotify, and I've traded this in the past. Actually the start of the year. We're trying to get this kind of early entry. This is spirit of a cheat. Things coming off the low. Sold some into strength and stopped even. So we're not getting great feedback, but then we see that, okay, it bounced back up, and we targeted it later. So making any kind of profit on it was kind of a clue that, okay, we're able to sort of get some stocks moving here, and it's an early clue that, okay, we're going to start looking more long. And then you can see the market, what it looked like here. You get this higher low, and then it shook out, and we had MSTR on the left side, the double bottom base right on the 200-day moving average. So you go into a bear market, and all it could do is tap the 200 and stay in trend. And on the entire chart, you really can't even find a tight area except where we bought it there. So we're selling some into strength and getting out there. And I did try to re-engage it in this handle for an even stop and a 1% stop, and just kind of getting messed up in this one. And switching to IBIT today, which is actually nicely on the move. And I think it was trading a little better than MSTR. So yeah, Take-Two was another double bottom base, where the second bottom sort of undercut the first, and that was right at the bear market low. It snapped right back. So we're looking for some kind of a turn off the 50, and we got it, and started getting up double digits, sold a little bit into strength, and we thought we had it. So things are looking pretty good, but then they kind of moved the game back, the Grand Theft Auto 6. They delayed that, so I caught a bounce off the open and sold into that. So didn't make a lot on that one on the last sale there, but it's a sign that things are firming up, and then from here it improved a little bit more. So, one thing about a game delay, somebody else has the opportunity to come in and put out maybe a free version without so much of a story or something, and kind of compete with you there. So it kind of got a little riskier in my view, so we just said goodbye to it. But it sort of had the spirit of a tight area, like I said, like Mike Webster would say, as we sort of tightening up, and very little was tight, but some stuff started to move. So we're gonna test our luck there, basically. So there's some re-entry opportunities, but we got other stocks here. So Uber, once again, we're just trying to buy this breaking out here. So we looked for a spot, we sold into strength there, tried it again and stopped out. So once again, just a big base, and the whole bear market just kept it within its base. So there was something there that I'm thinking, okay, they couldn't knock this one out of this base finally, so I think it's maybe ready to go to the next one. But this one was it's well managed, I suppose, but maybe a little sluggish, after the fact. So take a look at that, just sort of buying that coming out of there. And what the Palantir looked like, which is our key stock, the key market leader. You had that double bottom base and that shakeout at the bear market low, and then tightened up. And I tend to use the horizontal, the spirit of one, right? So you have that horizontal pivot, and it kind of broke the 100 level. So we're using this buy there and selling and adding. So we're still in this trade, even adding up here. Taking it off though on this liquidation bar here. I think that had something to do with a Musk feud. So we couldn't get a real read on that. It's a little bit of a violation. But turning back up, you could reattack it. So The other ones was Carvana. Carvana, once again, you just draw that the horizontal pivot, had the spirit of one. It just barely shook out. It didn't really live below the 200. That's what I don't like. We're just talking about stocks like Now and other ones. The ones that were below the 200-day moving average at the bear market low, I don't think are the stronger stocks. But of course, anything can change and they can really rip. But we're trying to stick with the ones that are in trend, the trend of the best, and are going to continue the trend. So we're adding this long here. April 23rd. So we're sort of buying a few on that day as things really start taking off. And it's kind of this Livermore idea where I think it's in this book there. You figure when it crossed 300 ought to keep going and probably touch 340 in a jiffy. And that's exactly where we sold out. And then I think it got worse from here and just kind of tanked. So, but once you do the rebuy on the handle, I'm expecting less on the next one. So you're getting maybe 30% from here to there and a little bit more up there. So it's about 50% gains from the buy point, the original one. And that's good. And it's something with Rocket Lab. I had Rocket Lab, and you don't want to let perfect be the enemy of good. I was trying to sell Rocket Lab up 50%, and I got like within 3% of that, and then it just kind of tanked like 30% back down. So that was you want to be selling into strength in choppy environments. So, but this one was acting like a leader all the way, and I think we were right to say, okay, that's going to lead off the lows. So. We picked that one off too, and these are all in a row on Champion Team Trading. These are all the buys here actually. So, and we did hit 340 there. We got out. So you take a look at that, and very much the spirit of like a high handle pullback on top of this little base here, and aggressive off the lows, and not a perfect pivot, right? You'd say that's not a textbook thing. Same with CrowdStrike. Draw the line across it. Just we're trying to grab these leaders. We think this is the cybersecurity leader. So and we're adding as we go. And we're trying to ride these. This is just the next day as stocks are confirming and they're all breaking out. The leadership I think is more important than the perfect pivot off the bear low. But once again, we're using the spirit of a pivot. That's something that makes sense. That's horizontal. So that's what we're looking at. And we're sort of using this 400 level break. I say it's a 4 Livermore. That's the $400. The round numbers are key. You want to see stocks moving through those round numbers, and sometimes they can be resistance if you're extended into them. So that's something that I put more emphasis on over the years. It's this kind of obvious round numbers and the psychology behind that. You can see the 400 break up there, and then a little mini handle. So there's almost a shakeout in this handle. So that's why we're adding to it, and then we're adding up here. So we're trying to keep size and what we think is a cybersecurity leader. And a lot of these had this kind of earnings amnesia. This had earnings that kind of dropped out, but they snapped back. So that's an interesting thing about the group during this time. PANW, FTNT, and others, Cyber, CYBR, they kind of sold off on earnings and just snapped back because I think in the future the market's looking forward to that group as leadership. SE, we went over this one before. As the example of what they look like. This just barely touched the 200. So we had this great run before. I tend to want to go back to stocks that I've traded well. Right? So I got SE right back in maybe September. So I think it's a leader. It's performed well. It was trending well. Just barely touched the 200 and then tightening up off the bear market low. So what did I say here? Hold on a second. We got to fix this. Adding back can be wrong. Hold on. Okay, so what I'm saying here is adding back can be wrong when you're adding back at the highs here, and this broke out and failed, but this will probably still turn up is my guess, and that's what we're betting on down there. But sometimes your add backs can raise your cost basis and start messing things up, unless you sold it and you rebought almost at the same place. So you don't want to mess up your cost basis too much when you're adding on and trying to keep size. If you've taken scales, if you add extended, you're putting yourself in a more difficult position to hold. So that's what we're looking at there. That's the add spot. Just add.
Yeah, through that high.
Yeah, through that little turn, and then it really didn't hold there. It kind of just threw back. You had your chance to take it off, I suppose, but starting down here with size, helps the situation. And it's always good to sort of, you don't really want to lose your position in a leader. It's I think David Ryan says that a lot. And yeah. Anyway, so the pattern buying, right? So it's like eBay. I think of eBay as like a pattern buy to me, but you got some stuff working lately like Cisco and eBay, and I don't know that eBay is the future of online retail or anything, but it had this pretty decent shakeout of the 200, snapped right back, got really tight. So this is more of a textbook area, but I mean, right away it dumped me out. So this was a quick stop at like the previous low as it just pulled in there, and then it actually took off later. So lately, anything I've stopped on or took off early just continues higher, and that's a real sign of a good market, right? So you're going to get that volatility where you're trying to do a prior low stop. Tend to fish it when things are a little bit bumpy, but you get this kind of old tech. I think that's the pattern buy, but sometimes they're great, right? So you're going to get a pattern buy out of that, and then that really took off. So you're going from somewhere around below 70, and you're up to 80 there. So Melly's one that I just got back in actually on this turn off the 50, and had a pretty good turn today. It was like up 3% or something. But one of the things I do too is we look for huge earnings jumps, which we had I think in February, and the bear market pulled it back. Not anything else really. I just think, okay, there's no news that says they're fumbling their business. They did great earnings reaction, and then just market selling took it back in. But the next time it rose back to that level, we're getting in, closing most of it into earnings here, and then a lucky earnings gap, getting out on this drop here. So that's what we're doing. Now we're sizing it back up on the turn. So it's a lot of add backs. And when you identify a leader and this sort of pull back on top of this base, it's the other thing with the 50 supporting it. And then you got, ARGT, we're sort of comparing it to that ETF, this is about 21%, I think the top holding there. So you do want to see the stocks that had the great earnings reactions and then revisit those after the bear market, because the bear market pulls those back in. And recently there was a sell-off over free shipping. They're offering free shipping to beat their competition. Sometimes that's a good thing. Maybe they keep their competition out for a while and they bust out, and then they're back to charging like Prime or whatever, right? Like Amazon does. You get those fees finally. So a little look at the chart here. Once again, not the perfect pivot, but I wouldn't buy this pattern right now, really. I mean, I'd buy more textbook stuff as we extend, but just racing into the leaders was as carefully and as concentrated as I could get, getting on margin very quickly.
Could you go back to that one just a second? The spot near 2100 is a little bit cleaner, maybe through that reversal high. Yeah, right through that spot. Yeah.
Yeah, I like that spot too. I just was late, so I'm just looking for the next spot really. So that's a better spot actually. Coming down there, 2100. Yeah, absolutely. So, but then you realize we're waiting for that confirmation, right? So it's like we're buying other leaders there, the ones we just mentioned. You sort of just can't. I really couldn't bring myself to just keep adding and adding and adding and adding, but I am, right? It's just sort of like one to three a day. You're doing like 10% size or something, 10 to 15. And trying to ramp it up. And your recent gains off the bear market low, this is something also that you got to understand. Off the bear low, you're going to have made a bunch of mistakes, and you don't have like a bunch of recent gains to spend. That's the tough thing for people to trade off the bear market low. Nobody has the gains basically unless you're an expert short, and my shorts actually weren't getting it done either. But you sort of have to go very quickly with very quick risk management. Like you saw Spotify, that threw back, I'm out. Like I don't have the recent gains to spend. Doesn't matter what I made last year or anything else. You're worried about what you have to work with right on the spot, right? That's the key. So.
And you're taking this off because it had that second close below the 21 EMA and then kind of confirming down. That was the sell rule for this one?
Yeah, we just moved it up, and we didn't like the news-driven spike with on volume through the 21 EMA, so we moved it up to, I don't know exactly where, somewhere in there, and then we're reattacking it here as it pulls back on top of support, and it turned up today. It was, I don't know what, I don't know where it turned up to, but it was up
3%.
3%.
It's right near the 21 again.
Right. And
Yeah.
Oh yeah, and then pop back up to that, right? What's the level? Where's that at now?
It's at 2,450 right now.
Right. Okay. So we bought the turn like over this prior high there. So for $50 or something is a good start. And we'll put a stop below that in the 50 there. So and then you get, we're pressing, and maybe we put all your money in LTH because it's got the ants on the left side, and you really like this double bottom base, which we did, and it's sort of getting on everybody's radar. I think it's sort of not really an IPO base, but it's kind of I looked at it as almost a new thing. I mean, I hadn't even heard about it. We tried it back in here and it got stopped out on an earnings drop after taking off most of it. But now we're on the right side of this, and it just blew out, and then it spiked and rolled. And in hindsight, these ants during that, the ants on the chart is up 20% in 13 out of 15 days up. There's a lot of insider selling there, so no surprise this sort of rolled down anyway, but they're not all going to work. So this one was just a bust, trying to buy that turn. And this base is starting to get better, right? So it's like now it's starting to look like a double bottom base, and it's tightening up throughout the pattern. And this acted like a leader during the bear market low. It didn't touch the 200. Now it is for some reason. So I don't know where it is today, but that was the case. So this is what it looked like. Get the ants. When you see the ants on the chart, I typically want to consider the right side of the base, the same base. So once again, this KRMN it's our earnings pivot example, but once again, it's sort of double bottom IPO. So if you can IPO in a bear market and really tighten up on the right side and act like a normal base, there's something very positive going on there. And I think this is even up more from this. So this was one I got real heavy in. And you can tweet at me if it crashes or something. But we're moving up the stop as we go, and we're adding to it. But one of the things I've discovered too that negating the head and shoulders pattern. When you negate that right shoulder, you kind of tighten up and break out there. And it didn't go right away, but the stop held. I think just a standard 5% stop or so held. And we had to give it a little bit of room. It's volatile off the bear market low, so we held that in earnings. It was a good add spot, so you might want to take some off before earnings and add it back, and that would have been kind of ideal there. Because you don't really know the options volatility there. I don't know if the options are really trading much, so you just got to assume 10% or so is what you're going to get, beating or a mansion or trailer, right? So you see what happens. Karaman, we're adding on this high handle as this IPO is starting to look successful, getting out there. So trying to instead of having chasing a bunch of cats around, trying to have fewer positions. And we were having a lot of them, but nothing crazy like a mutual fund. So trying to stick with the ads on something like this makes sense. And once again, the bottom is the same thing, the double bottom base, and getting the right shoulder. IPO rules, the time frames we cut in half generally. So if you allow an 8-week base, we'll allow 4 for IPO base. So a little more aggressive with these, and you get a better look there. So now it's got a 96 RS rating, and it's trading pretty well. So from this one we went to cyber. So this one threw back basically. So we entered on May 1st, May 9th. It was just barely in the money, and we closed it into earnings just because we didn't want to roll the dice, and it really didn't do anything on earnings. You could have done this kind of post earnings pullback buy. So that's part of the earnings pivot strategy too, is kind of fishing the turn after the earnings, because that's meaningful. It didn't crash. They're accepting it. Someone's still reading the paperwork. Right? They're reading the conference calls, and then if it turns back up, that's your spot, and then that's where you could have reattacked it. So we closed it, a slight gain right into earnings, just basically even, and then turning it up. So we're getting a look at a lot of different ones here, and trying to go in a group that we thought was going to lead, and that was cybersecurity. And Schwab, we bought this one once again, just breaking this range. I think there was an upgrade, so at the buy point, sort of breaking that range there, double bottom. So it's just a little bit of different trading for us off the lows. The patterns were very loose, but there's sort of just so much power we're throwing the risk on as they're all coming out there. Using the spirit of the horizontal pivot, 4 or 5 day pivot there at highs. trying that coming out. And then this handle shook out, and today it snapped back. So you could probably just reattack it, but we just a quick little trade there. And sort of at this point, it's like one big ball of momentum. So you want to sort of adjust to a financial or something, right? You just don't want to have everything Palantir, Carvana. They're all trading the same. Hood, we have Hood. We'll go over that later. I bought that later. It's sort of all the same stock for the most part. You're going to get similar performance, so you want to sort of spread out in some different groups. Once those groups start to make sense, there's a group that I'll show that I tried that I realized I didn't want any part of, and maybe it's starting to get ready now, but it was not good recently. So let's see. So this is the day we switched to green signals. I was heavily invested or on margin already, as we're trying to push these out and getting pretty decent feedback, except for the one or two that we're sizing off here. So BSX, I think this is it's a quality stock that we traded pretty well before. We entered May 1st and closed at May 12th, so this one really didn't go anywhere. And we sort of closed it even because we didn't like the way the sector was acting. XBI, even though it's just the same sector, not really the same group or industry group. You have UNH, VRTX, and others. ISRG sort of after this kind of blew out. So you sort of want to diversify into some other ones. You think are leaders, it's got real earnings, but we started to see that. So that's where I'm saying, look, this is something's wrong with this one. The whole group. So we're just going to move on to something else. And it turns out that was right to just close it even though it went up another $5 before it dropped. So you take a look at that. And once again, it just barely, tickled the 200 and reset, and that's what you want to see. And that's a sign of strength. And the bear market, that's all it can do. That's leadership qualities there. All right, so Chewy, this is the other fun one here, the pet one. I know, Richard, you have a pet, I take it.
Yep.
You want to share?
I'm part of it.
You got that pet hiding under somewhere there. You want to bring him out?
No, she's sleeping in the sun right now. We've got the patio. There's finally some sun in Seattle, so she's enjoying it. But yeah, I'm part of the revenue of Chewy. They're nice, but they throw in some nice toys sometimes with the orders, which is cool.
Nice. So yeah, I mean, it looked good. So this is a nice little base, and just kind of pull back. And we try to get like a early entry on a pullback, sort of inside day pullback and turn. And that helped from the highs. And what I've been saying about these highs is they throw back, right? So you want a 5% stop at highs. Everybody there was eliminated for sure. Our stop held. So, it was like the low of the day or something, or right below it. And it didn't even get there. And I wasn't even looking at this, and it just snapped right back. And then once again, it did get 20% out there. And I felt dumb closing it early. But like I said, you have to start to book some of these, right? That's the other thing. I guess we'll look at rubric there. But you see this, this is the pattern starting to get better as you get farther away from the low. So this is just your mini little pullback and a little cheat there. Selling it up there, and then up here you feel dumb, and then earnings dropped out there. So it was okay to sell there in hindsight. Whereas I did this with Roblox, and then that went for like another 20%. So sometimes it's like a blend of them. You're never going to get the exact top. You're never going to. Well, sometimes you're going to get picked off with your exact low too on your stops. It happens a lot, right? They just fish your stops and run it up. You can see Chewy there. There's a nice little run there, so that we'll hold on to that. Maybe that'll reset, and we'll take a look. But Okta, so we're just trying to get back in. So Cyber looked okay for a minute, but I don't think we're going to hold it. So we look at Okta, and that group is strengthening, and we look like this base was ready to go off the bear low. We get this tight area. It's a little too aggressive, so I have a very small size on something that's not really setting up like this. It's not setting up a very developed pivot, so we're just kind of throwing that on. It did have a bad earnings reaction, and I did have some left, so not that bad of a loss. Just you want to take your first price at the open on a earnings sell-off, because that got much worse anyway. And everybody asks, like, what's the trick to trying to keep it and all that? Everyone's just trying to be right. Like, you're wrong. The earnings are bad and you're wrong, so you have to sell. Right? I mean, of course it could just bounce back, but the reaction, everybody says this one shouldn't have been up there. and now you're wrong. You just have to take your whip in there and get out. So that's what we did there after selling some into strength, and you get double digits up in the money, and you go into earnings. It is definitely good to take some off, in my view. Make sure you get something out of it in case this happens. And I don't think we got that bad of a fill either. It's not even too far from our entry, but they could have kept that profitable. Hood, so this one was a really great trade, and it's still kind of trending higher there. I don't think it's like 77 or something. May 7th, pull back by post earnings, right? So this is part of I'd say this is like the earnings pivot, but we do like earnings pullback. So maybe I need some better names for it or something, but we just call it earnings pullback or earnings pivot. So that's what we're looking at here. Is it pulled back and turned? We're just loading up there and really straight in the money. So that was pretty good. And even adding back up there, and maybe more ad spots along the way. But this was a real leader. And you can see the top of the market there right before the bear. S&P 500 is on the chart there. And we got that 50% jump. So we sold some and we added back. But it was leading. I mean, this is the look. I don't have this one jumping out, I guess. But you have this up to 67 at the highs there with the market, and then drop down just to the 200, then tighten up. This one looks like really strong, and it was likely just pulled back by the market. So we're looking for some kind of an entry on the right side of that. And earnings didn't shoot it up, but it was tight. Like I said, maybe they were reading some of the conference calls and people started to get behind it, and that turn looked good to me. So that was one of our better trades recently, and still holding it. Spotify still holding this one. Really since 200, sub 200, been trading this one. Some of them are, you go back and look at your markings and like, well, what was I doing there? In hindsight, sometimes it's going to look bad, but a lot of these really ripped pretty good here. So this one's been trending really nice. Got the double bottom with the bear market low there. Like I said, you get in step with the leader, you dance till the music stops. So you just keep playing it or hold it, right? I mean, if you want to do it that way too. So this is sort of like the handle low fish that we were talking about. So I looked at this as sort of the handle on the right side. So we're, kind of dropped in, got an inside day or two, and then turned there. So that's where we're checking that, and probably little ad spots along the way. And I think this even got out a little more today. So this is a re-entry. Like this was our first, and then we got back in. Then the first one got obviously threw back, and we got out and re-attacked it. So just not taking that personally. The stocks can act up, right? So Roblox, what did this look like at the bear low? I mean, you just have to train the eye. I mean, obviously just bang right on the 200. There was buyers there, and this has gone to 100 now. So I closed it in the 80s, and this is like to what I was saying about Chewy. You get your 20% rips. Some of them are going to tank, some of them are going to continue, but you sort of want to target where you think you're going to be profitable. And like I said, you're holding one big ball of momentum. You got Hood, Carvana, Roblox. It's sort of like being ARK Invest or something at one point, right? Except maybe more quality. I think they kind of some of the stuff they buy I don't understand, but and they're living below the moving averages. But they have their own style, which is cool. So I have my style. It's going to be stocks in uptrends that are high growth, right? If it's in a downtrend and it's high growth or it's under the moving averages, I don't even look at it. So, but this is very on theme with the video games. We're looking at Take-Two. Digital subscriptions seem to be popular. Tariffs probably unaffected by that. Maybe unaffected by recessions and all that. I mean, maybe you're not going to cancel your Spotify or Netflix, right? So they're not that expensive. So yeah, this was like a little bit of a handle low fish there. Once again, a little creative buy as we're coming off the lows. This one snapped right to highs and then did this little pullback and tightened up and turned there. So that's what we're looking at, that using some daily high and inside day or two. You're looking for some low volume or shakeout. We got a little shakeout there, and that sort of gives you that stop protection in the handle. I look at that as a little bit of, if your stop is below that, you're probably safer than usual, right? Like the low of the day. I mean, that's where you're really wrong now after the shakeout low. So anyway, that's it for now. That's what I got for the conference. But thanks for having me. And this is you can trade with me on Champion Team Trading. This is my little ad here. If you want to check that out, we'd love to have everybody that kind of understands what I'm doing, and it's got word of mouth only. So stop by and check it out.
Perfect, Leif. Could you run back to that Roblox chart real quick? It's funny, I noticed this is one of the names I have on my list as holding the 200 SMA, but I was just watching other stuff when it's set up. But this has been one of like the unsung, nobody's really talking about this on Twitter, but it's been one of the best runners and movers. Everybody's watching Hood and Palantir, but this has really performed well. I want to highlight something that you mentioned about, the tight days on low volume. That's really the signature that you're looking for to set up the entry point, right? Is that tight range, tight days, for the pullbacks. Do you want to expand on that a little bit?
Yeah. So if something's pulling back on low volume, I look at it as, okay, maybe it's a little shakeout and it's low volume. The sellers just the final sellers got out. That creates the handle. It's like the people that are back to even, right? So say you buy your house at $1 million, you want to sell it, but it goes to 800, goes back to $1 million, and now you're even, and that's where you're selling and depressing the price, and then maybe your house is on the way to 2 million though, right? But that's the little handle before that. So the sellers they're praying every night that if only I get back to even, that's where it gets back to the high, then they create the handle. And you want to see them not too excited. You want to see low volume puking the stocks out there and making that handle and tightening up. And then you want to see the volume pushing it out, taking out one of those highs there. And I tend to get ahead of the highs, even though you probably could have bought this high in hindsight, but that's not the way I typically do it. You can add to it there too, and you can add as you go. But this got a little extended for me from the 200. So sort of like from where this 75 was to the 200, I thought this spot was about as far away as that. So I said, well, it's very similar in distance, and it's the risk multiples I'm looking for. Let's close it down there and maybe let it set up a new base or whatever. And then now it's over 100, so I'm never going to get the exact top. I've done it once or twice actually within a few pennies, but it's very unusual.
Yeah. And then, by the way, it's awesome to see all the case studies, because I think people can really study the entry points that you're talking about. Yeah. I'd encourage them to mark it up on their own charts, take a look at what it looks like, and see the commonalities. In terms of what you said earlier about, after a correction, really just trying to, work your way in terms of, instead of trying to find and wait for the perfect handle to set up. Can you expand on that? Because I think that's a really important concept, identifying the names that have the potential and just trying to find a way in versus wait for, the ideal setup that isn't going to come until it's already moved, well off the lows.
Yeah, I mean, the leaders, the way they pulled back, they kind of all gave it away, in my view. Some of them, like I said, they're, LTH just blew out or whatever. But for the most part, the other ones held. They gave you the clues that there was support during the pullback. There was buyers during the pullback. That's why I'm not looking at, I'm thinking of like now, NOW or something. It was like below the 200, okay, during this pullback. Everything I looked at really held quite well, with maybe there was a few, maybe a Carvana or something, a couple days below it. But for the most part, we're looking at stocks that maintain the trend. So I'd say I'm also a trend follower, is I'm sort of working around that idea that we're trying to get something in a trend. And as this is trending, this sets up a base. And there's even a better entry if you want to go aggressive around 60. You get a couple days tight there on the 50. Coming off the bear low, I wasn't ready to try this one yet. I was a little unsure about this one, and then you're going into earnings, and it was the earnings pullback. It kind of shot up on earnings and pulled back once again. So we're using all these methods, and then obviously the practice is how you get to see that and get good at it. And I've never seen anybody run through a bear market low with the leaders like this. So I think this is a good presentation. I'll give myself an A.
There you go. No, I think this is the way to build a pattern recognition, right? Is to see how you would do it or somebody else does it.
Yeah,
and
exactly.
The buy points that they're pointing out. And then with all of these, as you're going through them, what you want to think about is, all right, that's my entry point. where is the tight and logical spot to manage risk? You know, is it the low of the range? Is it the low of the day on the, when would I move up that stop? That's the type of mental exercise that can really help you out until you've traded your own way through a few cycles. And even then it's great practice. And to build the skills that you need in real time, you have to go back and study, how you would have done it in the past. So I think this is awesome. In terms of key takeaways that you'd like people to have from this session today, we've already touched on a few, the tight buy spots, finding the leaders early and building into them. Anything else that you really want people to walk away from today, remembering going into the future?
The leaders present themselves at the lows in this manner for the most part. Okay. And yeah, is it going to be a perfect pattern coming off of it? One of the most volatile, messes at a bear market? No. It's going to be a little bit messy. It's the spirit of the pattern, the overall, combining all the ideas and saying that this is a supported stock. They're going to go back to it when the market joins the party, right? The market runs up and moves everybody back in this stock, and they were already buying it when it was going down. That's the whole point of this presentation, really, is getting a look at the lows. Spotify during a whole bear market didn't do anything. Like, you got to go back and look at all these. And, even Okta didn't touch the moving averages. What are we looking at here? Chewy just scraped it, trended nicely. So as soon as the market comes back and the right side of that starts to look okay, these are the ones that the market's going to run up. And trying to force your way in them makes sense. But then now when it's very clear that the market's is strong again, or we're sort of rolling out of the bear, then you sort of want to go more pattern buying in these leaders, right? And add-ons and try to stay with them. You got Roblox just keeps extending. So, and really Chewy would have been okay if it wasn't for earnings, maybe. That's why I focus on the earnings pivots, earnings pullbacks, because there's a lot of runway once you get through earnings. And then you can let that trend happen and not say, oh, what do I have to do here? Like my Melly trade, where's this?
Yeah, it was right there.
Yeah, so Melly, it was looking good, and then going into earnings, I got to pull it off because I'm only up a little bit on it. I'm not going to just roll the dice on this one. So we took it down to like a quarter size, and just trading a little bit, trying to get back in now. But if this was post earnings, and then you got this move, you could keep going. There's just a lot of runway, unless there's news. There was some shipping news or something, but you want the runway. Roblox definitely had runway. It was post earnings. Let's take a look at that if we can find Roblox here.
Yeah, and as you're doing that, I think another key takeaway that people should have is be thinking about the themes. Again, thinking beyond the pattern, grouping different themes. What is the market rewarding? You tried the biotech names, they didn't quite work. You focused elsewhere on the names that were working. So I think that's another key takeaway to focus on for folks. Yeah, and here's Roblox.
Yeah.
Yeah, so you had runway after earnings.
Right. So this went through earnings and it's got plenty of runway. There's nothing to knock it down. There's no news, there's no nothing. So the problem with Chewy was it had earnings and then it shot it down. You want that runway, and that's why I focus on earnings pivots, earnings pullback. So I should have put Rocket Lab on that. Look at the last earnings for Rocket Lab. This little turn almost got 50% out of that from there. Same thing. It's a powerful stock. They digest earnings and it turns like this little handle here somewhere. Then you've got plenty of runway. They didn't mess up. They're digesting the earnings like Hood. We got to take a look at Hood. Hood was a little bit of the same. I don't have the pop-up here, but you had earnings. It was a day tight, and then it turned. And there's plenty of runway, and it's still going. It's like 77 now or something, I think. So that's what you want, that earnings behind you. At least I do. I just trade better that way. I get it behind me, and then I have a chance for it to trend, and the money just continuously buys it, and the sellers are not there as much because they're not nervous about the next earnings. They're happy with the last earnings, and it's like the canned slim method. It's the earnings are there, so and behind you, right? You got to have good earnings. I want to see beat and raise, and that's for the earnings pullbacks. The same thing. Sometimes It's just an unsure bear market. They're not going to launch it. A couple days tight, you could try the turn. If you think it's a leader, this acted great, it trended great. I think the market pulled it back, and that's what you want to see. You want to see great earnings like this one here. February earnings shot it out, and what took it down? I think the bear market pulled it back. So once the bear is over, you got to look to reattack this one. There's something going on there, just like Melly. And is the entry going to be perfect off the bear market low? Probably not, but as long as the spirit of your entry is there, I think you're all right.
Yeah, GEV was another one that had earnings pretty early on the higher low. I think April 24th, it had a nice spot right after earnings where it reconfirmed higher through a pivot.
Yeah.
And that's been one of the energy nuclear theme ones that's been acting really nicely.
And that was an okay earnings pivot. The problem is I think it opened high and then dropped, so it didn't have the technical move that I needed, and I just sort of missed that spot. But I've traded that in the past pretty well. That's like your blue chip nuclear name, which is great. And we have, and from here I'm trading VST nuclear names, and like I showed Oklo. We're still hitting that theme and taking scales and trying to stick with some of these leaders as there's still runway, and I think there's still runway in some of these, but now they're getting very extended, right? So you see how far it can go from the 200. That's, you get up to 80. Okay, now you're very extended off the 200 again. You're up in the nosebleeds. You probably want to take it down a little bit, depending on your style. So that's what I did with Chewy, and I was right after earnings, right? This earnings, we're going to get earnings again, but not for a while on Hood, so we'll see.
Yep, perfect. Well, Leif, this has been amazing. Any other key messages that you want to leave everybody with watching today, regarding either trading after market corrections or any general advice with interpreting charts too would be awesome.
General advice, I don't know about interpreting charts. Let me think.
Or just studying case studies like this. What should people do to make the most out of?
From this presentation, I think the best thing to do would be sort of review what the leaders looked like at the lows, and that's what I did on the slide. So you're not going to typically be in a depression if you have a lot of your leaders not even touching the 200-day moving average. So you start to get some confidence, but they have to build some kind of a tight area as you get the higher lows in the market, and you're not buying right off the lows. It's really the bear market sequence. So I just think studying this bear market sequence is really the key takeaway, because there'll be a bear market again. I mean, there's always one around the corner. That you got to be ready to capitalize off that low, and people wait for too much confirmation. This is the thinking beyond the pattern. By the time it's obvious that we're back to highs in the index, it's easy to shoot it down with some news. You start shooting some missiles at each other. You're going to sell off, and now you're getting your low risk entries, hit because the market did this V shape. It's almost like a COVID snapback, a very quick, V-shaped snapback. But once you get back to highs, that's where maybe you need the handle, right? So everybody gets back to highs. I swear I'll behave myself. Just let me get back to highs, and people pray for that. And you get the handle. And sometimes it's just the news, the excuse to put that handle in for the digestion. And now you're late. So the other thing is sort of buying when things are the hardest. And I actually tweeted this on the 15th, I think, of June. That things look good for a lot of leaders, and it's hard to buy. And then the next day, boom, everything's up and all those leaders are moving. But did you see that they were all set up? They're not setting up because you're about to blow up, right? If the leaders are setting up in a difficult tape, that's when I typically go in a little harder than most people, because it's also like a little bit of a game of poker, right? It's like you're sitting there and most people aren't willing to do this because they're all nervous about the news, but the stocks are telling you it's okay, right? You got everything at a buy point, all the leaders you're looking at. And then on a day like today, which is not anything on the slides here, everything starts, there's so many setups, I couldn't have bought them all. They all moved too fast off the open, but I had the ones I wanted. So, buying when it's difficult, when stocks are setting up, equals improving your odds. And that's sort of what this presentation shows also. It was not easy to buy all these. I think a lot of people thought I was nuts, but it's the confirmation I got as I went, right? It's not some call like I'm on the news and I'm saying I'm bullish, for random reasons. The stocks are proving it and the gains are proving it. One or two mess up. It's always going to be the case. But you get 50% or more on Hood and these kind of moves here with Carvana and stuff. That's where you make some really good gains. And it's not going to be that easy when the market snaps a V to the highs, and maybe you need that shakeout where things are easy, right? And you're waiting for too much confirmation, and you're waiting for too much perfect pattern. We are using the patterns though, and I definitely respect pattern buying, but we're using the spirit of one to try to force our way in leaders in this case.
Yep. Excellent. Well, Leif, thank you again for your time. To everybody watching, hope you enjoyed. Make sure to leave a like down below if you are, and we'll be right back. Take care.
All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, someone who I'm really looking forward to hearing from, Christian Flanders. Chris is a swing trader and top performer in last year's U.S. Vesting Championship with a return of over 400%. He's competing again this year and doing very well in the Money Manager division. And today he'll be focusing on one of really the most important parts of trading and something that I think takes a little bit to grasp, progressive exposure. So I think this will help out a lot of traders out there. Chris, thank you so much, first of all, for taking the time. And yeah, thanks so much for being a part of the conference. I appreciate it.
Thanks, Richard. It's an honor to be presenting. I've watched this every year since its inception, so it's pretty surreal to be a part of it. It's wonderful. Thank you.
Well, it's of course it's great to have you. And yeah, let's dive right in. And first things first, I think yeah, this will be a great topic, and excited to dive in on progressive exposure.
Okay, yeah, great. Let's do it. So yeah, progressive exposure, the key to consistency and longevity in trading. So the big thing with trading is, your goals. What are you trying to achieve, and why are you trying to achieve them? And this is very important because, there's a ton of adversity that you're going to have to overcome as a trader. So it is very important to have a very powerful why to keep you motivated when the going gets tough. For me personally, I had 3 years in a row of drawdown, and what kept me going was the desire to provide for my family, and how much trust my wife put in me to quit her job to give me a chance to make this happen. So that very powerful why, and that kept me through the tough times. What return are you aiming for? What drawdown can you tolerate? And what are you willing to sacrifice to make it? These are all very important questions, which are key as we move forward through the presentation. Okay. Albert Einstein didn't actually say this, but I thought it's still a very powerful quote, and something that you need a big brain to think about. But compound interest is one of the most powerful things in finance, in the world, really. And if you understand it, you can harness its power. So here we go. What's the rush? So a lot of beginner traders, and I was guilty of this too, are in a very large rush to make their fortune. You see the potential, you see the kind of numbers that amazing traders can put up, and you think, I want it right now. Well, if you look at the results of great returns, what happens over time if you can maintain a high compound annual growth rate, or a CAGR? Morgan Housel, earlier, he had a great presentation about the dangers of trying to make too much money too fast with leverage. And I think this goes to show how much money is possible with solid returns and using the power of time and compound interest. Warren Buffett has a great quote on this, why he's so successful and why more people don't emulate him. And he said that no one wants to get rich slow. Everyone wants to get rich fast. So you can see the returns, a 20% return, 25% return. After a decade, after 20 years, after 30 years, the returns are they're mind-boggling. It's hard to even comprehend how big those numbers can get. And then you see, some market wizards like, Mark Minervini compounded that, 150% for 5 years. Qualamagi has compounded for, I believe, 100% over 10 years. You can imagine how big those numbers get. Okay. And this is a slide just showing what a big losing year can do to your total return and how it affects your CAGR. So in the first example, a trader, 250% years back to back, fantastic numbers, mind-blowing numbers, right? Year 3, minus 50%, and you see that the total return drops to 12.5%, and the CAGR drops to 4%. So this just shows how, ideally you never have a losing year, but I've had losing years. Losing years, they happen. The goal is to keep them as small as possible, to not reduce your CAGR. So boom and bust, the killer of compounding. Charles Harris had a fantastic presentation on his YouTube channel. If you're not familiar with him, I highly recommend you watch it. But the bust is what kills compounding. Having the big down years, the big down months really remove the power of compounding. So I have here, this is actually from a trader from last year in the USIC Enhanced Division who showed his results. A fantastic year-to-date return, but what a ride to get there. Not a ride that I would enjoy. I don't think he enjoyed it either, but he got to the other side. But you know, you run a lot of risk with those kinds of monthly drawdowns. So how can we get off that roller coaster? Having rules, the discipline to follow them, progressive exposure, and then what I call a heat check. And so progressive exposure is, I didn't define it at the start, but it's basically trading with larger size when you're winning and reducing size when you're not. That's really it in its simplest form. So here's a great Livermore quote: "A loss never bothers me after I take it. I forget it overnight, but being wrong, not taking the loss, that is what does damage to the pocketbook and to the soul." So he's one of, you know, the greatest traders ever, and maybe the biggest boom and buster ever, going to $100 million fortune to bankrupt to, I'm sure he ran it up, I think 3 or 4 times. So he is probably the ultimate boom and buster. And that $100 million adjusted for inflation is over $1 billion as an individual trader. So the struggle with accepting losses is a recurring human phenomenon. We are all guilty of this, or it's ingrained into ourselves. Loss aversion, we feel a lot more pain from losses than pleasure from gains. I'm definitely guilty of that. Maybe you are too, Richard. The losses hurt a lot more than the gains. And then the sunk cost fallacy, which is you're reluctant to abandon a strategy or course of action because you've already invested so much in it, even when it is clear that the abandonment would be more beneficial. So I have a story about this, but just an analogy with poker, that if you play poker live for long enough, you get a good idea of the kind of opponents you play against. So there's one kind of opponent called the Rock or the Nit, and he only bets when he has it, especially on the river. If he makes a large bet, he has it. He has very likely the best, he has the nuts, he has the best possible hand. You know he has it. He knows he has it. The table knows he has it. The guy who is about to call him knows he has it, but he just can't let it go, because what if he doesn't have it this time? And of course he does have it, and he loses his money. So the sunk cost fallacy of already putting so much into the pot and then being unable to fold. So a sign of a professional in poker, a strong professional, is the ability to fold extremely strong hands with extremely high absolute value when they estimate the odds of it being good are not high enough to justify the call. So if you have the second nuts and a player that only bets with the nuts bets into you, strong players can make that fold, but amateurs would not be able to relinquish their hand in that example.
And just to jump in, Chris, do you want to mention a little bit about your professional poker playing background? Because some people watching this might not be familiar of like how you made that transition from poker to trading. Just very briefly, yeah.
Sure, yeah. So I played. Well, let me scroll back really quick. But I played. I should have started with this, but I played online poker for about a decade professionally before I transitioned over to trading. And I played primarily online, 99% online, but a little bit live. And online you're staring at a computer screen. It is much more mathematical, I guess you would say. But the few times I did play live, you see crazy stuff. I mean, you see guys, lose a hand, turn, they get visibly red, and they just start playing every hand blind. Blind is you don't look at their cards. They would just start playing every hand. I mean, you see wild behavior. And you see it in financial markets as well. When market participants are clearly, when the fear gets really high, you can see it in the price action, the way prices move. But yeah, I played poker for almost 10 years professionally before transitioning over to trading. So we'll.
Yep. Also, I think worth mentioning, because I've got a lot of I've got some questions about the analogies between progressive exposure in the markets and how that comes from maybe some poker player mindset too. But yeah, I'll let you keep going.
Okay, sure. So learning to take losses. So learn to take losses. The most important thing in making money is not letting your losses get out of hand. So I got to speak with a veteran trader who's been in the market since the 1980s. I mean, he still draws charts by hand. And even he still struggles with taking losses. He was telling me how his biggest regrets or his biggest mistakes are not taking the losses when he knows he should. he's more of a research and fundamental guy, right? So if he believes in the story, if he has conviction, he's going to try to let it play out, and that's resulted in some gut-wrenching losses and drawdowns. So drawdowns. So his thing to me was discipline. Take the losses while they're still small and get out, because he's had to learn the hard way, and I have as well. Drawdowns cannot be controlled without taking losses before they become large. Everyone has losing trades. How you handle them is the difference between average, good, and great returns. And then Mark Minervini just posted this about 5 minutes ago, but I thought I'd include it about the reality of controlling risk. And that if you don't feel like an idiot, you're not managing risk, because you are going to get stopped out often and have the stocks turn back around and go up. And that has happened to me countless times, and it continues to happen to me today. I've been in almost every leader in this rally, and I got knocked out of a lot of them. And that's part of the game. You have to get used to it, and not go on tilt and just pull your stops, because eventually you will take a very large loss, which I have as well. Okay, so yeah, drawdowns are inevitable. They will always happen. The key is keeping them as small and controlled as possible. And Mark Minervini has a great story in one of his books about how he went back and looked at his trades. If he removed the large losses, his results would have been fantastic. So going forward, he said, I refuse to allow any more large losses. If they get me, it's going to be death by 1,000 cuts. So here we go, death by 1,000 cuts. So I Googled this because I didn't know what it was from, but it was a form of execution in China, which involved, it wouldn't take 1,000, but these small cuts that would be extremely painful, and eventually result in death. But thankfully in trading, you will not die from taking a lot of small cuts. You can survive and give yourself time to adjust, to learn, to adapt, and evolve. And this is a feature, it's not a bug, it is part of the game. The drawdowns are part of the game. You will be in a drawdown, if you trade the way I do at least, swing trading, you will be in a drawdown most of the time. The making new equity highs is the rare part. The drawdowns are really what's common. And decapitation, one large loss can be fatal. I've met many traders that have had the one large loss wipe them out. I've had traders where they've had one loss take out multiple years of gains, one large loss. I've had traders with, who have large accounts lose it all in one trade, one large loss. So, I have taken a large loss, and after that, I said never again. I'm never going to let that happen again. So the only way to prevent a large loss is you take the loss before it becomes large. So personal journey. Trade is an extremely personal journey. What works for one trader may not work as well for others. You have to find out what works for you. So it took me 7-8 years for all of this to click. And by now I have a pretty good idea of what my strengths and weaknesses are. And the way I use progressive exposure, it's really to protect me from myself, because I get overly aggressive and I will overtrade, which is a weakness that I continue to work on. But hopefully this can help you think about what your personal strengths and weaknesses are, and what you can do to highlight your strengths and reduce or hide your weaknesses as much as possible. So strengths and weaknesses. So risk, the double-edged sword. My strength is the ability to put on risk and aggressively pyramid as trades work in my favor. And my weakness is I overtrade and I place a lot of risk on quite quickly. So if my timing is off, I can get hammered pretty fast. So how do I protect myself from myself? Default position size, 0.25 to 0.5% risk per trade. That's much smaller than I used to trade. When I would have very large drawdowns, I used to trade much larger. So I reduced my initial position sizing. And when the trades work in my favor, I increase the risk, 0.75 up to 2.5% risk per trade. That's total equity risk to account. Then the larger size is when all the stars align. That is not a frequent size. That's on a A+ setup when I have traction in my portfolio. And then the max monthly loss, I try to keep my losses at a maximum of 5%, and I will reduce risk for the next month if I have a negative month. And you never ever want to have cascading growing losses monthly. That is key. that's how you can enter a trader death spiral, and that is a very unpleasant thing.
And sorry, just to jump in, I think the last time we did a podcast, Chris, we talked about that quite a bit. That was one of your focuses going forward is keeping those monthly drawdowns as small as possible. Yeah, any kind of with that added experience now since the last time we talked, how's that been going, and how's that kind of helped you both protect your equity but also protect your mindset as well, so you're mentally ready to profit from the better periods in the market when the market cycles eventually shift back to an uptrend?
Right. So it's helped immensely. I have kept my monthly losses to 5% or less. So I have not gone into a large drawdown this year. It's been very controlled. I think a lot of guys, it can be frustrating at times because the market's been very bullish since the lows in April, right? But what if you are not trading well, but you see the market taking off with you? Well, that can be difficult. There was a stretch where I sized large on a few trades and had 4 losers in a row, and I immediately slammed the brakes. Even though the market was positive, I reduced size because if you continue trading large because of the market, you run the risk of a drawdown. The only way to stop the large drawdowns is you must cut size if your trades aren't working. And I cover that a little bit later, but basically, if you're not winning, there's no reason to maintain size. You have to stop. You have to cut the risk. That's really it's the only way to protect yourself. And you have to trust that sooner or later you will be trading well in a good market, and then all you need to do is connect with a few trades. You're up for the month, and then you can really ramp up the aggression and get really aggressive. You really don't want to start ramping the aggression when you're already drawing down. You only want to ramp when you're winning, and then you can get really aggressive. I've been helping a friend trade, and he gets I would say it's too aggressive, really. He's risking 4 or 5% of his account, but he's up so much now, and it's okay. If he's willing to stomach the drawdown, which eventually will come, you can be really aggressive. I'm fine with extreme aggression when you are winning and you have the profit cushion. You just don't ever want to do that when you're losing.
Yeah, perfect. Sorry to jump in, but I thought that was a good thing to talk about.
So so for max loss, at 0.5% risk per trade, you need 10 losers in a row to hit -5%. And at 0.25% risk per trade, you need 20 in a row to hit -5%. So I personally had 20 losing trades in a row. I've had more than 20 losing trades in a row. So it seems crazy. You think, how can you possibly lose 20 in a row? Well, that's what I used to think too. And then I would increase size at the end because there's just absolutely no way I can lose 17, 18, 19, 20. And then it would happen. And then the drawdown would get worse. So when I start losing, I cut the size, and that's what really keeps the drawdowns in control. So after a losing month, I will reduce the maximum drawdown allowed for next month. So the first month maybe -5, -3, -2, -1, -0.5. So if you have 12 consecutive months of losses following this principle, you'd be -15% for the year. So I've never had 12 months in a row of losing. I've had 4 or 5 in a row, I believe. But yeah, so if you were able to follow this, you know that your annual loss could never be, maybe 15, maybe -20, right? But you keep it, reasonable. It's recoverable. You really don't want the -50, -60, -70% drawdowns, because those are extremely difficult mentally to recover from, but also just mathematically. Once you're down 50%, you need a double to get back to even. At a -70%, you need 150. You need a large gain to get back. And I have done that. I have come back from a 60-65% drawdown, and it was not pretty. I would not wish that upon anyone. And this is a way to prevent that from ever happening. And if you ever do go through that and manage to come back, at least for me, never ever want to have that happen again. Never ever. So and this is the only way that I know of to prevent that from happening. So yeah, portfolio trash. So once you're winning and have profits, you can increase position sizing if you so choose to push size, risk, and return. And if losing, cut size, cut risk. So like I said with my friend, he's always asking me, is it too much size? Is it too much size? I'm like, look, you're in the green, you're winning. You have the green light. once you're winning it and the market's good, you have the green light to get as aggressive as you want. Really, it's just once you start losing, you must aggressively cut size. Okay, so monthly progressive exposure. So what controlling drawdowns can do for your results, the power of compounding. So I took the trader from the USIC enhanced division and showed what happens if you were to cap his monthly losses at minus 10%. And I also reduced his positive months by 10% because maybe he has to be a little more cautious in general. And you can see the year-to-date return more than doubles. And then if you're able to just keep the monthly loss control to minus 10%, you can see the year-to-date return is out of this world. I mean, a 300% return. We take for granted the ability to have a stop loss. So I got to speak with him on the phone. He works at a financial institution. So he has to pre-check all of his trades. So he cannot trade without approval. So before he puts a trade on, he has to send it to HR, and they approve or disprove the trade. So you cannot have stop loss. So Minervini has a great quote about driving not having stop losses is like driving a car without brakes. Sooner or later, you just can't stop. So still impressive returns without using stop losses, but. We had a conversation about that, but he's adjusted since then. My experience. So I personally have never come back from a large drawdown in a month, but I have made the drawdown much worse, and I have had multiple losing months in a row. And in hindsight, going back and looking at my results, I realized that I'd be much better off just cutting the losing months short, slashing risk, and limiting risk going forward. If you're drawing down, it's likely the market is either negative, your timing is off, or you aren't seeing the ball clearly, or a combination of all three, maybe one or maybe two. Earlier this year, the market was great, but my timing was off, so I cut size, and then a few winning trades in a row, you see your A+ setup, you size up, that's a winner, and you're back in business. You can go back to being really aggressive, that's how to keep the drawdowns controlled. So study market history. The bull markets, they always come after bears, they always come back, and the opportunities are immense. And I wanted to refer to my Evernote where, some years I'll have, 50, 60 studies of previous market winners. Some years I'll have 2 or 3. So, are there always opportunities? Yes, but some years you're flooded with them, other years not so much. So much of the game is surviving till you get a time, an easy money environment where there's, 50 stocks that are up 100, 200% in a year. And all you have to do is catch a few of them with decent size and you can have a fantastic return. So here you go. So portfolio heat. So risk versus heat. Heat, how much equity you lose if all your stops are hit. Risk is how much initial equity you lose if all your stops are hit. So I have a few examples here, just showing the difference between risk and heat. So heat basically includes your open P&L, while risk is just the initial account risk. So the heat check, if all my stops hit, what's the drawdown? That's simple. So that includes open P&L. So you'll see traders post about online about how they want to take profits. Why? Well, because the heat is too much. Right. I mean, I've had times where the heat is like, well, last year the heat at one point was, almost the entire, the entire account practically. I mean, I was up 100% in the portfolio. I mean, my heat was massive. So, are you okay with that? Because that's the potential drawdown. So, when to run hot. So this is very important. At the start of rallies, much easier said than done, but when you want to run hot is when you want to let your heat grow and let your open P&L grow, because you can get the potential very large returns. The con, of course, because everything in trading has a drawback for the most part. The con is if your timing is off or the rally doesn't continue, you are going to give back a lot of open P&L. When to cool off. Sell into strength or smaller initial size in trades. The rally has been going on for several months. So pros, you can reduce potential drawdown if the rally fizzles. The con, of course, if the market continues, you miss out on potential gains. So, and the ways to reduce heat or open P&L, you cut positions, raise trailing stop losses, and you stop initiating new trades. So this is really key. This is a combination of situational awareness, experience. It takes time to know this, and often there'll be false starts. I mean, this rally just, took off from the lows, but sometimes you'll have multiple waves down, and on each bottom or what appears to be a bottom, you'll have stocks set up and break out, and they will suck you in, and then the rally doesn't materialize, and they will sell off, and you will give back. So this is really like the art, I would say, of trading. I mean, you can mechanize this. I mean, you can have specific rules, but a lot of it is, at least for me, it's more feel.
Yeah, can we pause on this slide, because I think this is so good, and I think and I struggle with this. I still working on it, but I think there's a lot of traders out there who they miss the start of the rally, and they feel pressured. The index is going up, and they feel pressured, and then they push size or push entries that maybe the leaders already extended, but those are the ones that are the leaders, so they need to get in them. They enter at the wrong spots, get shaken out in natural reactions, and then they've got a drawdown to start, and then they push size again to try to get back. It's like a cascading series of events where if you don't start getting exposed and testing positions a little bit earlier, when yes, the trend is less clear, but maybe that's the proper time where you can get maybe tighter entries and actually try to get into 1, 2, or 3 leaders that, if you get into them properly, can ride for the trend coming out of it. But I think this is such a great slide. And just again, speaking from personal experience, I've struggled with this, and like you said, I've come up with kind of more of a system, some kind of rules-based approach where the first higher low, I have to start testing some trades as we push off that first higher low, or right near the 21 EMA. If we start taking out that 21 EMA, that's when, for my style, for my system, I need to starting to buy positions if I haven't already. Because if I've missed that in the past, again, I'm in kind of that slippery slope where it doesn't create good trading habits. So this is such an important concept, guys. I think especially if you're newer to the game and haven't gone through a few market corrections and strong rallies from them, you can't, like Christian said, it's hard to internalize. You do need some experience, but this is so key, guys. And this is a great slide to summarize it. So fantastic, Christian. Anything else you want to add on this slide based off what I just said, or your own experience with it?
Yeah. So I actually spoke about this on there was a YouTube or a talk I had with a few traders the other day about how, like, the 2019 rally, that was a fantastic rally. I was probably on average 150% long the entire way up, and I was down 30%, doing exactly what you said, buying every rally or every, I miss the initial leaders, I chase, the market pulls back, I get stopped out. It rallies back up, I buy, literally buying the high, selling the low the entire way up the rally. So no, I've been there. I've made every mistake you can make. But and that's the point of this of progressive exposures. It gives you the ability to survive the mistakes, survive the learning curve, and make it to the other side. That's why this is so key. That's why this is so key.
And was that that period where you were 150% long and actually suffered a drawdown, was that coming out of the 2018 correction, or was that at the end of the year coming out of the choppy summer period?
That was coming out of the 2018. That was coming out of the 2018, like I think end of year sell off.
Inflation.
Yes, and I remember there was a few names, Kron, which was like a marijuana stock, and then SE, which I covered in our interview before, where I watched the episodic pivot go and then tried to get into the flag like 5 times or however many times, and each time I increased my size. Right, the first one, I was like, oh man, this is like so great, 1%. Oh, it didn't work. Okay, this one has to do 1.5. Oh, that didn't work. Okay, next one 2%. Oh, that didn't work. Oh, next one 2.5, and then it's like, whoa, like this drawdown is big, and it only took me 4 trades, and that doesn't include the other. I had some winners, of course, but same thing with Kron. That looked like it was forming a power play, which eventually failed. It didn't work, but I sized like 3 or 4 times into that one as well. And before you know it, you're down 20%, and it's like, okay, well, what do I do now? So you just never want to get in that position where you're in a good market, but you handcuffed yourself because you put on too much size and drew down. So even if you're very bullish, I was very bullish, but it doesn't matter. You just cannot allow those drawdowns. So you have to control the size, and once you're winning, once you have a few names work, you can ramp. There's no rush. I mean, it's like the first slide. Like what's the rush? If you can make 30% a year for 10, 15, 20 years, I mean, the numbers, I mean, you're going to have more money than you can spend. I mean, the numbers get so large. So it's really about the patience and not, you know, not seeing the forest, not the trees. You know, like you're in the middle of a forest, you're surrounded by trees, but, you know, it's like, yeah.
Yeah, hit some singles before you try to start swinging for fences.
Exactly.
Yeah, awesome, fantastic.
So simple, not easy. That really sums it up. It's simple. It's not easy. It requires incredible emotional control, self-awareness, and great minute reading. Everyone wants to be a market wizard until it's time to do market wizard stuff. Well, market wizard stuff is sometimes if you're not trading well and the market's taking off, you have to slow down. You know, it's the hard, but you don't want to slow down. You want to make the money back right now. You want to make the big gains right now. You see everyone making a huge amount of money, and you're the one guy in the world that's not, which of course is absurd. I promise you, there's tons of traders that have gotten chopped up and missed the rally. I mean, that's me. I mean, I've been through that multiple times. It always looks easy in hindsight. Real time, managing risk, trading. It's fog of war. You know, in hindsight, you know, the generals, it's so obvious what they should have done, but in real time, with limited information as well as the emotions, it's very difficult. I have a friend, my friend who I mentor, he would tell me that he wouldn't want to record his trades because it would show him the mistakes he made. It was like looking at a mirror, like a reflection of yourself, right? Your equity curve, the trades, everything. It's a reflection of you, and he didn't like looking at it. And but the solutions are so simple, right? It's an extremely humbling experience looking at your mistakes. And a lot of guys, although this is a thing with poker, poker players have massive egos, like massive egos. I mean, I know some traders do. I think trading is much more humbling than poker. I mean, it's not even in the same universe. I mean, because with poker, you can always blame the deck. you can always. I was.
You can blame the market too, though. But yeah.
Yeah, you can blame the market, but it's different. I mean, it's different. If you play both for a while, I've met so many poker players with just these massive egos. I have not met many traders, at least that have been around for a while, that do, simply because trading is so humbling, right? Trading is so humbling, but with poker, the variance is so wild, and because it's a one-on-one, or I mean, you're playing against other players, but you're playing against other players, right? It's a relative skill game, not an absolute skill game. So as long as you play with worse players, you can win. But trading's not quite so the same. Okay. So discipline. Yeah. Have rules, stick to them. Sacrifice short-term mental comfort for long-term goals. Let the power of compounding work for you. So those slides. I mean, compounding. That's really that's the most powerful thing you can do. I mean, that's the magic of trading, is the ability to compound over time and let your money grow and let your money work for you. And then I hope you guys found that helpful. I'm on Twitter at @cflanders7, and that's it. I think that's only 40 minutes or so.
It's all good. We've got some questions to talk through. So, Christian, first of all, thanks for that. I think this is so important, this topic. And the first question I had for you is, you talk about, slowing down when things aren't working for you. How many trades would it take for you to say, okay, my trades, whatever the market's doing, whatever everybody else is doing, I'm not trading well, or I'm not seeing the ball well right now. How many trades would that take to, drop from risking 0.3% to, maybe having that, or whatever your process is?
Right. I mean, 2 to 4. I mean, it depends on the market environment. I'm not in every breakout, although sometimes you wish you were, but I'm not in every breakout, right? So I'm watching the market and seeing what names are working. Are things going up? Are things going down? Is there general market weak? I'm looking at everything. So it's hard to really give a definite answer. But if you lose 3 or 4 in a row, I mean, obviously it depends on the quality of the trade. I mean, I'm guilty of over trading, so I take trades that are not A setups, right? So if those don't work, it's less meaningful than if your best setups aren't working. But yeah, I would say a few trades, 3, 4 trades, and I'm probably going to be cutting size.
And is it similar on the flip side? Because that's equally important when a correction just happened, you're starting to test trades. How many does it take you to ramp up size to normal?
Again, you're looking at everything. I mean, you're looking at what the market's doing, what leaders are doing, what sectors are performing. But yeah, I would say it's if you have a few trades that are working and then you get an A setup, then I'd size for that one. And if that one works, that's like a big green light that, okay, you know, the market's working, you know, they're rallying, I'm seeing the ball, you know, you can really ramp aggression at that point.
Excellent. And maybe using a case study of this most recent correction this year, and maybe from a holistic perspective, also like noticing which stock to try. You know, coming out of this correction, around when were you starting to test trades, and how did you kind of pick the ones to give a shot in the first place to see if the market was rewarding your style?
Right. So I I was very fortunate that I actually was in the market basically at the lows, and I screwed up a lot of those trades, but I was able to avoid the sell-off. And then when you had the cascading increasing losses on the indexes as well as individual stocks, I was paying really close attention to names that were still in intermediate term uptrends, like a Palantir or a Hood or a Spotify or Netflix. So I tried Netflix. When it broke out of the double bottom, it undercut the low of the day. I got knocked out, and then it took off, and I missed it. I tried getting in Hood on the second day off the lows, and I got stopped out, and that took off without me. I got Palantir on the day of the lows, and that one just went higher. I was able to ride that for a bit, and I also bought Hughes, the Nasdaq on the lows, and I panic sold that like 7 days later after that massive one up day. I was like what, plus 12%, and the next day was like down 7%, and I think I sold that basically at the lows. Yeah, I mean, I was able to get in. You know, Palantir really allowed me to take a lot of trades, and then the next, I want to say, week or two, it was extremely volatile and choppy, and I think I lost pretty much every trade I took. You know, when the market was basically just chopping around the moving averages, and then when Palantir formed a double bottom and gapped at like around 99, I sized up for that one, and that gave me the cushion to keep going. And then I posted on Twitter that I was extremely bullish on CoreWeave, that it was just like eBay in 1998, like a new, eBay was like a new internet stock, IPO'd right before a brutal bear market. CoreWeave is a new AI data center play, IPO'd right before bear market. It sold off, or it rallied, then it sold off during the bear. I bought it at the lows on April 7th. I got knocked out. It went lower. It came up. It formed a little pivot. It gapped up out of that. I bought it. It stopped me out. I took the opening range high. It stopped me out, and then it just took off and I wasn't able to get back in. And then on earnings, I tried buying it. After earnings, it was gapping after hours. I bought that. It stopped me out. The next day, what did it do? I think it was rallying. I took it over the 1 minute opening range highs. I got stopped out. At the end of the day, it took out the highs. I didn't buy it back because at that point I had taken so many losses, and I was sizing, trying to put on, because I had a lot of conviction in the name. I was trying to put size on. So at that point the losses were so large that I was like, geez, I can't put on the size I want. It's just not responsible for me to continue trading like this. So I'm going to back off. And I also missed the nuclear episodic pivots because of that, because I had just taken so many losses in CoreWeave as well as Pony. I tried getting in Pony as well after its on its earnings. It had formed a little flag. So I missed the initial run up in the nuclear names because I was protecting myself from myself. I mean, obviously in hindsight, I should have taken all the nuclear names. I should have taken CoreWeave again because I would have made a lot of money, and that would have been great. But it's more important to me. I'd rather miss out on those gains than have a large drawdown. Because what if CoreWeave did? What if it stopped me out again? What if the nuclear repeat failed? Right? I mean, because obviously in hindsight it all worked, but in real time I don't know if that breakout's going to work, and I cannot put on the added risk. If you lose 6 trades in a row and you're trying to put size in, like there's no way you're not on tilt. I mean, there's absolutely no way you're mentally sound enough to be able to make decisions, especially putting on more risk. It's just not a good idea. So at that point I was like, I have to slow down and start over. So then I started over, small size, waited for A+ setups, waited for my my bread and butter, and then I'm able to continue trading because I kept the drawdown under control.
Yeah, and I think that's perfect. And this year, obviously the index has gone really well since the correction, but there was a choppy period where I know my trades weren't really working too well in later May to June timeframe. I couldn't get too much traction going. It improved a little bit after. But there's going to be periods like that where there's the initial push off where the leaders expand, and then it gets choppy. And if you're not positioned earlier or in the right frame of mind, that's where you can give a lot back if you didn't have that cushion, or just not trade well and suffer a drawdown that sets you back mentally. And like you said, sizing down for you, those themes worked out at that instance, but maybe also you wouldn't have been in the frame of mind to execute properly like you can in those themes. So I think that's perfect. One question I did have, starting from a correction, a few trades work. Are you selling those trades outright to then finance other positions, or like a Palantir, are you just kind of holding it and watching your open gains and seeing if it's worth adding risk on, and you're keeping track of it mentally that you're seeing good progress? I think that's a big question to have. Do you have to sell a winning position to finance other ones, or can you kind of use the open profits to finance new ones?
Right. So this is I can go back to the slide about right. So this is the trick, right? Do you want to lock in profits to put on more trades, or how aggressive do you want to be with that open risk, with that heat, right? So that's a personal preference. It depends so much on the stock. So with Palantir, if it didn't have earnings, so I sold my Palantir position before earnings. I wasn't going to hold through that event risk, but if it didn't have earnings, I would have held. I mean, I like to think I would have held. I mean, I sold, but I probably would have held. I mean, this comes down to the trader. I do have positions that are still running that I've held for over a month. Yeah, I mean, I'm not really sure how to answer that. I mean, yeah, I mean, I will if I think it's a new bull market, and my positions are showing me progress, I will try to hold at least some of them for the rally. I mean, for sure. Some traders prefer locking in the profits and then using that to find that open or that closed profit to finance risk in other positions. So I mean, it's such a personal decision on your preference, your risk tolerance, your drawdown, what you're willing to accept in terms of giving back your heat or your open P&L. So, but yeah, I mean, at the start of a bull market, you really want to hold on to those positions if you can.
If you get them. And you did have that QQQ position that you sold, and that allowed you to finance some risk that way with those profits.
I mean, it feels like I lost on that trade even though I won, but yeah, that did lock in some profit, yes.
So were you trying that a few times during the correction process as we kind of put in an upside reversal that looked like it could be an extension low, or that was the first time you tried it? Okay.
I mean, I never play bottoms. That's the first time I've ever played a bottom because it was just so extreme. I mean, I think it was 3-4% gaps in a row, but that is not the way I trade normally. I mean, I buy names at highs. That's not how I trade. It was just such an extreme moment. And I remember I was gripped by, I mean, I missed the entire sell-off. I mean, I was in cash or short of a few names, but I missed it. But I remember just feeling this like gripping fear. I mean, this incredible feeling of uncertainty. And I remember thinking to myself, like, you're in cash. Like, what? Like, what are you terrified of? Like, what? Yeah, you're fine. You're protected. But it was just, this market gripping fear. The headlines were negative. I mean, futures limit down, and I was like, geez, you have Palantir selling off right into the 150-day. If it's gonna, this is the spot to play a balance. If you're ever gonna try buying the bottom, right? If you're ever gonna, I mean, this is the spot. I look back at the COVID crash, right? And Tesla got supported as 200-day, I believe, in a similar kind of situation. So I use that as my precedent. But yeah.
Yeah, excellent. And then I want to see, going back to kind of poker, what's kind of a similar analogy to progressive exposure? Is it like building up your stack of chips before you're getting too aggressive and just, like you said, folding hands when it's not a sure thing, or not, the probabilities aren't really in your favor? What's kind of similar with poker to this concept?
Right. So poker is more that. So I'll use a hypothetical example. You have a $100,000 bankroll. You play 10-20 no limit with a max buy-in of $2,000. Okay. So you're risking, when you sit down at the table, you're risking 2% of your total bankroll. Okay. That would be the equivalent in poker. You have guys with a $100,000 bankroll sitting down with $100,000 in a high stakes game of, say, 50, 100 or 200, 400. They put the entire bankroll on the table. That's not, that is literally all in on, in one trade, risking your entire account. Those guys can go on massive runs, but as you can imagine, they always give it back. I mean, they always give it back. There's just no risk management. I mean, when I was in college, Rounders, I don't know if you watched Rounders, but that was like one of my favorite movies. But Mike McDermott, I mean, he's the perfect example of, he literally put his entire account in one game, and he lost. He lost it all. I mean, the opening scene is he literally loses everything he had. So, and then at the end of the movie, he risks everything he had and potentially his life if he loses. Right. So I actually had a slide about him about how like he wouldn't make it as a trader, because if you keep taking these all or nothing bets, eventually even if you're a 99% favorite, if you take thousands of trades, eventually you're going to lose. I mean, you're going to lose everything. So yeah, that's the equivalent for poker with trading.
Excellent. And could you go to the slide that compares heat with risk, if you don't mind? Because I thought this was interesting. Because for me, the bigger drawdowns for me are when I've got a sizable position. Maybe I've got 3, 15, 20% positions in leaders, and it's coming off the top of profits, but it still hurts quite a bit.
Right.
So how do you compare progressive exposure and just risk management when you're first starting positions versus when they've been trending, they've been doing well, they're just they're acting fine, but then they start pulling in off the top, because obviously to keep the monthly drawdowns, you don't want to give too much back, and sometimes even a pullback to the 21 EMA, which is completely normal in a trend, is pretty sizable in some of these higher ADR leader names. So how do you kind of think about that to keep those monthly drawdowns and overall drawdowns, within the parameters that you're looking for?
Right. So in that kind of scenario, so I look at the percentage extended from the moving average. So each stock has its own character in terms of how extended it'll get. But if it gets really extended from the 21 EMA, then I'll sell. I mean, I'll sell some or most to prevent that kind of equity give back. But yeah, I mean, so again, this depends on the trader. Some guys, to them it's like it's open P&L. They're willing, it's not risk to their initial risk. It's open P&L. They're willing to risk that to make more, right? And if you go back and study like the late 90s, I mean, some of these names, they just keep going. They pull back. They'll have these really fast 25% pullbacks to the 21 EMA, go sideways for a week or two, and then launch and double again. So it obviously there's no guarantee that's going to happen, and that might be the time when it sells off and forms a longer base. But yeah, I mean, it depends so much on the trader. I mean, that's a great position to be in, right? To be in 3 leaders, great open profit. I mean, you have the flexibility to choose what you want to do. If you want to take some profits, reduce risk, reduce heat, and try to play for a bigger move. It depends. I mean, Minervini, he'll just sell. I mean, he'll just lock in the profits and take it. Other traders, they have a longer time frame. They're willing to give back that P&L. This is something you have to discover for yourself, what you're okay with. And if you want the best of both worlds, you can sell half, take half, and let the other half ride. It really depends on the trader. I tend to sell. I'll sell more. I mean, it's very hard for me to hold to the 21 EMA, so I'll sell more. I'll sell 70, 80, 90% of the position when it gets really extended from the moving averages.
Yeah, and I know you did some research, looking at your actual entries and how your performance compared to if you held to the 21 EMA. Can you talk about that process a little bit? Because I think that's a great exercise for traders out there as they're discovering, what their sell rules should be. Do they want to completely let it pull back, or are they better off like selling more into strength? And it does depend on how much you're willing to give back and all that. But yeah, could you talk about that research you did?
Sure. Yeah. So I simply looked at all my trades from last year and just changed the exit to a close below the 21 EMA. Like that was the exit, right? And it like more than doubled my results. Of course, you don't. It's one thing. It's kind of like looking at a chart, right? And saying, you should buy here and sell here. Okay, obviously, but you don't deal with the emotions on the way up. The equity give back, the open P&L give back, would have been immense at some points. And can you? So in the past, I did hold to the 50-day. I told that story in the other interview where I had VIPs, and I was in 10 stocks. They all stopped out except that one. And it pulled right back to the 50-day and bounced. And then I the pain was too much. All those other losses kind of accumulated, and I was like, I just can't deal with this. I'm just going to get out. And I didn't, and I sold it, and it would have kept going. So this is something you have to decide for yourself. What you can emotionally handle, right? So is it superior to hold to the 21 EMA? Like I think it is. Based on my results, when I go back and look at my years of trading, if I held to the 21 EMA, my profits would have been significantly higher. But having the ability to do it is challenging, especially because I size large. I want to have size on in my A setups and in my names that move, and that makes it more difficult. So one thing I could do is size smaller initially, or sell 80-90% and hold a small chunk to the 21 EMA. That's one solution for me.
Yeah, and we also discussed last year, which I think is really important to talk about. Last year was a really nice trending year. During some years, it might be better to sell more to strength. It's more like coming up with a process that works with you, works with how, if you can stomach larger drawdown, maybe you hold more to the 21 EMA and try to let that trend work. Right. But like you said, it's about knowing yourself, knowing what you can handle, and yeah, it impacts your psyche, all these drawdowns, because like you said, it happens in all your stocks all at once. It doesn't just happen in one stock and you can be really objective. If you're feeling heat, you're feeling it on your entire portfolio and all that. Yeah,
absolutely. And I also want to say, if you really want to zoom out and look, so if I held to the 21 EMA, right, my results, let's say I did that, and last year I was up 800%, right? Well, the previous few years, there are some years where I was, maybe slightly up or break even, but if I held to the 21 EMA, I would have been down 20%, right? So because, sometimes the rallies, they fizzle out, and the 21 EMA is an inferior exit to the selling into strength. But over the long run, it's better, by far, it's better. So are you willing to potentially have, say 4 years, right? 100% return, 0 plus 20, or plus 400% return, minus 10, minus 10, minus 10. So to give you an example of the potential changes in results. Obviously, the plus 400 with the small losses is way better, but emotionally dealing with that is a whole other thing. I'm human. I would like to win every year. I want to win every year, and if I had to sacrifice returns for 1 year in order to be positive every year, I would do that, even though it's obviously worse. At the end of all of that, your dollar amount's less, but emotionally, and psychologically, you can handle it better.
And doing what you do allows you to stay in the game versus whether you're willing to give those drawdowns. You're increasing the risk of ruin, increase the big drawdowns, which can knock you out, and then you're not able to trade for 10, 15, get that longer term compounding that is the ultimate goal.
Right. Yeah. At the end of the day, it's a personal thing. You have to decide what's appropriate for you, and the goal is to compound. The goal is to become, at least for me, is you want to have financial freedom. You want to be able to provide for the ones you care about. Long term, if you really make it, you can do to help. I would love to be able to help more people. But that's a longer term goal. But those are all things that again, that's why at the start I talked about
your why.
The why is so important, because if you don't have a really powerful why, it's going to be hard to survive through the adversity, because trading it's really tough. I'm going to refer to my friend again who's been transitioning from poker to trading, and I remember he would tell me, hey, why aren't you running 5 strategies? Why aren't you always in the market? You're leaving money on the table. Why don't you trade crypto as 24/7? And I'm like, dude, like what are you talking about? Like, that's crazy. It's like I want to be in cash. I don't want to constantly have positions on. It's like the stress. And now, this year he's done fantastically well after. He's a crazy boom and buster as well. And then this year he gets it. Like, he finally gets it. And he's told me, wow, like you're right. Like, it's the stress, like the mental fatigue from holding large positions and letting them trend. Like, it's taxing. So he gets it now.
Is he trading a similar way, or is he using other strategies?
Yes, he trades a similar way. He trades more aggressively than I do.
Yeah. What's that process like, do you think, transitioning from poker to trader? Is there a lot of new stuff that you have to learn, or it seems like he's picked up it relatively quickly? Obviously, he's got the benefit of getting to chat with you, who's gone through that same process, but I can imagine it's tough, but there's also probably a lot of helpful things that poker teaches you that translate well.
Right. So I think I mentioned this in the interview before, but the big thing with poker is that anytime you have an edge, you have to maximize it. you have to go for it any chance you can. You have to be extremely aggressive when you see the opportunity. So, you know, you obviously are extremely willing to take risk, and when you see an opportunity, you just aggressively pyramid. So I mean he has that, and I always told him, look, you know, he didn't realize how much of a strength that is. That, you know, most traders are risk averse because most of the guys like him blow up, and he's blown up, you know, multiple times, right? So the big thing with poker is the aggression. I think, you know, like the winning poker players are extremely aggressive. You just have to be. You know, you cannot sit back and be passive in poker. You have to be aggressive. You have to win pots when you have draws and you don't have the best hand. You can't just sit back and wait for the nuts. So definitely the aggression and the risk taking, but you have to control it, right? And he didn't control it. He would start losing and he'd go on tilt and he'd increase his size, and then, you know, he could blow up in like a week. I mean, you know, trading crypto on leverage and some of those like bucket shops, I mean, you could blow up real fast. So for him, I always told him, look, if you can learn to control the drawdowns, like the sky's the limit. It's just you have to do it. Like, I can't sit there and make you control yourself. Like, you have to be the one. Like, you're clicking the buttons, not me, right? Like, you have to control it. Otherwise, you're just going to be in this endless cycle of boom and bust, boom and bust, boom and bust. Yeah.
What was kind of your initial advice to him about risk management, setting stops, all of that? You know, how is risk management different in trading versus poker, and what kind of adjustments do you need to make?
Right. So first off, when I told my friends I was going to switch from poker to trading, they thought I was crazy. Like what are you doing? Like, you know, you're a great player. You know, you've done extremely well. Why? I'm like, well, I don't want to be sitting at a computer clicking the mouse 100 times a minute for the next 20 plus years. I love the markets. I love the freedom, the flexibility, the time. I mean, the time is huge. I mean, time is the most valuable thing you have. And, you know, I want to be able to spend time with my children. So, you know, so my why was I wanted to have the freedom to spend time with my kids when they're young. You know, because 95% of the time you spend with your kids is before they turn 18. Which is sad, but it's like, you know, but it's the truth. You know, I want to spend time with them while I still can. So that was a very powerful why for me to make that transition, because you go from being an expert at something to being a total beginner, right? I mean, you know, obviously some of the skills help, but it's a huge pill to swallow. You know, it's a massive pill to swallow, ego pill. I mean, your ego, you go from being an expert to being a total beginner, right? So, but in terms of risk management, I mean, poker has that, you know, I think, I'm trying to remember, I think you want to have ideally 100 buy-ins for whatever stake you play. So if you play 10-20 and the buy-in's $2,000, you want to have 100 buy-ins. So you want to have, what? You want to have $200,000. I mean, that's in general. Now, if you're aggressive, you can try to move up stakes with 50 buy-ins or 20 buy-ins, but if you're going to move up with only 20 buy-ins, so that'd be, you know, $40,000 at 10-20, you want to be very quick to drop down if you start losing. So, you know, that's something that poker players really struggle with, because as you move up stakes in poker, the players get tougher. Like the pros, you know, the higher you go, the better the pros are. So, but you want to level up. You want to play, you know, you want to play in bigger games and make more money, but you deal with tougher competition. So it's very common when players would try to move up, they would get knocked back down because the pros are tougher. You know, you're not used to the aggression at the higher stakes. So, you know, going back and forth between stakes is very common as players are trying to transition and move up, and that's something I've experienced in my trading, is that, you know, as you win and your account grows, you know, because I'm really trying to compound, is that the dollar amount gets bigger, and that increases the emotion and that increases the errors. So being able to control yourself when the dollar amount gets bigger, that's a whole nother skill that you kind of learn by doing. But, you know, I push myself. You know, I try to push myself through the errors that I make, and focus on the bigger goal of continuing to compound.
Are you focused much more when there's a potential trade? Are you much more focused on the risk side of things now versus the potential? Like, nailing the entry. Obviously, that's part of risk management, but you know, is risk management the focus now when you're trading?
Yes, I mean, I've been through a 60% plus drawdown. I never want to have that happen again. So yes, I am extremely focused on the risk. And like I said, where I had the core weave and pony trades where I like got whacked, I mean, I could have very easily just kept sizing and going for it, and it would have worked out because, you know, it's a powerful market, and I would have gotten bailed out. But you are setting yourself up for a brutal drawdown when it doesn't work out. Because if it doesn't work out, it can get very ugly. So it's very important because the good times always end. Sadly, eventually there will be a bear market after a bull market, and when that happens, thankfully this last one it was sharp and quick, and there weren't that many false. I don't think there were really any false rallies with leaders setting up, but there will be bear markets where you get multiple rallies where it looks like it's over and it's not, and everything fails. And if you get knocked out of those names and you see other names setting up and you're like, okay, well, that was the bottom, it's time to go, and you size up, and then those fail, everything fails, and now, and that happens, 3, 4, 5, 2000 to 2003, there was like 10 plus rallies that all failed. And if you were just constantly sizing up, trying to catch the bottom, you got obliterated. So it's very important to think long term, and again, focus on the compounding aspect of it to keep the losses and try to as small as possible.
Excellent. And can you go to the slide with the Mark Minervini quote about market wizard things? Because when I read this quote initially, obviously risk management is huge, and keeping small losses is definitely a market wizard thing. But it also reminded me of the work that you showcased in the previous podcast we did about studying leaders, and that helps just build the mental blueprint about how to manage a trade. What does a plus trade look like versus not? Do you want to talk a little bit about, or could you talk a little bit about how you organize things, what you've kind of studied that has helped your process and helped shorten the learning curve for you?
Sure. The big thing is going back and studying previous market leaders, because that gives you the confidence that they're always going to come back. There'll always be a leader, and then in a strong rally, you'll get multiple chances to make a return. It's not like, if you miss, Hood or Palantir at the start of the rally. Obviously everyone wishes they somehow caught it there, but if you don't, there's plenty of other stocks that will break out and go. And even if you missed, let's say you missed everything up to this point, okay? Well, guess what? A lot of these names haven't even formed a second stage base yet. That was the first base. Now they double, and then they form the second stage base. And you could argue that next base will actually be easier because, take a stock like Rocket Lab, right? It's gone. It's doubled from its base. The next base it forms is going to be at all-time highs, okay? There's going to be no overhead supply. So it's much more likely you get a smoother breakout that time. So going back and studying history and realizing these moves, they last for a very long time, and there's lots of chances to get on board, and you don't need to be in a rush. You don't need to feel FOMO. The opportunities will always be there. And let's say you miss this rally, and then they set up again, and you miss that one too. Well, there will be another one. The guys were asking me the other day about CoreWeave. You missed CoreWeave, and I'm like, yeah, the worst thing is to be super bullish, have conviction in a name, and it's not even missing it, but losing money on it, and missing it, right? How does it get any worse than that? But I'm like, look, it's okay. There'll be another CoreWeave. There will be another. I have theories on this rally, but I think it's gonna be like the late 90s. I really do. I think there's gonna be just unbelievable opportunity in the next few years. So there's going to be plenty of chances to get it back up to the plate and take swings, and you just have to connect with a few, and you can have a great return.
Excellent. And just to bring it back to progressive exposure risk management, and to summarize a little bit, it's basically bending with the punches, sizing up when trades are working. You said 2 to 4, you'll size up a little bit, or to the max parameter that you have, and then similarly when maybe the market's not right, maybe you're just not right, when you start seeing trades not work out, you're sizing down a little bit. And also it seemed like it's not just your trading, it's also a holistic view. What is stuff on your watch list doing? What are leaders doing in the market? Taking into account that. Is that a good summary of kind of the key points that you want to share with people today?
Yes, definitely. Yes. So, if, for instance, like today, there's a lot of speculative stuff. I haven't looked at the market in the last 30 minutes, but there's a lot of speculative names, breaking out and going today. So that would give me more, I don't know if conviction is the right word, but yeah, I guess more conviction that the breakouts are that there's still risk on, basically, right? Yeah. But what your summary was very accurate. Yes.
Excellent. Any other key takeaways or just general advice that you think you'd like to leave everybody watching here today with, and any last guidance or key points about risk management or progressive exposure?
Yeah, it would be with the compounding, just that keep a long-term view of things and realize, that, I think that a 25% CAGR, while challenging, this is not easy, right? But it's attainable, and you can see if you can maintain that consistency and longevity, that the returns are phenomenal, right? Like don't be in a rush. Don't worry. If you have the discipline and the patience, it'll work out. I mean, it'll work out. I mean, and you can see the long term returns of what's possible. Oh, and I also wanted to point out that I don't know if I did the trailing 20-year CAGR for the QQQ is 15%.
Mm-hmm.
The trailing 20-year CAGR for SPY is 13%. Will that sustain? Maybe that's a bit elevated, but that's still, those are fantastic numbers, and you can see, the power of just investing in the Qs. So, if trading's not for you, you got the Qs to buy, and if you hold it for 30 years, I mean, maybe it's not 15%, maybe it's 10%, but still, every dollar becomes 17, and you get the advantage of compounding without paying tax, and it's a long-term capital gain. So there's that as well.
Excellent. Yeah, be involved somehow, whether it's trading or investing.
Oh, yeah. There's a great analogy.
Yeah.
Sorry to interrupt you, Richard, but
Please.
it's I can't remember where I saw this, but my kid loves playing Monopoly, and I had I'm trying to teach him about investing and the power of compounding and investing, and I can't remember where I read this, but basically, not investing is like playing Monopoly and not buying any property. It's like you just go around and collect your $200 every game. Now, obviously, life, Monopoly is not life. You can't win at life. I mean, you can win. I mean, winning at life is getting what you want out of life. I mean, that's winning, right? Whatever that may be. Maybe for some people, it's like I just want to play tennis twice a week. I love being able to. Maybe some people, I want to retire early. Maybe I want to be able to spend more time with my kids. I want to, whatever it is, right? But investing gives you the potential to have financial freedom and to be able to live a more fulfilling life. So that's something that I try to pass on to them.
Yeah, I think that's a beautiful message. Chris, thank you so much for your time. Appreciate it. I definitely recommend to everybody watch our previous podcast. We'll probably link it down below. Really excellent stuff going through his trades and process and deep into a lot of the concepts we talked about today. We'll link that down below. But I hope you guys enjoyed. Leave a like if you did. And we'll be back right back with the next presenter. And Chris, thank you again for your time. And we'll see you guys in the next one. Cheers.
All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, Brad Freeman, representing the investors in the house. Really excited for this one. I think it'll be a great deep dive and chat about going beyond the stock pattern. And I think all of us traders can benefit from learning more about the fundamental side of things to learn more about the story behind a stock. So Brad, first of all, thank you so much for being here. You're, of course, the founder of the Stock Market Nerd, which you can check out in the description. But great to have you. Thanks so much for being here.
Great to be here. Thank you for having me. And Richard is kind enough to let me do this interview style so that I'm not rambling for 60 straight minutes, which sound a little intimidating to me. But this sounds like a super fun conversation, so I'm really excited to dig in.
We'll make it work for sure. And there's going to be a lot of great case studies focused on today and really showing how Brad dives into both the metrics and the stories behind a company. But first things first, Brad, do you mind just giving maybe a high-level overview of your fundamental process? How do you typically get a stock on your radar in the first place, a company on your radar in the first place, and what's kind of your starting point for going deeper into what they actually do and learning more about the financials?
Absolutely. So I guess for inspiration and for crowdsourcing ideas, it is a lot of crowdsourcing. It is leaning on opinions from dozens of smart people who I respect and who I know well. It's using the Peter Lynch style of who's a famous investor of using your surroundings and what are you interacting with and what are you consuming and what trends are you noticing. But it's doing all of that while using those ideas and those somewhat anecdotal factors for inspiration and for getting my foot in the door and for kind of sorting through and sifting through what I think deserves a closer look. And from there, it's turning that inspiration into either conviction or a lack of interest just through careful research and through a lot of the things that I'm sure you're going to ask me about next.
Yeah, and are you focused on any particular sector or theme? Like, do you prefer companies with recurring business models or anything like that? What are you typically focused on? Because I don't want to classify you as a growth stock investor. I want you to kind of define for yourself what you like to do. But yeah, from that perspective, what areas of the market are you usually focused on?
Yeah. So I do and I'm going to cite Investing Legend throughout this talk because I use them a lot and I use them for all the wisdom they've bestowed on the world over their decades of investing. But I love Buffett's idea of circle of competence, of the stock market being a no-call strike game and you being able to miss great opportunities left and right without losing money and really without hurting your chances of outperforming markets. There are just so many opportunities and so many deals always happening within Mr. Market. And I think focusing on fewer pockets of that, fewer facets of that, is super valuable for people and allows success rates and performance to really improve. So for me, what that looks like is avoiding things like biotech because biotech and healthcare I don't really touch with 10-foot poles. If you ask me how the U.S. healthcare system works, I would look at you with kind of a confused look and say I don't know. And I think just respecting our lack of knowledge in some places is super important. And for me, that means gravitating towards consumer and enterprise software. It means gravitating towards consumer discretionary. And those are really the two sectors or pockets of the market that make up most of my exposure. That does look like a growth portfolio to some people, and rightfully so. But I am not seeking out. I'm not seeking out only growth darlings. I'm seeking out good value and great risk reward and a better probability of beating a market with a given position. Sometimes that looks like a boring company like PayPal. Sometimes that looks like a more exciting company like a CrowdStrike or like a Trade Desk. And really it's evaluating each story within that circle of competence that I preside in and engaging risk reward for each individual name instead of saying I want to be in consumer discretionary with 40% of my portfolio. I want to be in consumer finance with 10%. And there are guardrails that I use for making sure that things aren't diversified and making sure I don't have a portfolio full of things that are going to be correlated perfectly with each other as markets go up and down. But there are themes that kind of stem from that mindset. And I think another theme that we'll get into is kind of evaluating financials and what I'm looking at. And so I'll talk more about things like PEG ratios, price to earnings divided by growth ratios, estimate trend, things like that when prompted or later on.
Yeah, for sure. First, I want to key in on something you just said there, value and risk reward. Could you define those terms for you from your perspective? Because if you ask me what's the value of Tesla right now, I'd go look up the stock chart and say it's worth whatever it's trading at. But obviously, as an investor perspective, you've got a different view. So I'd love to hear kind of your perspective on that.
Yeah, and it's not so much looking at traditional PE ratios and saying that trades for 25 times earnings and that trades for 27 times earnings, so 27 is bigger than 25 and so it's more expensive. It's really evaluating the holistic picture of how a company has performed in the recent past and how they're expected to perform going forward. So if there's a company that is delivering wildly visible and structural and high probability, high conviction, fast growth, they deserve to trade at a higher multiple than another company trading that has inherently cyclical pieces of their business and uncertain pieces of their future growth picture. So we'll talk. I should probably just get into PEG ratios now and price to earnings to growth. And in the earnings, so that this is another thing that I borrow from Peter Lynch, but for him, it's price to earnings divided by 1 year of earnings growth. For me, it's making sure we're using at least one profit key performance indicator from the income statement. So whether that's operating income or EBIT or net income, sometimes there are a few things that throw net income off that make EBIT less noisy, and I'll use that in that case. But having one of those two in the valuation picture is extremely important. And then using a free cash flow growth multiple, so borrowing from the other very important financial statement in terms of profitability, to make sure that there aren't things like gigantic stock comp add backs that are making one of those multiples look good and the other one not look so good, so that you can kind of be instructed on where to look when things are way off and they shouldn't be. So that's super helpful for me. But I think it's just, again, evaluating every company as its own living organism, pulling from peers in the sector to kind of guide and fortify that research, but really treating every company as its own living, breathing organism. I think that's super important. And when there is when there is a company like CrowdStrike that's going to deliver whatever 30-40% profit growth, as far as the eye can see, where macro cycles haven't really impacted it in the past, where estimate trends from analysts are up and to the right, so every time they beat and raise every single quarter, and all of those, and then looking at things like historical PE charts. So if it used to trade for 100 times earnings for 3 years and now it trades for 40 times earnings in a not so good period, what's that going to look like in a much better period? It's just using all these little pieces of context and then using multiple valuation bands. So each company is going to have its own kind of range of valuations that it trades for. So for a super simple example, say CrowdStrike trades between a 2x and a 3x PEG, and that's been the case for 6 or 7 years. And if the fundamental picture is stable and consistent and continues to improve, and it continues to fetch that fast growth and that margin expansion and that seamless cross-selling and all those things that I love to look for, then as it kind of moves towards the lower end of that band, that's when I will really lean in and build out a position. And as it approaches the higher end of that band, which is kind of happening now across markets in several pockets, that's when it's kind of, for me, time to ease up. And it's never I'm exiting 100% of the position, I'm building it immediately over a day. It's I'm going to peel off 15%, and if the multiple band expands by another point or two, I'm going to peel off another 10%. And if it just keeps expanding and keeps getting more and more expensive, that's really what I mean by risk reward. When I'm talking about risk reward deteriorating, when things get more and more expensive, no matter how high quality a company is, the risk reward is always, all things else equal, worse. And the probability of you beating markets or beating the S&P 500 over a holding period falls and falls and falls. So as that probability is falling, I'm lightening up. As it's getting better, I'm leaning in and just acknowledging the fact that I'm not going to do this perfectly. I'm going to make mistakes. I'm not going to time bottoms and time tops, and I'm not going to try. But for me, over the last several years, that's really been a process that's taken a lot of the impulse out of the decisions I make, a lot of the anxiety, a lot of the decision fatigue out of this whole process. And really, those kind of decisions have been put in autopilot by a set of rules that I've given to myself. And it's really just taken the emotion out of things and maybe more disciplined and process oriented and successful. I'm not feeling like a chicken with my head cut off and what am I going to do tomorrow? It's there are triggers and decisions just like you guys have with your charts. Just like you're looking at from a different lens that are instructing me on when to get conservative or get aggressive.
And that's the key behind all processes in the market. When you've got a position that's fluctuating between, a great value right now versus getting stretched valuation wise,
what's kind of your core position size, and what would you get it to as it becomes, a bit better value from your perspective, and how much might you sell of that position if you see it's getting stretched? What's kind of that variability?
Yeah, there are, and I do have guardrails, but I will break these rules pretty consistently. And if there's a 4% max, and I think it's a good decision to make it 4.1% of a portfolio, and I can explain it to someone like explain it to a mentor who I'll use to kind of screen opinions and tell me when I'm being an idiot. Then I will break that rule. But there are two different buckets of an answer there, pre-profit and post-profit. So I think at this point, 95% of my portfolio allocation is profitable, but there are still some more speculative, more risky bets. And for companies like that, usually it's starting a position at about 2% of a portfolio, with my own money allowing that to become 4% of my invested capital, and it can grow from there on its own. But 2-4 for unprofitable, and then 3-6 for profitable companies. So yeah, I think I'll leave it there instead of rambling for some minutes.
No, it's good. So around 20 something positions at any given time, around there.
It's 18 to 22. That's been the consistent range over the last few years.
Gotcha. And I want to take a step back here, because I wanted to nail down a little bit on this. For say there's a new stock that catches your eye based on what people are talking about on Twitter or your own research. What would be 3 things? Or it could be 4 things too if you've got them. But what would be a few things that would say, okay, I really need to focus on this name. It's got the characteristics that I'm kind of looking for. What would be a few things that would say, all right, I really need to get focused and do my research on this name and potentially look for just to start a position?
Yeah, and I've spoken about treating every company individually, but for this answer, there are sector-wide signals and data points that are super important. So I think from a demand perspective, market share trends are extremely important. So if there's a brand new sector growing 80% year over year and just scaling like crazy, and there's a company delivering 50% year over year growth within that bucket, and they're ceding market share to other companies, that 50% growth actually can be less compelling than something like maybe cloud computing, for example, where it's growing 10-15% pretty smoothly per year, and something like Azure is growing 30% year over year. That can be more compelling to me than the 50% growth. And I guess, like, we talk about demand a lot, and that's a pretty generic term, but a somewhat annoying part about what we do is within each sector there are 2 or 3 demand key performance indicators, or KPIs, that matter more for some companies than for others. So I guess within something like software, annual recurring revenue, or the total value of their annualized contracts in terms of revenue, remaining performance obligations is an extremely important look into future bookings and what the backlog, how the backlog is trending. So how, if you see something like remaining performance obligations, or another great forward-looking demand indicator could be something like, let's stick to RPO for now, and I won't throw out too many terms.
What's RPO? Just because I'm familiar.
Remaining performance obligation. So it's a way of calculating backlog, or the total demand obligations you have kind of looking forward
in the future.
And companies like Salesforce will give you a current RPO, which is your next 12 months of backlog, and then a total RPO, which is your full backlog. But Oracle's a good case study here. They've been absolutely killing it within AI infrastructure. Their Oracle Cloud Infrastructure OCI product has just been taking rapid share, just with their positioning we don't need to get into. But their revenue growth has been trending around 10-15% year over year. And then you look at their remaining performance obligation growth, and it's 40-50% year over year. And to me, that's telling me that the contracts they're signing looking forward are going to contribute to an acceleration in revenue growth. So the near-term demand factors and the future forward-looking demand factors will converge over time. And that bodes very well for improving revenue growth. So from a demand perspective, that's super important. I guess looking at some other sectors, okay, so maybe sticking with that sector. If your listeners couldn't tell, this is why we did an interview style instead of me just rambling for 60 minutes, because
this is good stuff.
I do kind of go all over the place sometimes. Yeah. But a company like Trade Desk, where they report something called gross revenue retention. So from your existing customers, how much of that business are you retaining into the future? And that doesn't get into expansion from existing customers, which a different metric does. But basically how hard are you having to work to retain your existing book of business? And something like GRR, or gross revenue retention, can give a great idea of that. And then just other consumer discretionary, if we're talking about Starbucks or Chipotle, same store sales growth, I think that's pretty self-explanatory. But there are just these different kind of metrics within each subsection of markets that matter a lot for individual companies, and pairing that with things like how is that growth for that specific metric comparing to all of their other peers gives you a great indication of, are they taking a bigger piece of the pie, which tells you they can grow in excess of whatever the structural growth or whatever economic growth is allowing that sector to actually grow at. So that's super important to me. And then the next one is from a profitability perspective, economies of scale. So as you're going from $1 and $10 and $20 in revenue, are your profit margins improving? Are you having to work harder and harder and harder to earn that incremental revenue? Or do you have the fixed costs, the sales talent, the compute infrastructure, all these costs in place that are allowing you to grow without working so hard to pursue that growth, to let the foundation that you've put in place allow your revenue to 2x, 3x, 4x without your costs 2x, 3xing, and 4xing. And what that means is, as your revenue base gets bigger and as your profit growth is hopefully robust, or as your revenue growth is hopefully robust, your profit growth is going to lead that, is going to be even better, which is when we're tying back to that PEG ratio and that idea that we talked about earlier. You will be rewarded with higher multiples because your bottom line will be growing quickly, and profit per share is really what fundamentally driven analysts are. That's our North Star. That's what we're really yearning for, more profit per share. And then I guess the third thing, which is per share, I guess is a good segue into, is dilution. Are you okay? So executive teams have an obligation to deliver returns for shareholders. That definitely straightforward. There's a massive conflict of interest within there, or potential conflict of interest, where if you want to preserve the cash on your balance sheet, you can use shares to pay employees, and that does align interests. It does make sure employees are working harder to make sure your revenue and your profit grows, because their performance and their compensation is somewhat tied to that. But there are companies that abuse that. And when your share count is growing 8, 9, 10% a year, which I know that sounds ridiculous to some people, but there are some companies delivering that kind of share growth right now, even outside of mergers and acquisitions, that directly eats into the financial value creation that we should be enjoying from profit going from $1 to $2 or $3, right? Because you're dividing by an ever increasing share count, and you are diluting the amount of profit that you're entitled to as that shareholder. So those three things are super important. And then I think number 4 is a little bit different, but it's respecting the fact that there are other very smart people that do what we do and that have access to great data and that have great things to say. And there are services that will take all of these opinions and all of these financial estimates, and they will aggregate them for us, and they will show us on July 1st. This company was expected to earn 78 cents, but now they're expected to earn 76 cents. And so why are profit revisions falling? And when that's happening, you kind of have to ask yourself, is momentum deteriorating? Is their competitive positioning kind of waning? Or is this just some kind of exogenous backdrop macro event that's hurting their overall sector? So I love when revisions are up and to the right, because it creates a lot of inefficiency for strictly value PE driven
valuations.
Yeah, because they'll see, well, this trades for 80 times forward earnings, and ignoring the fact for a second that, well, profit might be growing at 80% for a couple of years, but it probably doesn't trade for 80 times forward earnings, because revisions are up and to the right, because this company is beating and raising every single quarter, and that's probably going to continue because nothing's really changed. And yeah, so those 4 things are super important. I was going to get into a totally different idea, and so I think I want to leave it there and talk about the next thing later.
Yeah, mention the idea so we can come back to it if you don't mind.
I think so. Kind of the information that I'm kind of using to know if things are going well or if things are not going well.
Yeah, I'll write that down.
Perfect.
It's going well.
If you can tell, this is not scripted. So
yeah.
We are.
This is good though. I want to come back to that same question, but more from a subjective level when it comes to analyzing the management team of a company. Because obviously there's metrics, you can use that to decide whether a name is worth looking into. But the management team is critical for the continued growth and for inspiring employees and making all the key decisions. So what's your process like for diving into the CEO, the key people there, and what are some things you're looking out for on the plus side, but also some things that might be big red flags that you might say, I'll just take my money elsewhere. I'm not sure if I've got conviction in this team.
So I think first and foremost, track record and a quick LinkedIn search, or kind of where they came from, how they did in their position. So someone like Anthony Noto, who's the CEO of SoFi, just checking into things like, well, he was the COO at Twitter, and he was the CFO of the NFL, and he was an Army captain, and everyone who he's worked with has nothing but nice things to say about him. And I think reputation is something that is very, very hard to escape. For some people, that's a very good thing, and for some people, that's a very bad thing. But for us, it's a very convenient thing, because we go online and we see all the opinions and all the stories and all of the press that this person has dealt with throughout their career, and gaining that information makes it a lot easier to gauge whether the things they're telling us in an earnings report are candid and can be trusted or not. So I think that's extremely important. And then kind of along those lines, meeting your promises. So if it's a brand new public company and we don't have several quarters of historical data to pull from, that's harder. But when you're a company like Trade Desk, who for 8 straight years beat and raise versus consensus expectations and your own guidance, and for 8 straight years, no blunders, perfect, and then one quarter you miss, and you give us all of these reasons that you missed and all of the things you're doing to fix it. Those reasons and those fixes to me mean a lot more if the miss is an anomaly and not a consistent theme. And if this is the first time in 8 years you're telling me why things didn't go well, instead of inventing a new excuse for the 3rd consecutive quarter to tell me why things didn't go well again. So that's super important. Just looking at things like comp packages, are they paying themselves egregious amounts of money? Are they just lining their pockets and using their company as an ATM and just liquidating shares left and right? That's somewhat of a red flag. For CEOs, if their CFO position looks like a revolving door, that's probably not a good sign either. If the person signing off on your financial statements doesn't feel like they can stick around and you're on your 4th one in 2 years, that's a big red flag. And then availability. Or actually, I'm going out of order. I think, and then when you actually dig into these earnings materials, sometimes they will just give you these really pretty charts and tables of, here's every single metric we know all of you investors want to see, and we will and they will display it so neatly and so perfectly, and it'll take me 2 minutes to read all of it. And sometimes, like a company like Block, they will send out this 20-page shareholder letter where I have to go into the fine print on the 4th page to see what the revenue was for the quarter. It's like, are you kidding me? Like, why are you making me work so hard to see the things that we all want to see? Right. And when they are making you work that hard, you have to ask yourself, is there a reason they're making you work that hard? Are they trying to hide something from you? Are they trying to confuse and deceive and trick? Usually not, but sometimes yes. And then the only other thing is availability. So I love when I don't care if you're doing podcasts with Twitter people every week, or if you're having a product event every week. But I do love when CEOs and CFOs will participate in investor conferences during the quarter and tell us exactly how things are going, and say, not only every 90 days, here's how we're doing, but we have another event in 30 days where we'll kind of give you another update on the quarter, and another event in 30 days, because that just takes a lot of the drama and a lot of the uncertainty out of how things are going to look in their fresh quarter. So when they're willing to do that, when they're willing to get in front of investors and talk and share things and be vocal and give us new disclosures, that's also greatly appreciated, because we're public investors who only have access to whatever they're willing to share with us. So when they're willing to share with us something that's more valuable and more productive for building an investment case, that's something that I greatly appreciate and gravitate towards.
Is there a CEO or management team that comes to mind as a really good example of that transparency and being really involved, even between earnings reports?
I would say SoFi. I think they do get some pushback for their CEO not willing to do podcasts because he thinks he's going to get asked to do 20 more, and I get that. But I mean, when I'm reaching out to him with questions, he's responding to me and giving me great answers and giving me the information that I need to know. and telling me in a timely manner, here's what you can share. So it's things like that I greatly appreciate. And it's also the fact that they are doing what I've just mentioned. They do 1 or 2 of these investor conferences every single quarter. So there's always all this excitement and build up and intrigue going into SoFi's earnings report. And we sort of know exactly what things are going to look like because they told us exactly what things are going to look like. And they have that track record of things actually looking like what they said they were going to from pulling from what is it now, 4 years of them being a public company. So I do really like and respect Anthony Noto and think he does a great job.
Perfect. And this might tie back into what the thing you wanted me to remind you of, but how important are earnings reports for you? I know it's a busy time for you to catch up on everything, but first things first, for maybe a company that you own, what are you looking forward to diving into in terms of the earnings? Probably there's key metrics for each company depending on the sector and what they do that are the most important thing for you to judge the demand, the future demand, future expectations, if they're in line and all that. But yeah, walk us through your process for reading a single earnings report. What are you looking for and what do you really pay attention to? What stands out?
Yeah, no, it's and then there's different answers for different sectors, which I know is a little bit annoying, but I'll try to kind of provide that nuance. But to me, earnings reports are progress reports. So we got, when we were in school growing up, you would get a list of all your grades and check up on performance, and maybe your teacher would say something to you, and that's what earnings reports really are. It is the quarterly test of are you executing, are you performing, are you continuing to deserve my time, money, and attention, and not only for the companies that I'm currently holding, but for the wait list where there are 10, 20 companies that I greatly respect and know very well because I track these earnings reports every single quarter. And to me, that really puts me in a position to be able to pounce very quickly when I see opportunities surfacing, because I'm not starting from square one where, shoot, I need to go read all of this and make sure I understand everything about the company. It's no, I've been religiously tracking everything about them for the last 2 years, and I've been waiting for this forward valuation as an entry point, and it's here because of X factor, so that's interesting, or it's here because of some maybe not so good thing and it's not interesting. So for me, that really just it makes me prepared. It makes me ready to make the decisions that I need to make in a timely manner, without those decisions being impulsive and without them being influenced by anything other than structural data. So very, very, very important earnings reports. But then maybe the somewhat annoying thing is for a company like, well, I'll keep using the same examples. For a company like Trade Desk, my eyes immediately go to revenue, immediately go to EBITDA, and immediately go to gross revenue retention. But for CrowdStrike, they immediately go to annual recurring revenue and net new annual recurring revenue for demand, and then same and then operating income for profitability. But another very annoying thing is that some companies will not make any adjustments to their operating income. So GAAP accounting, generally accepted accounting principles versus non-GAAP accounting. When you're looking at operating income for one company versus another company, let's say Airbnb, which makes no adjustments, versus CrowdStrike, which does make adjustments. It's just that more nuance to know. You're not measuring apples to apples profitability, because when you have non-GAAP operating income, CrowdStrike is adding back their stock compensation expense into that, and Airbnb is not. So it just kind of maybe not super important, but just more reasons that things are different for each company, and more reasons that things think that I'm looking at things differently for each company. And I think maybe Uber is another great example of looking at different things from a profitability perspective, just because for them net income is about as noisy as it gets. So earnings per share, which is the most important metric for so many companies, is to me the least important profit metric for that company, because they have a massive publicly traded equity portfolio that violently fluctuates every single quarter in value. They have to mark that valuation based on fair market values, and when it goes from $1 billion to $2 billion, they net $1 billion in profitability, and that greatly props up earnings per share. And vice versa, when that portfolio gets cut in half, their earnings per share greatly suffers, and that has nothing to do with the underlying profitability of the company. It has nothing to do with how they executed. It has everything to do with how these other companies are performing and how markets are perceiving that performance. So for them, earnings before operating income, or EBIT, earnings before interest and tax, is just such a better metric for understanding how they're performing in terms of operating efficiency than net income, that it's better. But then for a company like SoFi, where net interest expense or net interest income is such an important part of their business, when you're using earnings before interest and tax, it's before interest, so you were completely ignoring that line item. You were completely ignoring that extremely important part of their operational business, to a point where net income does become, again, by far the most important metric for that company, and EBIT becomes a less important, somewhat irrelevant metric. So I know this sounds a little bit daunting, and to me, if I listened to myself talk 8 years ago and listened to this conversation, it would also sound pretty daunting. But I think the encouraging thing is, it's all new, but it's none of it's that hard to grasp. So it's all arithmetic. We're adding, we're subtracting, we're talking about when you should add this thing instead of this thing because it makes more sense, and it's all quite intuitive. So once you start to do this and start to gain experience, you will very, very quickly begin to notice patterns. And what I am saying, I think if you listen to another 2 or 3 years, would sound almost elementary, and it would sound very, very straightforward. So if this sounds daunting to everyone, or anyone at all, I'm sure to a lot of people it already does sound elementary, but for people who are getting intimidated by this, you shouldn't be. It's all lingo, it's all vocab. Whenever you hear a word you don't understand, just ask Gemini or ask one of the chatbots. It'll explain it to you very quickly, and you will very quickly become well versed in what I'm talking about. Because again, we're not doing calculus. I sucked at calculus in undergrad. We are doing arithmetic. We're adding, subtracting, multiplying, dividing, and just doing so in unique ways and using words and acronyms to make ourselves feel smart and sound smart. So we're not that smart, and you're definitely smart enough to do this, but I'm kind of going off on a tangent. So back to you.
No, I think it distills down to, for each company, what is the metric that best represents the success of the current success and the anticipated future success of growth, earnings, whatever they're focusing on at that time. And there's going to be different metrics that each company cares about. So makes perfect sense. So maybe to use one company as an example, when SoFi reports, obviously there's the metrics that you care about with that one. Are you reading the report first? Are you then listening to the conference call? What's kind of your process like for interpreting that one report?
Yeah, for me, so the earnings one pagers that I'm sure some people know about, and Richard, you can throw.
Should I bring that up?
Yep. Right now. I think it'll be helpful to know what I'm talking about. So the one pager that I'm posting on Twitter, which selfishly I use as top of funnel marketing for the newsletter, but now you know my secret, so don't tell anyone. But the one pagers are really, I kind of know where to look for the information, so read it, get it out as quickly as you can, and make sure it's 100% accurate. Just because, I mean, the game of social media, the quicker breaking news comes out, the more attention it gets, and the more attention my newsletter gets, and that's how I make a living. So for me, that's step one. Step two, we could just use new as an example because it's already up there, but they have a pretty lengthy shareholder letter that I'll immediately start reading. I don't love listening to calls live. I am a bit OCD when it comes to, oh my God, did I just miss something? And oh man, did I just miss something again? So when I'm listening to a recording and can listen to it on 2x speed and rewind 10 seconds and rewind whenever I need to, that's a lot more comforting to me to make sure I'm not missing anything, because to me, missing one tiny fine detail feels like the end of the world, which is a gift and a curse, I guess. Mainly a curse, but somewhat of a gift. I'm reading the letter, jotting down all those notes, making sure all of the financial tables that are included in the earnings reviews are filled out and look good, making sure the guidance section is filled out, and then using, besides the headline quantitative data, which I'll offer a little bit of commentary on, in the call and release section of every review. That's really where we get into fundamental progress of the more qualitative things, and I guess there are more quantitative statistics, but really these 5 things matter for this company, and here's how thing number 1 is going, and this was good, this was bad, and doing that, and then using the letter to do that, and then I'll listen to the call and listen to the Q&A and fill in the details from there, just because the good calls the recordings take about an hour or 2 to come out, so I usually have time to kind of consolidate and aggregate everything all the notes that I've taken from the letter into kind of cohesive paragraphs and easy to understand and read things, and then use the call and the transcript to kind of enrich all of that and tie it in a neat little bow and send it out to the readers.
And walk us through maybe this NU earnings sheet. And I don't know if you can see my mouse here, but this top box, what are you including there? And then we'll do this bottom box as well, just to break it down step by step. Yeah.
So I think we talked about earlier 3 or 4 things you look for in a company, and I kind of split that by demand and profitability. That top box is demand key performance indicators, or KPIs. So for new in the detailed reviews, there are a lot more rows in the charts, but just for putting something on Twitter and X, it makes the font a lot smaller and harder to read, and it makes it less pretty. But for this company, me putting revenue deposits and customers in that chart tells you those are the 3 most important demand key performance indicators that I'm looking at, and then I guess rationale for why the columns are structured the way they are. I do for some companies, quarter over quarter, that's what Q over Q means, and Y over Y is year over year. Growth is somewhat irrelevant. For a company like CrowdStrike that's signing really smooth contracts, quarter over quarter growth is extremely important. For a company like Airbnb, which is very tied to holidays and seasonality, quarter over quarter growth is irrelevant, but it's always in there just for more information. And then year over year, and then 2-year compounded annual growth, just to give a longer term sense of how demand trends are going. And if year over year growth is faster than 2-year CAGR, things are accelerating, and vice versa. They're slowing down if it's slower than 2-year. Kind of looking into the second part of the chart, for this company, gross profit margin is extremely important, which is why it's there, because to them that tells you how effectively they're pricing risk. It tells you how much they're being compensated for their credit losses and their balance sheet risk that they're taking for funding their loan book. So if gross profit margin is improving, it means they are properly pricing their risk. Risk-adjusted NIM, which is net interest margin, is a kind of very similar but not identical way of looking at how they're pricing risk, which deducts something called current expected credit losses, which is very important for a company like this. So those top two, those top two are super important for gauging how well New is doing as an underwriter. Are they being fairly paid as they expand into Mexico, as they expand into Colombia, as they dip their toes into maybe less ultra prime credit bands? Are they being appropriately compensated with repayments that are making up for the amount of added risk they're taking? And then net income and GAAP net income, more similar to a traditional company outside of lending. It's all of that we talked about with credit costs, and then also deducting all the operating expenses like general administrative, sales and marketing, research and development, things like that, to where you end up with the bottom line or net income on an income statement. So for most companies I'm looking at, net income will be there. But for most of them, EBIT or operating income will also be there, just because that usually is my favorite metric on the income statement. But again, just like we talked about with SoFi, the interest parts, or earnings before interest and tax, that interest part is such an important part of their actual business. New is also a bank, so the same can be said for them too.
Excellent. And then these last bullets are just kind of key takeaways for you, or key. Yeah. What exactly are these? Yeah.
There probably should be more structure and more reason for the bullets that go in there, but I do, for a growth company, I do like comparing how the 2-year compounded annual growth rate, CAGR, compares to last quarter and the quarter before. Just again, another kind of view into, are things slowing down or are they speeding up? For a company like Nubank, where they're doing a ton of all of their business in Mexican pesos and Brazilian reals, foreign exchange neutral, or FXN revenue growth, so revenue growth excluding currency fluctuations, is more important to me for understanding what the future growth engine looks like than their actual revenue growth, just because currency fluctuations are outside of their control and irrelevant in terms of things like market share, and gaining customers and gaining deposits and things like that. So that shows you and for New right now, currency has been a massive headwind that just kind of flipped to a tailwind over the last few weeks, although there are now tariffs on Brazil, so we'll see how that kind of trends over the next few weeks, but fun times. So foreign exchange neutral growth, it has been much faster than actual growth, and I think that's super important to consider for this company, because you look at the year-over-year growth column in the revenue, year-over-year growth in the revenue part of that chart, and it's 19% year-over-year, and that maybe doesn't impress you as much for a company that's supposed to be in hyper growth mode. But then you look at the fact that there's a 21-point headwind from currency, and they're actually growing apples to apples 40% year over year. It's just more important context to consider. And then after that, key balance sheet items, so liquidity, debt, they don't really provide us that great of information on capital ratios, but if they did, it would also be in there, which are important kind of liquidity mandates for banks. From regulators, you have to have this much cash or liquid assets set aside to make sure if sugar honey iced tea hits the fan, that you have enough money in the bank to make sure that you're not going to go belly up. And then just other important notes like something like, and we can get into this later if you'd like, but you can gap GPM or gap gross profit margin, that first column of the profit chart. You can see that it's contracting, it's falling, and it's been falling for about a year now. But that's because they're expanding into new markets where gross profit margin is lower than their original largest market of Brazil. And they're having so much success in these new markets that it's growing as a percentage of the revenue more quickly than it was supposed to. And so gross margin is suffering. But to me, it's another one of those evaluating companies and evaluating headwinds and tailwinds as their own kind of special item. So to me, in this case, beating up on them or getting upset with them because gross profit margin is falling because they're killing it in Mexico and Colombia doesn't make a lot of sense. But if it were falling because credit losses are going through the roof and they are taking more credit risk and they are expanding into these subprime borrowers and are being irresponsible, then that would be something where I think to myself, okay, time to move on. So yeah, I guess just more annoying nuance for people to grasp.
Yeah, no problem. For a company like New and other international companies, do you have another thing that you consider versus a domestic company in the U.S., or it's pretty much the same process?
I definitely will consider, I guess, geopolitics, and so something like in maybe something that made me gravitate towards Latin America for some of my international exposure is just how compelling the population growth dynamics are, and how compelling GDP per capita is when you compare that to the penetration they have on things like credit cards, personal loans, level being properly banked or not underbanked, that term we hear thrown around by a ton of companies. So it's this combination of you guys have more money per person than a lot of these other countries that are way more advanced than you are in terms of people paying with credit cards or people paying with buy now pay later or people using tap to pay or things like that. So it's can a company come in here and create more convenient and more compelling workflows or processes for consumers to use these products where they have the money, they have the means, they have the education to be similar to these other countries that are using them more frequently, but they aren't yet. And there's just some disconnect and some piece of the puzzle that's missing. And it's looking at a company like New or looking at a company like Mercado Libre in terms of e-commerce and how behind Latin America was for e-commerce penetration before they really rev their engine. And it's just seeing opportunities through that lens. But then something like maybe looking at Korea and Coupang and a company like that where there is no population growth, and there probably won't be any population growth outside of maybe some immigration programs they can figure out, or I know they're trying to pay young women to have babies now, which we'll see kind of how that does for them. But that gives you an idea, just like Japan, gives you an idea of how dire the population growth situation is for them right now. And for me, that made me much more interested in are there other markets where you can kind of feasibly expand into and have a similar probability of success and be able to find your own population growth, so your addressable market growth, your population growth for Coupang through kind of means like that, because it's not going to come from Korea. And how much cross-selling do you have left to do? Like how many, in terms of assortment on your e-commerce marketplace, are you selling people the 50 things they want in every category and that's kind of it? Or are you selling them 10 things and your power users are consuming those 50 things, and now you just need to figure out a way to get everyone else from 10 to 50? That can kind of combat and overcome slower population growth. But I think things like how does the U.S. look? There's 25%, or what are we at, like 25% e-commerce penetration or something like that. So you'd think countries in Western Europe should look similar, which they do. And then you'd think countries in Latin America will eventually look similar, but maybe on a longer delay, just because they've been on a longer delay for most technological revolutions. And then do they have the characteristics for the population to embrace that evolution, and who's the company that's best positioned to give them that evolution and delight them with new products?
From your perspective and thinking back, has there been a quarter earnings report that really stood out in a positive way for you and got you to say, hey, I need to increase my allocation to this company? Is there a name that comes to mind that says that they either reported some metric or revised upward guidance, or the CEO maybe said something that was game changing and said, okay, I that changed my perspective on things. Maybe you didn't own the company before and you said, okay, now they prove themselves. Anything coming to mind?
Yeah, maybe, and it's not one that I'm gonna say two, and I don't even own them, and it wasn't like I need to buy more. It was a dang, I missed the boat here, and I could have, I probably should have had exposure before I did, but and I don't, but I think Nvidia's last 2 years, just the level of beats at the gigantic scale and gigantic growth rates that they've been reporting on the data center segment for their GPU business has been so incredibly impressive, and is showing not really signs of slowing down. If you look at all the deals that they're signing and look at the fact that Oracle is re-upping with OpenAI to build more giant data centers as part of Stargate, and then Jensen talks about next generation models needing 100x to 1000x the compute of the generation before. So the reasoning models need way more chips and way more compute and way more data center capacity, way more cooling power, way more connectivity, way more everything. That kind of doesn't feel like things are slowing down. And I mean, it's not only the incredible growth that they've posted, it's the fact that they're doing it at 60% operating margins, which for a company like Intel, their goal is to have a 53% gross profit margin, which is profit before you deduct all of the operating expenses. And Nvidia is surpassing that after deducting all of the operating expenses, which is just such a clear sign of their technological lead being massive. Because if any other company was remotely close to them in the performance and efficiency that they could be purchasing chips with, then they'd be buying chips from AMD, they'd be buying chips from Amazon and Google and custom chips from Broadcom and trying to figure out how to emulate the amount of performance that they're getting with not such a gigantic, absurd price tag that Nvidia is rightfully charging, because they're so much better than everyone else and because they're innovating so much faster than everyone else. And I know AMD has a chip release that a lot of people, or Dylan Patel, who's a brilliant semiconductor analyst, is super excited about later this year. So we'll see if they kind of make headway and close that gap. But when you look at what Nvidia is doing, when you look at their growth rates and compare that to AMD and Marvel and some of these other companies that are trying to compete, maybe not in the GPU data center space, but in the data center space in some capacity, there is a reason why things look so much better for them than everyone else, and it's tech. And I think the second one is Palantir, which I don't even know what it's trading at now, but I do know that 30% ago I was calling it expensive, and now it's 30% higher, $142 a share, and I think that's again pushing 100 times forward sales, which is 20 times forward sales is expensive. So 100 times you can kind of extrapolate from that what you want, but I'm not going to argue that they deserve this multiple, because I don't think anything has ever deserved this multiple and probably never will. But if you can argue one company has deserved something that's bubbly and crazily priced and absurdly valued, it is Palantir, because within this gigantic Gen AI boom we've had, all of the monetization has come from Nvidia selling GPUs, Broadcom selling their connectivity equipment, and their ASICs, which again is just a custom chip, which is less general purpose than a GPU, kind of like what Google does with their TPUs. But it's all happened there, and then it's all happened with the cloud providers, so AWS and Azure and Oracle and Google Cloud reselling or renting out that compute capacity to other companies to try to figure out what the hell we're going to do with this. And what the hell we're going to do with this has been very hard for people outside of automating some coding workflows and some customer service workflows, which has been a home run for a lot of companies, and that's been great. But beyond that, the software layer of Gen AI has had a much tougher time in terms of getting off the ground in monetization. And when you look at who's figuring it out, it's Palantir with the AIP, or artificial intelligence platform that they've sold, that they've manufactured this massive acceleration in growth, several quarters stringing together of vastly outperforming analyst expectations, which you can do that for a quarter or two, but when you do that for a few quarters in a row, analysts start to think to themselves, well, maybe it's time to raise these estimates because you're kind of sandbagging and I need to do that. And it gets harder and harder and harder to keep delivering these monstrous beats, and they've done so over and over and over again. And it makes sense why they are, because while other companies are talking about experimentation and figuring out what to do with AI, Palantir is talking about shrinking onboarding processes for companies from months to days, or 100,000xing the pace of drug discovery and protein synthesis, or whatever the heck, I don't do biotech, so whatever the heck it's called, for these biotech companies that are just realizing this incredible acceleration in machine learning that they've done for years and years. But now that they're able to do at such a higher level and such a crazy level compared to what they've been able to do before, that they will pay Palantir lots of money, and customers will flock to them because of the utility that they're providing, as evidenced by the countless case studies they share with us with tangible quantitative evidence every single quarter. Not to mention the fact that they've done this really without building out an enterprise go-to-market team, and they've done so really through just bringing customers to events at their boot camps, they call them, and saying, hey, look what we can do for you. And them being, these customers being so taken back by what they can do that they sign on the spot and start building that day. So ServiceNow maybe is another company that you could say has done a great job with monetizing Gen AI. I think Azure, maybe Copilot, you could say has been good at that. Although I think the AI contribution for Microsoft is really clouded by OpenAI and how much GPU capacity they're renting to that company through that partnership. So I would say ServiceNow is the distant second, and Palantir has just figured it out so much more quickly than anyone else. And you can go back and look at their revenue growth a couple of years ago versus what they're doing now at just gaudy margins, and say, wow, you bulls really knew what you were talking about. And that's I think that's a really important example of where I was looking at. I was looking maybe too closely at traditional valuation multiples and saying, why does this deserve 80 times forward earnings when they're growing 15% year over year and profits growing 15% year over year? And bulls were rightfully digging in closer and saying, this product release is going to be the biggest game changer in Palantir's value proposition and their financial engine that the company's ever seen. And what results look like right now aren't going to be what they look like in a year. And people willing to make that bet have been rewarded and then some, and look very, very smart. So props to you guys.
And then similarly, and I know you move pretty incrementally in your decisions, but what's been an example of either an earnings report or news coming out with a company that says that you say, okay, that was the last straw, I'm going to start cutting my position or remove it entirely. And can it take one quarter, or do you need to see multiple quarters of kind of confirmed weakness or not meeting expectations before you would make a move in your portfolio?
Yeah, I'll never say never, but usually I am a little more patient than one bad quarter. I think maybe Lululemon is a good example of patience running thin a few quarters ago. And it's just, it kind of gets back to what we talked about Trade Desk maybe an hour ago or 45 minutes ago about, was this your first mistake in 8 years, or was this your third mistake in 3 quarters? And are you picking a third excuse to explain why things look so bad, or not look so bad, but maybe look worse than they're expected to? So for Lululemon, it shifted from we rolled out a pair of leggings that didn't do well, and that cost us growth. And then it shifted to, our product newness isn't where it needs to be, and so our inventory is a little stale, so we need to figure that out, and we'll have it fixed by the end of the spring. Which then shifted to, while other peers were not calling this out, the U.S. consumer weakening, and that's why our traffic is bad. So while it used to be assortment, which is why traffic was good and conversion was bad, now it's weak consumer, which is why traffic is bad, but conversion is still maybe not great. So it's just been, it was one excuse after another, blaming things about the company internally and taking accountability and ownership for that. But as soon as things were supposed to be fixed on their timeline that they promised us and told us to expect, it was shifting from internal micro level excuses to macros really bad. While On Running was delivering a great quarter, while Nike was delivering a much better quarter than they've delivered in over a year. So I think that's a good theme when you run out of micro excuses and then you start blaming the exogenous backdrop, especially when your peers aren't doing the exact same thing. That's like, I see red. It's like you're like that's such a lame excuse, and you no longer deserve my time and money. I think maybe Celsius was another good example where there was this headwind from they earn revenue by selling selling cans to Pepsi. Pepsi is their main North American distributor. So there was maybe a period of time where Pepsi got way overzealous on the amount that they were ordering. So there was a 12, 18-month period where there were inventory resets, where they were ordering a lot less. So there was still a lot of Celsius being sold, but not a lot of Celsius being purchased from Celsius by Pepsi because they already had so much inventory on hand. So that was rightfully slowing down growth, and that made all the sense in the world. But then that wrapped up, and then they started posting quarter after quarter of market share declines and blaming poor macro, which you can't blame market share declines on bad macro, because bad macro should be impacting companies with very similar business models in a nearly identical fashion to you. And if they're taking market share from you, that means they're figuring out how to overcome this better than you are. So it was that understandable excuse wrapping up and thinking, okay, now we're done with this and now we're through this. And then them saying, we're losing market share because macro is bad and because these distribution partners and stores aren't buying as quickly as they were last year, and just all this BS, where I got very annoyed and got out. And then the icing on the cake was their continued market share declines for several quarters in a row, leading them to needing to shell out a lot of money to buy Alani Nu, which is the latest and greatest fad brand in energy drinks. And I think when you get into the game of buy the latest shiny brand that's growing quickly in a category like energy drinks that where things come and go on a dime, on a whim, I think that is just a recipe for disaster and a recipe for owning a lot of worthless assets in several years down the line. So I guess that's another example of just headwinds and excuses and things that don't sit well with me and aren't things that I'm willing to be patient about.
And that's actually a question I wanted to ask you is, when a company you own or are interested in announces an acquisition of another company, how do you kind of take it step by step and interpret whether that's going to be a good thing, a bad thing, hard to tell? What's kind of your reaction? And is there another good example, key example that comes to mind?
Yeah, so I think I have to fight negative bias here a little bit, because in 2021, I made the dumb mistake of being a Teladoc investor and thinking Livongo was a good decision. And just that massive blockbuster purchase where Livongo was growing like crazy, and could lead to a lot more cross-selling and platformization and holistic relationships for Teladoc. So I shy away from blockbuster purchases. I shy away from when a $20 billion company is adding a $12 billion company under their balance sheet and just has this massive integration headache ahead of them. That makes me a little bit nervous. But I mean, for a company like SoFi, which is they do a lot of things, but at the end of the day, they have a banking charter. Most of their business is related to being a bank. Banks need to compete by being more efficient than the other banks so that they can pay more interest on a savings account, so that they can charge less interest, so that they can give more perks in a consumer subscription bundle. You need to outcompete everyone else on marginal cost if your offerings are somewhat similar, so that you can afford to rationally pass on more value to these people. So when they bought Galileo, which is their, and then Technisys, which is now just Galileo, which is their tech division, to me, there's been a lot of headache with macro and the growth rate of that specific segment. But the impact that's had on SoFi's consumer-facing app has been so underappreciated and monumental to me that I care about that way more. Because when you own your tech stack, you're not paying 15 different vendors for this API and for this integration and for this maintenance and over and over and over again. You are pocketing all of that money and allowing it either to flow down to the bottom line on your income statement, or allowing yourself to pay a 4% APY on a savings account while JP Morgan's paying 0.00001% to 99% of their customers. So to me, this was somewhat of a large purchase, so maybe that's not the best example, but the purchase to create not only another revenue opportunity, which Galileo is, and they sell to other customers like Robinhood and H&R Block and Wyndham and a lot of good customers, but to buy something that makes your core business that much more differentiated and that much more special and that much more able to delight customers where others can't. I think Galileo is a big part of SoFi's entire value proposition right now. So that made a lot of sense to me in terms of buying something that lets you differentiate in a sector that's very hard to differentiate in.
Excellent. And I wanted to take a step back a little bit and change gears a little bit and ask you if what's going on in the macro environment with what the Fed's doing and everything else that's going on geopolitically in the world, how much is that factor into your process of overall exposure, how aggressive you'll be with new buys, how you're interpreting companies themselves. So, stepping away from just focusing on individual companies, how does macro, the Fed, all of that play into your process?
Yeah, I might be a stock picker. I might be micro driven, but the phrase "don't fight the Fed" rings very loudly in my ears perpetually. So I think ignoring liquidity, ignoring Fed policy is detrimental to a fundamental investor. Even if you think to yourself, well, how is the Fed printing money going to be positive for CrowdStrike's new product? Like why is that going to make it a better product and a better business? And you're right, it's not, but risk assets are correlated. Risk assets are very tightly tied to available liquidity. And more liquidity will just mean some of that ends up as demand for our stocks and pushes prices higher. So right now, and we can talk, and I'll throw in tariffs after I talk about this, but right now it's so maybe in 2021, when last time things felt a little frothy, which I think there are parts of markets that feel a little frothy. There are parts that don't feel frothy at all, but when you have quantum computing names 5 years away from maybe earning a profit trading at triple-digit sales multiples, there are pockets of froth, and I think that must be respected. But last time this really happened, where we had way more pockets of froth, basically the entire market was a pocket of froth, we were gearing up for about 5 points of rate hikes. We were facing the end of quantitative easing, which is basically the Fed supporting overall liquidity levels through their balance sheet management. And we were heading into quantitative tightening, which is them doing the exact opposite. If you look at where we are right now, a lot of Fed officials are calling for a cut this month. They're calling, I saw Morgan Stanley come out with a note last week saying they're expecting 6 cuts in 2026, which I don't think, that's not my personal base case. But the point is, don't fight the Fed right now means own risk assets. It means rates are going to fall. We haven't even gotten to an end of quantitative tightening or the Fed actively limiting liquidity for capital markets. And every single time there's a negative headline, things get immediately bought up because people are looking forward to that. And people know that the next several moves are probably going to be cuts, and know that liquidity is going to get even easier than it is right now. And credit spreads are going to get even tighter, which is great for consumer lenders, which is great for risk appetite, which is great for taking out loans and taking out margin and things like that, which not something that I do, but something a lot of other people do. And so I think right now, don't fight the Fed means stay involved in equities, and it means lean in. So I'm still, there are still some names where I am taking some profits and I am raising some cash, just because things have gone so far so quickly. I mean, when a company doubles in a month, and profit estimates don't move, so the multiple doubles in a month, it's I have to do something. I can't sit on my hands and do nothing. But that's been modest. It's been sparingly, and I'm remaining pretty mainly invested as I usually do. But the cash position, which usually for me cycles from about 0% to maybe 20% at a peak, is closer to 0% than 20% right now, because don't fight the Fed means fun things right now, unlike it did a few years ago. And there are still companies, like you've got a company like DraftKings, which I view as I don't view what everyone views as a market share, one of the 2 market share leaders in a structural growth category with regulatory tailwinds, some headwinds, but net regulatory tailwinds, trading at I think last time I checked, it was a mid-20s free cash flow multiple, with free cash flow compounding or growing at a multi-year rate at 100%. So if like PEG ratio, which we talked about, so price to profit divided by growth, 1.0x is the overgeneralized benchmark of cheap and expensive. That's trading at 0.25x, which is just, unless estimates are about to fall off a cliff, very, very cheap. So there are pockets of froth, pockets of value, as there always are. And I think right now, it's just acknowledging where things have maybe gotten a little ahead of themselves and shying away a little bit from those parts, but not shying away from markets, because tailwinds are stronger than headwinds at this point in time. And I don't think the next 8 threats of what tariffs are going to be on one country versus the next are really being taken seriously by markets anymore, just because we've seen them come away and leave in such an ephemeral manner so many times that is a 50% tariff on Brazil something to worry about? Well, I'll let you know in 4 days if it's even still there. And also, I mean, we've started to see June inflation data, which is where tariffs were supposed to make an impact, and which is where previous tariffs have already been implemented, and it's been extremely modest, which is somewhat counterintuitive. But we saw the same thing happen in whenever the first trade war was happening during his first term, where there were very good reasons to believe there should have been inflationary forces from tariffs. And for whatever reason, maybe it was demand destruction, maybe it was better supply chain diversity than people expected, so we were able to move more freely. Whatever it was, there was no spike in inflation. And so far, that's kind of happening right now. Tariffs are a lot more aggressive than they were the first time around, but again, will they be in 4 days? I don't know. And will they have that inflationary shock? It hasn't really come yet, and it was supposed to start. So
We'll see. Yeah.
we'll see. Exactly. We'll see is a great. So I don't know. Is the answer?
No, that's good. I wanted to actually go back to 2021 and 2022 and ask you, as an investor during that period and the bear market that happened, in 2022, what were some key lessons that you learned about managing emotions, managing drawdowns, managing, all of that comes with the bear market from your perspective?
Yeah, and I'm pushing 30, so that was my. I mean, you could call 2018 the taper tantrum some kind of a correction, but in terms of depth and longevity, that was correction bear market number one for me. So I think that was a humbling period, and I mean, a period of a lot of learning, and a period where I am grateful that I was kind of still had a lot of student loans and was poor and didn't really have a lot of money, because it was a kind of a cheap lesson when it could have been a more expensive lesson. But I think it's just I think I got enamored and seduced by maybe all of the excitement and all of the camaraderie, let's call it, on FinTwit and these names that really became high profile and everyone raced towards and gravitated towards. And that's really where all of the stuff that I've talked about for the last hour and a half has come from a place of messing up during that time. Has come from a place of following people into Teladoc when I really didn't understand healthcare very well, and I really didn't respect M&A risks and synergy risks. And that for me, I'm an extremely competitive person. So 2022 was a terrible year and really forced me to reevaluate how I'm doing things and maybe to be a bit more conservative and more buttoned up in some places and take a little less beta in the portfolio in other places and make sure the portfolio is maybe going to track markets a little bit more closely instead of just having a group of names that are through the roof in terms of volatility and will be even more sharply moving in whichever direction markets are. So to me, it was, it's funny. Buffett had this transit, and I'm not comparing myself to Warren Buffett, so please no one think that, but had this transition of with Charlie Munger going from deep value to great companies at a great price. And for me, I went from growth at any price to great values at a great price. So it was respecting things like macro and liquidity. It was respecting that cyclical companies aren't going to grow in perpetuity at 50% like they're all claiming that they're going to. It was respecting that companies have sometimes a convoluted incentive to tell you when things are better than they might be, and when you need to kind of do some critical thinking to ask yourself, are they right? And are there real reasons that I think they're wrong, or am I just a little bit nervous? So 2021, 2022 really was, I mean, that was my fourth or fifth year of doing this. And I will tell you, I felt like a superstar in year 4 and year 5, and I felt like an idiot in year 6. And I think for the rest of my career, I will probably feel somewhere in between superstar and idiot status. But I think that was so valuable for me in terms of just gaining some perspective and gaining some modesty and gaining some more experience that will help me and serve me, I think, for a very long time. And that has for the last, I guess, 4 years now. So
did you change like how much you'd allocate to, is that when you kind of implemented those restrictions on speculative names and just had set up a little bit more guardrails with regards to position sizing? Because that's the main way that investors manage risk and manage fluctuations, is their allocation to different volatilities and all that. Yeah.
I think sector exposure didn't change very much. I think what did change a lot is I think my exposure to unprofitable companies was probably like nearly half of the portfolio at one point, and now it's well under 10%. I think my exposure to small caps was a lot higher than it currently is, just because I had this idea in my head that you have to uncover a rock that no one's ever turned before to find a company that no one's heard about to make sure you're the only one that profits off of this. while Meta was doubling and tripling and things like that in the portfolio. And while my least creative and unique ideas were the ones that were doing best. And so I think getting over the fact that I needed to be inventive and creative in my ideas, and getting over the fact that it's okay to invest in the same names that a lot of other people are investing in, as long as you can intelligently explain it yourself and aren't just blindly following them in and borrowing conviction. So getting bigger, getting higher quality, getting more profitable, getting more defensive, I think. And yeah, it was 2, 3, 4 years of things just double every single year, and it's really easy. And then a year of most of my positions are down like 40-50%, and it was a humbling time for sure, but a valuable time.
Yeah, some good takeaways there for sure. I don't have too many more questions. I did want to actually zoom in a little bit on CrowdStrike. I'm not sure if you own it currently, but it seems it's in your wheelhouse. But obviously CrowdStrike went through this news event driven significant decline. I'd love to hear your thoughts on how you interpreted that, how you judge the value of it throughout, and yeah, just how you thought things through during that time. Which obviously, for those who don't know, CrowdStrike shut down the world one day, where they pushed an update that wasn't ready or something similar to that, and basically shut down all Microsoft operating systems, which half the world is run on, airlines, all that. But yeah, Brett, I'd love to hear your thoughts with that. What happened to CrowdStrike during that instance, and how that changed how you view the company, if at all.
Yeah. So it was important to me that it was a software update bug instead of a core security breach and jeopardization of their central value proposition of keeping things safe and preventing breaches. But that was, I think, that was another good learning experience, because I mean, I've personally never invested in a cybersecurity company through a global outage, or I guess maybe Microsoft several years ago. But so I guess it was thinking about how many other options are there besides CrowdStrike? Like, where are you going to go? And to a lot of people, including myself, it was intuitive. You'll go to SentinelOne probably, or you'll go to Palo Alto, which has another large endpoint part of their business, which they really seamlessly cross-sell into their networking and cloud security products. But none of those companies did everything that CrowdStrike does. So they provide charts every single quarter. I actually have the numbers right here, so I'll just offer them. But a third of their customers are using at least 7 of their products. So it is very hard to cut CrowdStrike without replacing them with 4 or 5 different vendors and having all of the clutter, and having all of the disparate systems and stitched together integrations and clunky interfaces that coincide with having more and more vendors. Not to mention the fact that CrowdStrike's tech, per Gartner, per Forrester, MITRE, whoever you want to look at, they don't participate in MITRE, but Gartner and Forrester and IDC is best in class, and not, they might not have the absolute best product for every single module that they offer, but they have one of the best products for every single module they offer, and they have way more than everyone else. So replacing them is extremely expensive, it's extremely costly, and it invites vulnerabilities that these companies are trying to fix while they're thinking to themselves, CrowdStrike didn't present a vulnerability, they just really messed up on a software bug. So to me, I think I own a small piece of CrowdStrike. I actually trimmed a little bit following that outage just because there was so much uncertainty and I was sitting on a few 100%. I mean, I've owned it since the IPO, so it's been a great position for me, but definitely lightened up during that period, and that was the wrong decision, as you can see what the share price has done since then. But to me, it was, let's lighten up a little bit and let's see how this company is going to react. So the first reaction was Kurtz got on the next earnings call and said, this sucked. We are so sorry. We messed up. And this is unacceptable. And here are the 7 things we're doing for our software configuration processes to make sure this doesn't happen again. And then what they did was, and they gave the $10, what was it, a $10 Uber gift card or something and people thought that was the response, which if that was the response, that would not have been okay. But fortunately, that was just an apology to some developers that had to stay up all night fixing what they messed up on. But for other companies, how they addressed this was very, it was very glass half full, and it was very, let's make the most of the situation. They used something called customer commitment packages, where they didn't just say, here are massive discounts on your existing products. they said, we'd like to have you using even more of us. We'd like to have you using more of what we're offering, and we will offer temporary perks. We'll offer temporary discounts. We'll comp you some modules instead of discounting and just giving you a cash apology. And most customers opted into customer commitment packages, which I think bodes very well for that idea we talked about of where else are you going to go, and there's not really anywhere else to go. And if you look at SentinelOne's growth rates over the last year and a half, it's very hard to tell that there was an outage from CrowdStrike, because at a revenue base that's, I think, maybe like 4 or 5 times larger than SentinelOne, they're still outgrowing them. So no one really left. There were some challenges in pipeline and needing to replace new customer growth, which I think did help Palo Alto and SentinelOne a little bit, just in competition rooms, because they did have this chip to play. But no one really left. And what happens now is, I should mention, customer commitment packages are offered through their go-to-market engine called Falcon Flex, which is really just more of an a la carte style of consuming the credits you've purchased, where I don't have to buy $1 million worth of this. There's this module for the next 12 months. I have $1 million worth of credits, and I can use it on this module for that month. Yeah, exactly. So what that has led to is even larger contracts with even more modules, with these perks in these commitment packages wearing off at the end of this year, where we'll be left with CrowdStrike now having customers with more modules that are even more reliant on their ecosystem, that are even stickier, that have even lower chance of going anywhere else, that are paying them just as much as they were paying them before. So they called it seeding the industry with our product or with our modules. And to me, it was just making sure they use this massive blunder and this massive screw up to lick their wounds, to apologize, to go on a tour saying, we suck and we know you don't like us right now, but we're going to make sure you like us even more in a year, and we're going to make sure this never happens again. And right now, they're still getting through customer commitment packages, which is why revenue growth has greatly slowed from mid-30s to 20% as of last quarter. We've got we have one more quarter of that impacting them fully, and then they're going to start wearing off as we start to exit this calendar year. And then this is probably going to go right back to a nearly 30%, probably 25-30% revenue grower with 30% cash flow margins, with a massive runway that has been more successful cross-selling and rounding out their platform across identity, across cloud security, across endpoint security, which is their bread and butter, than anyone else. So to me, that was a massive opportunity for CrowdStrike to kind of lose its luster, for George Kurtz to kind of be taken down a notch and to lose that shine that they've had since they've gone public. And they instead arguably gained even more shine and made themselves even more relied upon vendor for all of these customers, which is just like, good job, George Kurtz. Like you guys did so well there when you could have done so poorly and you didn't. So props to you.
Yeah, that's a smart play. And it seems like your very first thing that you thought about was, is this something that is just a bug, a flash in the pan type thing, or did they do something seriously wrong that is going to permanently impact customers' data and trust and all that? So no, that's really interesting to hear your interpretation of that. And I based on what you just said, I had another follow-up question. When it comes to recent IPOs, what are your rules about investigating them, starting positions? Do you like to see a few quarters before you would consider a position? Because it sounded like a CrowdStrike you bought pretty much right near the IPO. What's your process for that currently? Because IPOs can present amazing opportunities, but obviously there's often a period where they go into substantial decline. Some of them just never work out. So what's kind of your thoughts there?
Yeah, I don't. There's no rule that I have against no IPOs investing on day one. It served me very well in the past with CrowdStrike. It served me very poorly in the past with other companies that I've tried to invest in from the IPO. I would just say maybe the recent batch isn't super compelling to me. I don't. There hasn't been like a CoreWeave, who just basically is reselling NVIDIA infrastructure, and a few of these other companies that don't really stand out to me as much as some other software names and some other consumer discretionary names. So it's not so much no IPOs for me, but it is so much the 2025 class hasn't been super compelling in my point of view. And the valuations have not been super compelling either.
Are there any potentially upcoming IPOs that you're kind of interested in, and any that come to mind?
There are definitely a few. I mean, maybe not interested in buying, but Anthropic and OpenAI and Cohere, I think, are going to be three of the most, and maybe Perplexity if they don't sell to Apple before they go public. those are going to be 4 of the most highly touted and entertaining IPOs we've had in a very long time.
Entertaining. That's a good word for some of these moves. Yep.
Yeah,
Sure.
I mean, some of these companies they're so big, and now they're figuring out ways to let them tokenize or whatever and sell shares privately. And I'm like, just IPO, like just give us all the disclosures that you should be giving us and go public. But there are more things that financial service companies are allowing giant private companies to do to stay private while still accessing needed liquidity, which is a little bit annoying for public market investors like myself. But it is what it is. But and then Anduril, I think, is also an extremely interesting company. Another one that's probably going to have somewhat of a frothy valuation when it goes public, just because people are going to be immediately calling it the next Palantir as soon as it goes public. But they do have some really interesting, intriguing contracts. And they do have a founder who I think is the right kind of quirky in terms of personality you're looking for and track record you're looking for to make a bet on someone. But I'd have to see them give me an S1 and actually be able to dig into financials and gauge what that financial profile is trading at in terms of valuation to know for sure. But those 5, maybe Databricks, which is a big competitor for Snowflake, will be interesting. Yeah, let's stick with those.
Is the right kind of quirky? Is that a checklist item for you in your investing process? Does seem
it's just very abstract. I guess that would be in the feel or art portion of the checklist. But he's an impressive guy.
Awesome. Well, Brad, this has been great. I've really enjoyed that. I'm gonna enjoy watching it back and taking notes. Any last thoughts or bits of advice for maybe traders who want to, dive a little bit into the other side and learn more about how to interpret companies at the level that you do?
Yeah, I'll just echo that you're more than capable. I think it was the Peter Lynch quote that the most important organ in the stock market is not the brain, it's the stomach. And that's him saying that emotion and process and discipline are more important than IQ in this. I think we all have the IQ to be doing this. I also think FA people can learn from TA people and TA people can learn from FA people. I think turning our nose and ignoring any part of a company analysis that has been proven over a very long period of time to be effective for people who do it the right way is not productive. And for me, sometimes there's a rivalry between financial statement driven people and chart driven people, and to me, it's just let's use all the information we have at our disposal. Let's gravitate towards the information that maybe makes the most sense to us, and let's all try to make money in the way that makes the most sense to us. I mean, we all have different personalities. We all have different risk tolerances. We all have different strengths and weaknesses. So we're all going to look at different things and all do things in a slightly different way. And I think sometimes people find that threatening and sometimes people find that offensive. And I find the people who find it threatening and offensive to be confusing because we're all just trying to do this in the best way possible. And maybe you learned something today that'll help you. Maybe you didn't. Hopefully you did, because it's been like an hour and a half. So hopefully there's at least one thing in there that was somewhat valuable. But I learned a ton from Richard too, and I learned a ton from you people who trade charts. And I think knowledge is power, and ignoring knowledge willfully is not smart.
Great, that's fantastic. And where can people go if they want to learn more from you and learn your style a little bit more? Stockmarketnerd.com, is it .com?
Yeah, stockmarketnerd.com. Portfolio and all the equity research is there.
Awesome. Well, Brad, thank you so much again for your time. That was a very diplomatic answer, very peace along the world, marrying FA people with TA. But I completely agree. I think edges in the market come in so many different shapes and sizes, and we all just have to find something that works with us. And I appreciate you coming on and sharing your perspective. So thank you again to everybody watching. I hope you guys enjoyed. Leave a like down below if you did, and we'll see you guys in the next one. Cheers.
All right. Well, that's it for day 5 of the 2025 TraderLion Trading Conference. Again, a huge thank you to our presenters and a huge thank you to you guys, our audience members, for attending. We couldn't do this without you. So thanks so much. Hopefully you guys got a lot out of it. Let us know in the chat right now which of the presentations today were your favorite. Be really interested to hear that. And if you have 1 or 2 favorite quotes from today, that would be cool as well to put in the chat. But again, we've got a fantastic lineup, not just today, but this whole conference. So a huge thank you to our presenters, and hopefully you guys are getting a lot out of the 2025 conference. I do want to mention, to get the most out of the experience, you definitely want to sign up for the free VIP pass. Again, all the sessions are recorded and housed there, in addition to slides, bonus resources, and notes that we're creating. And you'll also get access to free giveaways of TraderLion Masterclasses and Deep View. So definitely don't miss this. You definitely want to sign up here if you haven't already, and check out the resources that we're creating that really expand on the webinars itself. So definitely pick up your 100% free VIP pass. Again, I want to mention a huge thank you to NinjaTrader Live for sponsoring the conference. NinjaTrader is basically an educational service that allows for live daily futures trading, real-time market coverage, and actionable strategies. They're live 6 days a week with fantastic traders and educators. You can learn more about them by scanning this QR code, as well as clicking the link in the description. It's a great way to support the conference as well. Check them out if you're interested at all in futures trading. And there's a lot of lessons there that supersede futures trading and apply to all trading methodologies. So definitely go ahead and check them out if you haven't already. I also want to mention again, the Trader's Handbook is our debut book that we worked tremendously hard on, that was released just over a month ago now. It's been amazing to see that we have already got close to 15,000 readers. We're rated 4.9 stars with a little over 400 reviews on Amazon, which is amazing. There's not many books that do that. And we're super excited about all the feedback that you guys are getting. And it's good to see you guys are finding it a valuable resource. We've got a testimony here from Stan Weinstein. The Trader's Handbook is a clear, no-nonsense resource for anyone serious about improving their trading. It's rooted in common sense, sound technical principles, and most importantly, discipline. The authors focus on price action, trends, risk management, and teach you how to build a real process, not just chase opinions. It's a practical book that respects and emphasizes the core truth that the tape tells all. I recommend that you pick up a copy for your trading library. Amazing to hear that from Stan, who wrote one of the foundational texts in growth stock trading. Of course, the secrets for profiting in bull and bear markets. He's also the founder of Global Trend Alert. So go ahead and listen to Stan if you haven't already, and pick up a copy. I believe it's on sale right now. So definitely go ahead and check it out and let us know what you think. And if you already read it, let us know in the chat what you think, and let other readers know that they should, or potential readers know that they should pick up a copy. All right, here's a quick preview of tomorrow's schedule. This will be fantastic, starting at 9:30 with Stan Weinstein himself. We'll go through a lot of case studies of stage analysis in recent markets. He'll be discussing stage analysis in modern markets. Then at 11 a.m., we've got Dr. Eric Wish discussing the green line breakout, blue dot, and daily EMA bound setups. That will be fantastic, and some great lessons about trading at large there as well. Then at 12:30, we've got Rohit RK discussing the secret path of big money, mastering institutional buying in winning sectors and stocks. That will be really, really great. At 2 p.m., we've got Matt Caruso discussing timing growth stock leaders with market trends and sentiment. Very important presentation. And then last but not least, but I am the last one, I'll be presenting on fighting and trading breakouts with relative measured volatility, share my process and routines for speeding up my process for finding VCP setups and also trading them as well. So this will be a fantastic day as well, and we'll be closing out really strongly. So I look forward to seeing you guys there, and let us know in the chat right now who you are most looking forward to hearing from, other than myself, of course. But with that said, thank you guys all for tuning in again. Thank you to everybody for your great messages and engagement and questions in the chat, and we look forward to seeing you guys here tomorrow. So stay tuned, and see you guys shortly. Cheers.